Hey everyone, welcome back to the channel. Today we're diving into a game-changing audiobook for anyone serious about trading and investing, Evidence-Based Technical Analysis by David Aronson. Now, if you've ever questioned whether chart patterns and technical indicators truly work, or if they're just trading folklore, this book is for you. Aronson, a former Wall Street quant and technical analyst, pulls no punches. He applies scientific rigor and statistical testing to debunk myths and reveal what really holds up under scrutiny. Forget gut feelings. This is all about evidence, data, and hard proof. Aronson explores how to evaluate trading strategies using the same methods scientists use to test hypotheses. You'll learn about data mining bias, overfitting, and why traditional technical analysis often fails under scientific testing. Whether you're a beginner looking to build a solid foundation or an experienced trader seeking a reality check, evidence-based technical analysis will challenge your thinking and likely change the way you approach the markets forever. So sit back, hit play, and get ready to rethink everything you thought you knew about technical analysis.
Evidence-Based Technical Analysis by David Aronson. Introduction. Technical analysis, TA, is the study of recurring patterns in financial market data with the intent of forecasting future price movements. It is comprised of numerous analysis methods, patterns, signals, indicators, and trading strategies, each with its own cheerleaders claiming that their approach works. Much of popular or traditional TA stands where medicine stood before it evolved from a faith-based folk art into a practice based on science. Its claims are supported by colorful narratives and carefully chosen, cherry-picked anecdotes rather than objective statistical evidence. This book's central contention is that TA must evolve into a rigorous observational science if it is to deliver on its claims and remain relevant. The scientific method is the only rational way to extract useful knowledge from market data and the only rational approach for determining which TA methods have predictive power. I call this evidence-based technical analysis, EBTA. Grounded in objective observation and statistical inference, i.e., the scientific method, EBTA charts a course between the magical thinking and gullibility of a true believer and the relentless doubt of a random walker. Approaching TA, or any discipline for that matter, in a scientific manner is not easy. Scientific conclusions frequently conflict with what seems intuitively obvious. To early humans, it seemed obvious that the sun circled the earth. It took science to demonstrate that this intuition was wrong. An informal, intuitive approach to knowledge acquisition is especially likely to result in erroneous beliefs when phenomena are complex or highly random, two prominent features of financial market behavior. Although the scientific method is not guaranteed to extract gold from the mountains of market data, an unscientific approach is almost certain to produce fool's gold. This book's second contention is that much of the wisdom comprising the popular version of TA does not qualify as legitimate knowledge. Key definitions, propositions, and claims, belief, and knowledge. I have already used the terms knowledge and belief, but have not rigorously defined them. These and several other key terms will be used repeatedly in this book, so some formal definitions are needed. The fundamental building block of knowledge is a declarative statement, also known as a claim or a proposition. A declarative statement is one of four types of utterances that also include exclamations, questions, and commands. Declarative statements are distinguished from the others in that they have truth value. That is to say, they can be characterized as either true or false, or probably true or probably false. The statement, "Oranges are on sale at the supermarket for 5 cents a dozen," is declarative. It makes a claim about a state of affairs existing at the local market. It may be true or false. In contrast, the exclamatory statement, "Holy cow, what a deal," the command, "Go buy me a dozen," or the question, "What is an orange?" cannot be called true or false. Our inquiry into TA will be concerned with declarative statements, such as, "Rule X has predictive power." Our goal is to determine which of these declarative statements warrant our belief. What does it mean to say, "I believe X"? With regard to states of affairs in general, i.e., matters of fact or what will happen, believing X amounts to expecting to experience X if and when we are in a position to do so. Therefore, if I believe the claim that oranges are on sale for 5 cents a dozen, it means that I expect to be able to buy oranges for 5 cents a dozen if I go to the store. However, the command to buy some oranges or the exclamation that I am happy about the opportunity set up no such expectation. What does all this means for us? For any statement to even be considered as a candidate for belief, it must assert some state of affairs that can be expected. Such statements are said to have cognitive content. They convey something that can be known. If the statement contains nothing to know, then there is nothing there to be believed. Although all declarative statements presumably have cognitive content, not all actually do. This is not a problem if the lack of cognitive content is obvious. For example, the declaration, "the square root of Tuesday is a prime number." This utterance is, on its face, nonsense. There are other declarative statements, however, whose lack of cognitive content is not so obvious. This can be a problem, because such statements can fool us into thinking that a claim has been made that sets up an expectation, when in fact, no claim has really been put forward. These pseudo-declarative statements are essentially meaningless claims or empty propositions. Although meaningless claims are not valid candidates for belief, this does not stop many people from believing in them. The vague predictions made in the daily astrology column or the nebulous promises made by promoters of bogus health cures are examples of meaningless claims. Those who believe these empty propositions simply do not realize that what they have been told has no cognitive content. A way to tell if a statement has cognitive content and is, thus, a valid candidate for belief is the discernible difference test described by Hall. Utterances with cognitive content make claims that are either true or false, and whether they are true or false makes a difference that can be discerned. That is why these utterances offer something to believe, and why there is no point in trying to believe an utterance that makes no such offer. In other words, a proposition that passes the discernible difference test sets up an expectation such that the state of affairs, if the statement were true, is recognizably different from the state of affairs, if the statement were false. The discernible difference criterion can be applied to statements purporting to be predictions. A prediction is a claim to know something about the future. If a prediction has cognitive content, it will be clearly discernible in the outcome if the prediction was accurate or not. Many, if not most, of the forecasts issued by practitioners of popular TA are devoid of cognitive content on these grounds. In other words, the predictions are typically too vague to ever determine if they were wrong. The truth or falsity of the claim "oranges are on sale for 5 cents a dozen" will make a discernible difference when I get to the market. It is this discernible difference that allows the claim to be tested. As will be described in Chapter 3, testing a claim on the basis of a discernible difference is central to the scientific method. Hall, in his book Practically Profound, explains why he finds Freudian psychoanalysis to be meaningless when examined in light of the discernible difference test. Certain Freudian claims about human sexual development are compatible with all possible states of affairs. There is no way to confirm or disconfirm either penis envy or castration complex, because there is no distinguishable difference between evidence affirming and evidence denying these interpretations of behavior. Exactly opposite behaviors are equally predictable, depending on whether the alleged psychosexual stress is overt or repressed. The requirement of cognitive content rules out all utterances that are so loose, poorly formed, or obsessively held, e.g., conspiracy theories, that there is no recognizable difference between what would be the case if they were so and what would be the case if they were not. In a like vein, the intelligent design theory carries no cognitive freight in the sense that no matter what life form is observed, it is consistent with the notion that it manifests an underlying form specified by some intelligent designer. What then is knowledge? Knowledge can be defined as justified true belief. Hence, in order for a declarative statement to qualify as knowledge, not only must it be a candidate for belief because it has cognitive content, but it must meet 2 other conditions as well. First, it must be true or probably true. Second, the statement must be believed with justification. A belief is justified when it is based on sound inferences from solid evidence. Prehistoric humans held the false belief that the sun moved across the sky because the sun orbited the earth. Clearly, they were not in possession of knowledge, but suppose that there was a prehistoric person who believed correctly that the sun moved across the sky because of the Earth's rotation. Although this belief was true, this individual could not be described as possessing knowledge. Even though they believed what astronomers ultimately proved to be true, there was no evidence yet to justify that belief. Without justification, a true belief does not attain the status of knowledge. These concepts are illustrated in Figure 1.1. From this it follows that erroneous beliefs or false knowledge fail to meet one or more of the necessary conditions of knowledge. Thus, an erroneous belief can arise either because it concerns a meaningless claim, or because it concerns a claim that, though meaningful, is not justified by valid inferences from solid evidence. Still, even when we have done everything right, by drawing the best possible inference from sound evidence, we can still wind up adopting erroneous beliefs. In other words, we can be justified in believing a falsehood and honestly claim to know something if it appears to be true according to logically sound inferences from the preponderance of available evidence. We are entitled to say I know when the target of that claim is supported beyond reasonable doubt in the network of well-tested evidence. But that is not enough to guarantee that we do know. Falsehoods are an unavoidable fact of life when we attempt to know things about the world based on observed evidence. Thus, knowledge based on the scientific method is inherently uncertain and provisional, though less uncertain than knowledge acquired by less formal methods. However, over time, scientific knowledge improves as it comes to describe reality in a progressively more accurate manner. It is a continual work in progress. The goal of EBTA is a body of knowledge about market behavior that is as good as can be had, given the limits of evidence gathering and the powers of inference. Erroneous TA knowledge, the cost of undisciplined analysis. To understand why the knowledge produced by the popular version of TA is untrustworthy, we must consider two distinct forms of TA, subjective and objective. Both approaches can lead to erroneous beliefs, but they do so in distinct ways. Objective TA methods are well-defined, repeatable procedures that issue unambiguous signals. This allows them to be implemented as computerized algorithms and back-tested on historical data. Results produced by a back-test can be evaluated in a rigorous quantitative manner. Subjective TA methods are not well-defined analysis procedures. Because of their vagueness, an analyst's private interpretations are required. This thwarts computerization, back-testing, and objective performance evaluation. In other words, it is impossible to either confirm or deny a subjective method's efficacy. For this reason, they are insulated from evidentiary challenge. From the standpoint of EBTA, subjective methods are the most problematic. They are essentially meaningless claims that give the illusion of conveying cognitive content. Because the methods do not specify how they are to be applied, different analysts applying it to the same set of market data can reach different conclusions. This makes it impossible to determine if the method provides useful predictions. Classical chart pattern analysis, hand-drawn trend lines, Elliott wave principle, Gann patterns, magic t-TICS, and numerous other subjective methods fall into this category. Objective TA is religion. It is based on faith. No amount of cherry-picked examples showing where the method succeeded can cure this deficiency. Despite their lack of cognitive content and the impossibility of ever being supported by sound evidence, there is no shortage of fervent believers in various subjective methods. Chapter 2 explains how flaws in human thinking can produce strong beliefs in the absence of evidence, or even in the face of contradictory evidence. Objective TA can also spawn erroneous beliefs, but they come about differently. They are traceable to faulty inferences from objective evidence. The mere fact that an objective method has been profitable in a back test is not sufficient grounds for concluding that it has merit. Past performance can fool us. Historical success is a necessary but not a sufficient condition for concluding that a method has predictive power and therefore is likely to be profitable in the future. Favorable past performance can occur by luck or because of an upward bias produced by one form of back testing called data mining. Determining when back test profits are attributable to a good method rather than good luck is a question that can only be answered by rigorous statistical inference. This is discussed in Chapters 4 and 5. Chapter 6 considers the problem of data mining bias. Although I will assert that data mining, when done correctly, is the modern technician's best method for knowledge discovery, specialized statistical tests must be applied to the results obtained with data mining. How EBTA is different. What sets EBTA apart from the popular form of TA? First, it is restricted to meaningful claims, objective methods that can be tested on historical data. Second, it utilizes advanced forms of statistical inference to determine if a profitable backtest is indicative of an effective method. Thus, the prime focus of EBTA is determining which objective methods are worthy of actual use. EBTA rejects all forms of subjective TA. Subjective TA is not even wrong, it is worse than wrong. Statements that can be qualified as wrong, untrue, at least convey cognitive content that can be tested. The propositions of subjective TA offer no such thing. Though, at first blush, they seem to convey knowledge, when they are examined critically, it becomes clear they are empty claims. Promoters of New Age health cures excel at empty claims. They tell you that wearing their magic copper bracelet will make you feel better and put more bounce in your step. They suggest your golf game will improve and maybe even your love life. However, the claim's lack of specificity makes it impossible to nail down exactly what is being promised or how it can be tested. Such claims can never be confirmed or contradicted with objective evidence. On these same grounds, it can be said that the propositions of subjective TA are empty and thus insulated from empirical challenge. They must be taken on faith. In contrast, a meaningful claim is testable because it makes measurable promises. It states specifically how much your golf game will improve or how bouncy your steps will be. This specificity opens the claim to being contradicted with empirical evidence. From the perspective of EBTA, proponents of subjective methods are faced with a choice. They can reformulate the method to be objective, as one practitioner of the Elliott wave principle has done, thus exposing it to empirical refutation, or they must admit the method must be accepted on faith. Perhaps Gann lines actually provide useful information. In their present form, we are denied this knowledge. With respect to objective TA, EBTA does not take profitable backtests at face value. Instead, they are subjected to rigorous statistical evaluation to determine if profits were due to luck or biased research. As will be pointed out in Chapter 6, in many instances, profitable backtests may be a data miner fool's gold. This may explain why many objective TA methods that perform well in a backtesting perform worse when applied to new data. Evidence-based technical analysis uses computer-intensive statistical methods that minimize problems stemming from the data mining bias. The evolution of TA to EBTA also has ethical implications. It is the ethical and legal responsibility of all analysts, whatever form of analysis they practice, to make recommendations that have a reasonable basis and not to make unwarranted claims. The only reasonable basis for asserting an analysis method has value is objective evidence. Subjective TA methods cannot meet this standard. Objective TA, conducted in accordance with the standards of EBTA, can. EBTA results from academia. Evidence-based technical analysis is not a new idea. Over the past 2 decades, numerous articles in respected academic journals 16 have approached TA in the rigorous manner advocated by this book. The evidence is not uniform. Some studies show TA does not work, but some show that it does. Because each study is confined to a particular aspect of TA and a specific body of data, it is possible for studies to reach different conclusions. This is often the case in science. The following are a few of the findings from academic TA. It shows that when approached in a rigorous and intellectually honest manner, TA is a worthwhile area of study. Expert chartists are unable to distinguish actual price charts of stocks from charts produced by a random process. There is empirical evidence of trends in commodities and foreign exchange markets that can be exploited with the simple objective trend indicators. In addition, the profits earned by trend-following speculators may be justified by economic theory because their activities provide commercial hedgers with a valuable economic service, the transference of price risk from hedger to speculator. Simple technical rules used individually and in combinations can yield statistically and economically significant profits when applied to stock market averages composed of relatively young companies, Russell 2000 and Nasdaq Composite. Neural networks have been able to combine buy/sell signals of simple moving average rules into nonlinear models that displayed good predictive performance on the Dow Jones average over the period 1897 to 1988. Trends in industry groups and sectors persist long enough after detection by simple momentum indicators to earn excess returns. Stocks that have displayed prior relative strength and relative weakness continue to display above average and below average performance over horizons of 3 to 12 months. United States stocks selling near their 52-week highs outperform other stocks. An indicator defined as the differential between a stock's current price and its 52-week high is a useful predictor of future relative performance. The indicator is an even more potent predictor for Australian stocks. The Head and Shoulders chart pattern has limited forecasting power when tested in an objective fashion in currencies. Better results can be had with simple filter rules. The Head and Shoulders pattern, when tested objectively on stocks, does not provide useful information. Traders who act on such signals would be equally served by following a random signal. Trading volume statistics for stocks contain useful predictive information and improve the profitability of signals based on large price changes following a public announcement. Computer-intensive data modeling neural networks, genetic algorithms, and other statistical learning and artificial intelligence methods have found profitable patterns in technical indicators. Who am I to criticize TA? My interest in TA began in 1960 at the age of 15. During my high school and college years, I followed a large stable of stocks using the Chartcraft point and figure method. I have used TA professionally since 1973, first as a stockbroker, then as managing partner of a small software company, Radin Research Group Inc., an early adopter of machine learning and data mining in financial market applications, and finally as a proprietary equities trader for Spear, Leeds, and Kellogg. In 1988, I earned the Chartered Market Technician designation from the Market Technicians Association. My personal TA library has over 300 books. I have published approximately a dozen articles and have spoken numerous times on the subject. Currently, I teach a graduate-level course in TA at the Zicklin School of Business, Baruch College, City University of New York. I freely admit my previous writings and research do not meet EBTA standards, in particular with regard to statistical significance and the data mining bias. My long-standing faith in TA began to erode in response to a very mediocre performance over a 5-year period trading capital for Spear, Leeds, and Kellogg. How could what I believed in so fervently not work? Was it me or something to do with TA in general? My academic training in philosophy provided fertile grounds for my growing doubts. My concerns crystallized into full-fledged skepticism as a result of reading 2 books, How We Know What Isn't So by Thomas Jilovich and Why People Believe Weird Things by Michael Shermer. My conclusion, technical analysts, including myself, know a lot of stuff that isn't so and believe a lot of weird things. Technical analysis, art, science, or superstition. There is a debate in the TA community, is it an art or a science? The question has been framed incorrectly. It is more properly stated as, should TA be based on superstition or science? Framed this way, the debate evaporates. Some will say TA involves too much nuance and interpretation to render its knowledge in the form of scientifically testable claims. To this, I retort, TA that is not testable may sound like knowledge, but it is not. It is superstition that belongs in the realm of astrology, numerology, and other non-scientific practices. Creativity and inspiration play a crucial role in science. They will be important in EBTA as well. All scientific inquiries start with a hypothesis, a new idea, or a new insight inspired by a mysterious mixture of prior knowledge, experience, and a leap of intuition. Yet, good science balances creativity with analytical rigor. The freedom to propose new ideas must be married to an unyielding discipline that eliminates ideas that prove worthless in the crucible of objective testing. Without this anchor to reality, people fall in love with their ideas, and magical thinking replaces critical thought. It is unlikely that TA will ever discover rules that predict with the precision of the laws of physics. The inherent complexity and randomness of financial markets and the impossibility of controlled experimentation preclude such findings. However, predictive accuracy is not the defining requirement of science. Rather, it is defined by an uncompromising openness to recognizing and eliminating wrong ideas. I have 4 hopes for this book. First, that it will stimulate a dialogue amongst technical analysts that will ultimately put our field on a firmer intellectual foundation. Second, that it will encourage further research along the lines advocated herein. Third, that it will encourage consumers of TA to demand more beef from those who sell products and services based upon TA. And fourth, that it will encourage TA practitioners, professional and otherwise, to understand their crucial role in a human-machine partnership that has the potential to accelerate the growth of legitimate TA knowledge. No doubt some fellow practitioners of TA will be irritated by these ideas. This can be a good thing. An oyster irritated by a grain of sand sometimes yields a pearl. I invite my colleagues to expend their energies adding to legitimate knowledge rather than defending the indefensible. This book is organized in 2 sections. Part 1 establishes the methodological, philosophical, psychological, and statistical foundations of EBTA. Part 2 demonstrates one approach to EBTA, testing of 6402 binary by /cell rules on the S&P 500 on 25 years of historical data. The rules are evaluated for statistical significance using tests designed to cope with the problem of data mining bias. Part 1. Methodological, Psychological, Philosophical, and Statistical Foundations. Chapter 1. Objective Rules and Their Evaluation. This chapter introduces the notion of objective binary signaling rules and a methodology for their rigorous evaluation. It defines an evaluation benchmark based on the profitability of a non-informative signal. It also establishes the need to detrend market data so that the performances of rules with different long/short position biases can be compared. The Great Divide: Objective versus Subjective Technical Analysis. Technical analysis, TA, divides into two broad categories, objective and subjective. Subjective TA is comprised of analysis methods and patterns that are not precisely defined. As a consequence, a conclusion derived from a subjective method reflects the private interpretations of the analyst applying the method. This creates the possibility that two analysts applying the same method to the same set of market data may arrive at entirely different conclusions. Therefore, subjective methods are untestable, and claims that they are effective are exempt from empirical challenge. This is fertile ground for myths to flourish. In contrast, objective methods are clearly defined. When an objective analysis method is applied to market data, its signals or predictions are unambiguous. This makes it possible to simulate the method on historical data and determine its precise level of performance. This is called backtesting. The backtesting of an objective method is, therefore, a repeatable experiment which allows claims of profitability to be tested and possibly refuted with statistical evidence. This makes it possible to find out which objective methods are effective and which are not. The acid test for distinguishing an objective from a subjective method is the programmability criterion. A method is objective if and only if it can be implemented as a computer program that produces unambiguous market positions, long, short, or neutral. All methods that cannot be reduced to such a program are, by default, subjective. TA rules. Objective TA methods are also referred to as mechanical trading rules or trading systems. In this book, all objective TA methods are referred to simply as rules. A rule is a function that transforms one or more items of information, referred to as the rule's input, into the rule's output, which is a recommended market position, e.g., long, short, neutral. Input S consists of one or more financial market time series. The rule is defined by one or more mathematical and logical operators that convert the input time series into a new time series that consists of the sequence of recommended market position, long, short, out of the market. The output is typically represented by a sign number, e.g., +1 or -1. This book adopts the convention of assigning positive values to indicate long positions and negative values to indicate shorts position. Process by which a rule transforms one or more input series into an output series is illustrated in Figure 1.1. A rule is said to generate a signal when the value of the output series changes. A signal calls for a change in a previously recommended market position. For example, a change in output from +1 to -1 would call for closing a previously held long position and the initiation of a new short position. Output values need not be confined to +1, -1. A complex rule, whose output spans the range +10, -10, is able to recommend positions that vary in size. For example, an output of +10 might indicate that 10 long positions are warranted, such as long 10 contracts of copper. A change in the output from +10 to +5 would call for a reduction in the long position from 10 contracts to 5, i.e., sell 5. Binary rules and thresholds. The simplest rule is one that has a binary output. In other words, its output can assume only two values, for example +1 and -1. A binary rule could also be designed to recommend long/neutral positions or short/neutral positions. All the rules considered in this book are binary long/short +1, -1. An investment strategy based on a binary long/short rule is always in either a long or short position in the market being traded. Rules of this type are referred to as reversal rules because signals call for a reversal from long to short or short to long. Over time, a reversal rule produces a time series of +1 and -1 that represent an alternating sequence of long and short positions. Specific mathematical and logical operators that are used to define rules can vary considerably. However, there are some common themes. One theme is the notion of a threshold, a critical level that distinguishes the informative changes in the input time series from its irrelevant fluctuations. The premise is that the input time series is a mixture of information and noise. Thus, the threshold acts as a filter. Rules that employ thresholds generate signals when the time series crosses the threshold, either by the rising above it or falling beneath it. These critical events can be detected with logical operators called inequalities such as greater than and less than. For example, if the time series is greater than the threshold, then rule output equals +1, otherwise rule output equals -1. A threshold may be set at a fixed value, or its value may vary over time as a result of changes in the time series that is being analyzed. Variable thresholds are appropriate for time series that display trends, which are large, long-lasting changes in the level of the series. Trends, which make fixed threshold rules impractical, are commonly seen in asset prices, e.g., S&P 500 index and asset yields, AAA bond yield. The moving average and the Alexander reversal filter, also known as the zigzag filter, are examples of time series operators that are commonly used to define variable thresholds. The operators used in the rules discussed in this book are detailed in Chapter 8. The moving average cross rule is an example of how a variable threshold is used to generate signals on a time series that displays trends. This type of rule produces a signal when the time series crosses from one side of its moving average to the other. For example, if the time series is above its moving average, then the rule output value equals +1, otherwise the rule output value equals -1. This is illustrated in Figure 1.2. Because it employs a single threshold, the signals generated by the moving average cross rule are, by definition, mutually exclusive. Given a single threshold, there are only two possible conditions. The time series is either above or below the threshold. The conditions are also exhaustive, no other possibilities. Thus, it is impossible for the rule's signals to be in conflict. Rules with fixed value thresholds are appropriate for market time series that do not display trends. Such time series are said to be stationary. There is a strict mathematical definition of a stationary time series, but here I am using the term in a looser sense to mean that a series has a relatively stable average value over time and has fluctuations that are confined to a roughly horizontal range. Technical analysis practitioners often refer to these series as oscillators. Time series that display trends can be detrended. In other words, they can be transformed into a stationary series. Detrending, which is described in greater detail in Chapter 8, frequently involves taking differences or ratios. For example, the ratio of a time series to its moving average will produce a stationary version of the original time series. Once detrended, the series will be seen to fluctuate within a relatively well-defined horizontal range around a relatively stable mean value. Once the time series has been made stationary, fixed threshold rules can be employed. An example of a fixed threshold rule using a threshold of value of 75 is illustrated in Figure 1.3. The rule has an output of value of +1 when the series is greater than the threshold and a value of -1 at other times. Binary rules from multiple thresholds. As pointed out earlier, binary rules are derived quite naturally from a single threshold because the threshold defines two mutually exclusive and exhaustive conditions. The time series is either above or below threshold. However, binary rules can also be derived using multiple thresholds, but employing more than one threshold creates the possibility that the input time series can assume more than two conditions. Consequently, multiple threshold rules require a more sophisticated logical operator than the simple inequality operator, greater than or less than, which suffices for single threshold rules. When there are two or more thresholds, there are more than two possible conditions. For example, with two thresholds, an upper and lower, there are three possible conditions for the input time series. It can be above the upper, below the lower, or between the two thresholds. To create a binary rule in this situation, the rule is defined in terms of two mutually exclusive events. An event is defined by the time series crossing a particular threshold in a particular direction. Thus, one event triggers one of the rule's output values, which is maintained until a second event, which is mutually exclusive of the first, triggers the other output value. For example, an upward crossing of the upper threshold triggers a +1, and a downward crossing of the lower threshold triggers a -1. A logical operator that implements this type of rule is referred to as a flip-flop. Name stems from the fact that the rule's output value flips one way upon the occurrence of one event, and then flops the other way upon the occurrence of the second event. Flip-flop logic can be used with either variable or fixed threshold rules. An example of a rule based on two variable thresholds is the moving average band rule. See Figure 1.4. Here, the moving average is surrounded by an upper and lower band. The bands may be a fixed percentage above and below the moving average, or the deviation of the bands may vary based on the recent volatility of the times, as is the case with the Bollinger Band. An output value of +1 is triggered by an upward piercing of the upper threshold. This value is retained until the lower threshold is penetrated in the downward direction, causing the output value to change to -1. Obviously, there are many other possibilities. The intent here has been to illustrate some of the ways that input time series can be transformed into a time series of recommended market positions. Hayes adds another dimension to threshold rules with directional modes. He applies multiple thresholds to a stationary time series such as a diffusion indicator. At a given point in time, the indicator's mode is defined by the zone it occupies and its recent direction of change, e.g., up or down over the most recent 5 weeks. Each zone is defined by an upper and lower threshold, e.g., 40 and 60. Hayes applies this to a proprietary diffusion indicator called Big Mo. With 2 thresholds and 2 possible directional modes up/down, 6 mutually exclusive conditions are defined. Binary rule could be derived from such an analysis by assigning one output value, e.g., +1 to one of the 6 conditions, and then assigning the other output value, i.e., -1 to the other 5 possibilities. Hayes asserts that one of the modes, when the diffusion indicator is above 60 and its direction is upward, is associated with stock market returns value line composite index of 50% per annum. This condition has occurred about 20% of the time between 1966 and 2000. However, when the diffusion indicator is 60 and its recent change is negative, the market's annualized return is 0. This condition has occurred about 16% of the time. Traditional rules and inverse rules. Part 2 of this book is a case study that evaluates the profitability of approximately 6,400 binary long/short rules applied to the S&P 500 index. Many of the rules generate market positions that are consistent with traditional principles of technical analysis. For example, under traditional TA principles, a moving average cross rule is interpreted to be bullish output value +1 when the analyzed time series is above its moving average, and bearish output value of -1 when it is below the moving average. I refer to these as traditional TA rules. Given that the veracity of traditional TA may be questionable, it is desirable to test rules that are contrary to the traditional interpretation. In other words, it is entirely possible that patterns that are traditionally assumed to predict rising prices may actually be predictive of falling prices. Alternatively, it is possible that neither configuration has any predictive value. This can be accomplished by creating an additional set of rules whose output is simply the opposite of a traditional TA rule. I refer to these as inverse rules. This is illustrated in Figure 1.5. The inverse of the moving average cross rule would output a value of -1 when the input time series is above its moving average, and +1 when the series is below its moving average. There is yet another reason to consider inverse rules. Many of the rules tested in Part 2 utilize input series other than the S&P 500, for example the yield differential between BAA and AAA corporate bonds. It is not obvious how this series should be interpreted to generate signals. Therefore, both uptrends and downtrends in the yield differential were considered as possible buy signals. The details of these rules are taken up in Chapter 8. Use of benchmarks in rule evaluation. In many fields, performance is a relative matter. That is to say, it is performance relative to a benchmark that is informative rather than an absolute level of performance. In track and field, competitors in the shot put are compared to a benchmark defined as best distance of that day or the best ever recorded in the state or world. To say that someone put the shot 43 feet does not reveal the quality of performance. However, if the best prior effort had been 23 feet, 43 feet is a significant accomplishment. This pertains to rule evaluation. Performance figures are only informative when they are compared to a relevant benchmark. The isolated fact that a rule earned a 10% rate of return in a backtest is meaningless. If many other rules earned over 30% on the same data, 10% would indicate inferiority, whereas if all other rules were barely profitable, 10% might indicate superiority. What then is an appropriate benchmark for TA rule performance? What standard must a rule beat to be considered good? There are a number of reasonable standards. This book defines that standard as the performance of a rule with no predictive power, i.e., a randomly generated signal. This is consistent with scientific practice in other fields. In medicine, a new drug must convincingly outperform a placebo sugar pill to be considered useful. Of course, rational investors might reasonably choose a higher standard of performance but not a lesser one. Some other benchmarks that could make sense would be the riskless rate of return, the return of a buy and hold strategy, or the rate of return of the rule currently being used. In fact, to be considered good, it is not sufficient for a rule to simply beat the benchmark. It must beat it by a wide enough margin to exclude the possibility that its victory was merely due to chance, good luck. It is entirely possible for a rule with no predictive power to beat its benchmark in a given sample of data by sheer luck. The margin of victory that is sufficient to exclude luck as a likely explanation relates to the matter of statistical significance. This is taken up in chapters 4, 5, and 6. Having now established that the benchmark that we will use is the return that could be earned by a rule with no predictive power, we now face another question: how much might a rule with no predictive power earn? At first blush, it might seem that a return of 0 is a reasonable expectation. However, this is only true under a specific and rather limited set of conditions. In fact, the expected return of a rule with no predictive power can be dramatically different than 0. This is so because the performance of a rule can be profoundly affected by factors that have nothing to do with its predictive power. The conjoint effect of position bias and market trend on back-test performance. In reality, a rule's back-tested performance is comprised of two independent components. One component is attributable to the rule's predictive power, if it has any. This is the component of interest. The second and unwanted component of performance is the result of two factors that have nothing to do with the rule's predictive power. One, the rule's long/short position bias, and two, the market's net trend during the backtest period. This undesirable component of performance can dramatically influence backtest results and make rule evaluation difficult. It can cause a rule with no predictive power to generate a positive average return, or it can cause a rule with genuine predictive power to produce a negative average return. Unless this component of performance is removed, accurate rule evaluation is impossible. Let's consider the two factors that drive this component. The first factor is a rule's long/short position bias. This refers to the amount of time the rule spent in a +1 output state relative to the amount of time spent in a -1 output state during the backtest. If either output state dominated during the backtest, the rule is said to have a position bias. For example, if more time was spent in long positions, the rule has a long position bias. The second factor is the market's net trend, or the average daily price change of the market during the period of the backtest. If the market's net trend is other than 0, and the rule has a long or short position bias, the rule's performance will be impacted. In other words, the undesirable component of performance will distort backtest results either by adding to or subtracting from the component of performance that is due to the rule's actual predictive power. If, however, the market's net trend is 0, or if the rule has no position bias, then the rule's past profitability will be strictly due to the rule's predictive power plus or minus random variation. This is demonstrated mathematically later. To clarify, imagine a TA rule that has a long position bias, but that we know has no predictive power. The signals of such a rule could be simulated by a roulette wheel. Create the long position bias. A majority of the wheel's slots would be allocated to long positions +1. Suppose that 100 slots are allocated as follows: 75 are +1 and 25 are -1. Each day, over a period of historical data, the wheel is spun to determine if a long or short position is to be held for that day. If the market's average daily change during this period were greater than 0, i.e., net trend upward, the rule would have a positive expected rate of return even though the signals contain no predictive information. The rule's expected rate of return can be computed using the formula used to calculate the expected value of a random variable, discussed later. Just as it is possible for a rule with no predictive power to produce a positive rate of return, it is just as possible for a rule with predictive power to produce a negative rate of return. This can occur if a rule has a position bias that is contrary to the market's trend. The combined effect of the market's trend and the rule's position bias may be sufficient to offset any positive return attributable to the rule's predictive power. From the preceding discussion, it should be clear that the component of performance due to the interaction of position bias with market trend must be eliminated if one is to develop a valid performance benchmark. At first blush, it might seem as if a rule that has a long position bias during a rising market trend is evidence of the rule's predictive power. However, this is not necessarily so. The rule's bullish bias could simply be due to the way its long and short conditions are defined. If the rule's long condition is more easily satisfied than its short condition, all other things being equal, the rule will tend to hold long positions a greater proportion of the time than short positions. Such a rule would receive a performance boost when back-tested over historical data with a rising market trend. Conversely, a rule whose short condition is more easily satisfied than its long condition would be biased toward short positions, and it would get a performance boost if simulated during a downward trending market. The reader may be wondering how the definition of a rule can induce a bias toward either long or short positions. This warrants some explanation. Recall that binary reversal rules, the type tested in this book, are always in either a long or short position. Given this, if a rule's long plus 1 condition is relatively easy to satisfy, then it follows that its short condition minus 1 must be relatively difficult to satisfy. In other words, the condition required for the minus 1 output state is more restrictive, making it likely that over time, the rule will spend more time long than short. It is just as possible to formulate rules where the long condition is more restrictive than the short condition. All other things being equal, such a rule would recommend short positions more frequently than long. It would be contrary to our purpose to allow the assessment of a rule's predictive power to be impacted by the relative strictness or laxity of the way in which its long and short conditions are defined. To illustrate, consider the following rule, which has a highly restrictive short condition and therefore a relatively lax long condition. The rule, which generates positions in the S&P 500 index, is based on the Dow Jones Transportation Average. Assume that a moving average with bands set at plus 3% and minus 3% is applied to the DJTA. The rule is to be short the S&P 500 while the DJTA is below the lower band, by definition a relatively rare condition, and long at all other times. See Figure 1.6. Clearly, such a rule would benefit if the S&P were in an uptrend over the back test period. Now let's consider the back test of two binary reversal rules which are referred to as Rule 1 and Rule 2. They are tested on S&P 500 data over the period January 1, 1976 through December 2004. During this period of approximately 7,000 days, the S&P 500 had an average daily return of plus 0.035% per day compounded, or plus 9.21897% annualized. Assume that Rule 1 was in a long state 90% of the time, and Rule 2 was in a long state 60% of the time. Also, suppose that neither rule has predictive power, as if their output values were determined by a roulette wheel with 100 slots. The output for Rule 1 is based on a roulette wheel with 90 slots assigned a value of plus 1, and the remaining 10 assigned a value of minus 1. Output for Rule 2 is based on a wheel with 60 slots assigned a plus 1 value and 40 a value of minus 1. By the law of large numbers, 11, it is reasonable to expect that over the 7,000 days, Rule 1 will be long very close to 90% of the time, and Rule 2 will be long approximately 60% of the time. Although the rules have different long/short biases, they have equal predictive power, none. However, their expected rates of return will be quite different over this segment of market history. The expected return of a rule depends upon three quantities. 1. The proportion of time the rule spent in long positions. 2. The proportion of time spent in short positions. 1 minus the proportion of time long, and 3. The market's average daily price change during the historical test period. The expected return is given by the following equation. Based on this calculation, the expected return for Rule 1 is 0.028% per day, or 7.31% annualized. The expected return for Rule 2 is 0.007% per day, or 1.78% annualized. This demonstrates that the rule's historical performance misleads us in two ways. First, both rules generate positive returns, yet we know that neither has any predictive power. Second, Rule 1 appears to be superior to Rule 2, even though we know they have equal predictive power, none. When testing actual trading rules, one way to remove the deceptive effect due to the interaction of position bias and market trend would be to do the following. Subtract the expected return of a non-predictive rule with the same position bias as the rule tested from the observed return of the tested rule. For example, assume that we did not know Rules 1 and 2 had no predictive power. Simply by knowing their historical position bias, 90% long for Rule 1 and 60% for Rule 2, and knowing the market's average daily return over the back test period, we would be able to compute the expected returns for rules with no predictive power having these position biases using the equation for the expected return already shown. The expected returns for each rule, and would then be subtracted from each rule's observed performance. Therefore, from Rule 1 back-tested return, which was 7.31%, we would subtract 7.31%, giving a result of 0. The result properly reflects Rule 1 lack of predictive power. From Rule 2 return of 1.78%, we would subtract a value of 1.78%, also giving a value of 0, also revealing its lack of predictive power. The bottom line is this: by adjusting the back-tested observed performance by the expected return of a rule with no predictive power having an equivalent position bias, the deceptive component of performance can be removed. In other words, one can define the benchmark for any rule as the expected return of a non-predictive rule with an equivalent position bias. A simpler solution to benchmarking, detrending the market data, the procedure just described can be quite burdensome when many rules are being tested. It would require that a separate benchmark be computed for each rule based on its particular position bias. Fortunately, there is an easier way. The easier method merely requires that the historical data for the market being traded, e.g., S&P 500 index, be detrended prior to rule testing. It is important to point out that the detrended data is used only for the purpose of calculating daily rule returns. It is not used for signal generation if the time series of the market being traded is also being used as a rule input series. Signals would be generated from actual market data, not detrended. Detrending is a simple transformation, which results in a new market data series whose average daily price change is equal to 0. As pointed out earlier, if the market being traded has a net zero trend during the back test period, a rule's position bias will have no distorting effect on performance. Thus, the expected return of a rule with no predictive power, the benchmark, will be 0 if its returns are computed from detrended market data. Consequently, the expected return of a rule that does have predictive power will be greater than 0 when its returns are computed from detrended data. Perform the detrending transformation. One first determines the average daily price change of the market being traded over the historical test period. This average value is then subtracted from each day's price change. The mathematical equivalence between the two methods discussed, 1 detrending the market data and 2 subtracting a benchmark with an equivalent position bias, may not be immediately obvious. A detailed mathematical proof is given in the appendix, but if you think about it, you will see that if the market's average daily price change during the historical testing period is equal to 0, then rules devoid of predictive power must have an expected return of 0, regardless of their long/short position bias. To illustrate this point, let's return to the formula for computing the expected value of a random variable. You will notice that if the average daily price change of the market being traded is 0, it does not matter what P long or P short are, the expected return will always be 0. For example, if the position biases were 60% long and 40% short, the expected return is 0. If, on the other hand, a rule does have predictive power, its expected return on detrended data will be greater than 0. This positive return reflects the fact that the rule's long and short positions are intelligent rather than random, using logs of daily price ratio instead of percentages. Thus far, the returns for rules and the market being traded have been discussed in percentage terms. This was done for ease of explanation. However, there are problems with computing returns as percentages. These problems can be eliminated by computing daily returns as the logs of daily price ratios, which is defined as the log-based market returns are detrended in exactly the same way as the percentage changes. The log of the daily price ratio for the market being traded is computed for each day over the back test period. The average is found and then this average is deducted from each day. This eliminates any trend in the market data. Other details, the look-ahead bias and trading costs. It is said the devil lives in the details. When it comes to testing rules, this truth applies. There are 2 more items that must be considered to ensure accurate historical testing. They are 1, the look-ahead bias and the related issue, assumed execution prices, and 2, trading costs. Look-ahead bias and assumed execution prices. Look-ahead bias, 14, also known as leakage of future information, occurs in the context of historical testing when information that was not truly available at a given point in time was assumed to be known. In other words, the information that would be required to generate a signal was not truly available at the time the signal was assumed to occur. In many instances, this problem can be subtle. If unrecognized, it can seriously overstate the performance of rule tests. For example, suppose a rule uses the market's closing price or any input series that only becomes known at the time of the close. When this is the case, it would not be legitimate to assume that one could enter or exit a position at the market's closing price. Assuming this would infect the results with look-ahead bias. In fact, the earliest opportunity to enter or exit would be the following day's opening price, assuming daily frequency information. All of the rules tested in Part 2 of this book are based on market data that is known as of the close of each trading day. Therefore, the rule tests assume execution at the opening price on the following day. This means that a rule's daily return for the current day is equal to the rule's output value, plus 1 or minus 1, as of the close of day multiplied by the market's change from the opening price of the next day, open day plus 1, price to the opening price on day after that, open day plus 2. Price change is given as the log of the ratio defined as opening price of day plus 2 divided by the opening price on day plus 1. As shown in the following equation, this equation does not show the detrended version of rule returns. As shown here, look-ahead bias can also infect backtest results when a rule uses an input data series that is reported with a lag, or that is subject to revision. For example, the backtest of a rule that uses mutual fund cash statistics, 15, which is released to the public with a 2-week delay, must take this lag into account by lagging signals to reflect the true availability of the data. None of the rules tested in this book use information reported with a lag or that is subject to revision. Trading costs. Should trading costs be taken into account in rule backtests? If the intent is to use the rule on a standalone basis for trading, the answer is clearly yes. For example, rules that signal reversals frequently will incur higher trading costs than rules that signal less frequently, and this must be taken into account when comparing their performances. Trading costs include broker commissions and slippage. Slippage is due to the bid-ask spread and the amount that the investor's order pushes the market's price up when buying or down when selling. If, however, the purpose of rule testing is to discover signals that contain predictive information, then trading costs can obscure the value of a rule that reverses frequently. Since the intent of the rule studies conducted in this book are aimed at finding rules that have predictive power rather than finding rules that can be used as standalone trading strategies, it was decided not to impose trading costs. Chapter 2. The illusory validity of subjective technical analysis. The difference between a crank and a charlatan is the charlatan knows he is dealing in snake oil, the crank does not. Martin Gardner. The chapter has two purposes. First, it is intended to encourage an attitude of skepticism towards subjective TA, a body of propositions that are untestable because they lack cognitive content. Second, it underscores the need for a rigorous and objective approach to knowledge acquisition, to combat the human tendency to form and maintain strong beliefs in the absence of solid evidence, or even in the face of contradictory evidence. Besides what we take on faith, most of us are under the impression that our beliefs are justified by sound reasoning from good evidence. It can be said that we know something when we have a belief that is true and we hold it because we have drawn a correct inference from the right evidence. We know that ice cream is cold, gravity is real, and some dogs bite on the basis of first-hand experience, but without the time or expertise to acquire all requisite knowledge directly, we willingly accept wisdom from second-hand sources we deem reliable. However we come by it, we do not adopt knowledge willy-nilly, or so we believe. Unfortunately, this belief and many others that we hold are erroneous. Without realizing it, by a process that is as automatic as breathing, we adopt all sorts of beliefs without rational thought or reliable evidence. According to a growing body of research, this is due to a variety of cognitive errors, biases, and illusions. This is a serious liability because once a falsehood is adopted, it tends to persist even when new evidence shows it to be wrong. This longevity is also attributable to various cognitive errors that lead us to defend existing beliefs. A visual illusion is an example of an erroneous belief that persists even after it has been pointed out. In Figure 2.1, line segment A appears longer than segment B, but if you apply a ruler, you will see they are of equal length. However, this knowledge does not undo the illusion. Seeing can be deceiving and the deception lasts. Figure 2.2 depicts another visual illusion. The tabletop on the right appears more elongated. If you compare them, you will see they have the same dimensions. Under normal circumstances, sensory impressions as interpreted by the brain produce accurate beliefs about the world. The selective pressures of evolution assured the development of such a vital capability. However, as well adapted as the eye/brain system is, it is not perfect. Under adverse conditions, conditions outside of those that shaped its evolution, the system can be fooled. Just as there are illusory perceptions, there is illusory knowledge. It seems valid, but it is not, and similar to perceptual illusions, false knowledge tends to occur in situations beyond those that shaped the evolution of our cognitive abilities. Under such adverse conditions, our generally successful learning strategies fail, and we come to know what is not so. Over the last 30 years, cognitive psychologists have discovered that erroneous knowledge is often the result of systematic errors, biases in the way we process information about complex and uncertain situations. Financial market behavior is complex and uncertain, so it should be no surprise that informal, subjective analysis would produce illusory knowledge. A systematic error, unlike a random error, occurs over and over again in similar situations. This is good news because it means the error is predictable and steps can be taken to avoid it. The first step is realizing that such errors are common. Subjective TA is not legitimate knowledge. As defined in Chapter 1, subjective TA is any method of analysis that, because of vagueness, cannot be defined as an algorithm that can be back-tested by computer. Though the subjective domain of TA is comprised of many different methods, they share a faith that valid knowledge about financial markets can be discovered in an informal and non-scientific manner. I contend this faith is misplaced. As discussed in the introduction, subjective TA cannot be called wrong, because to call a method wrong implies it has been tested and contradicted by objective evidence. Subjective TA is immune to empirical challenge because it is untestable. Thus, it is worse than wrong, it is meaningless. Beliefs that cannot be tested must be accepted on faith, anecdotal evidence, or authoritarian pronouncement. In this way, subjective TA is similar to practices such as New Age medicine, astrology, numerology, and a host of other untestable claims, none of which can legitimately be classified as knowledge. However, many TA practitioners and consumers believe strongly in the validity of subjective methods, and if asked, no doubt each would assert that their belief is justified and supported by evidence. I contend this is a consequence of the same cognitive flaws that underlie erroneous beliefs in general and the unscientific manner in which traditional TA is practiced. TA is certainly not the only field to suffer the ill effects of non-scientific methods. Medicine and psychology, where the penalties for faulty wisdom are much greater, are also burdened with erroneous knowledge. This has spawned an emerging movement called evidence-based medicine that appeals to doctors to restrict themselves to practices with proven efficacy. There is a similar movement in psychotherapy. A journal called the Scientific Review of Mental Health Practice describes its mission as ridding the field of unsubstantiated and untested treatments. Unfortunately, it is unlikely that traditional doctors and psychotherapists will abandon their ingrained ways. Old beliefs are hard to change. However, new practitioners may be persuaded, and it is their patients who will benefit from methods with proven efficacy. Although this chapter is a critique of subjective TA, objective TA is also vulnerable to erroneous knowledge. However, it comes about in an entirely different manner. Whereas subjective TA suffers from a lack of quantitative evidence, objective TA suffers from faulty inferences drawn from quantitative evidence. This problem and possible solutions are explored in Chapter 6. A personal anecdote, first a true TA believer, then a skeptic. A book on the necessity of quantitative objective evidence may be a strange place for personal anecdotes. Nevertheless, I offer a first-hand account of my initial conversion to a true believer in TA, my fall from faith, and my rebirth as a scientific skeptic who believes TA can offer value when researched in a disciplined manner. I first learned of TA as a teenager and wanted to believe its claims were true. Making money from chart patterns seemed magical yet plausible. Until that time, my earnings were derived from summers spent tending lawns, digging clams on Long Island's North Shore, and working on a garbage truck at a local resort. Though I've never shied away from physical labor, the idea of making money without sweat had great appeal. Like most TA true believers, my initial convictions came secondhand, reading the revealed wisdom of the field's self-proclaimed authorities. It never occurred to me that their claims might not be grounded in sound research. The very term technical analysis had a scientific ring to it. Later it became clear that in many instances, the authorities were not basing their claims on first-hand research, but merely regurgitating what they had read from even earlier self-proclaimed experts. Humorist and philosopher Artemis Ward has said, "It's not so much the things we don't know that get us into trouble as the things we know that just ain't so." My first read was How I Made $2 Million in the Stock Market by Nicholas Darvas, a professional dancer. He attributed his success to a charting method called the box theory. As my first exposure to TA, the idea that buy and sell signals could be derived from a stock's behavior was entirely novel and exciting. Darvas based his analysis on a staircase-like arrangement of price ranges that he called boxes. Soon I learned this was old wine in a new bottle, the good old-fashioned support and resistance zones of TA. My enthusiasm was undeterred. Next, I studied Chartcraft's point and figure method and began keeping charts on a large stable of stocks. For my 16th birthday, my parents gave me the Bible, Technical Analysis of Stock Trends by Edwards and Maggi, and my conversion was complete. Before long, I was giving stock tips to my chemistry teacher, Mr. Korn. My initial success with a stock called Cubic made several other teachers fans of my mysterious charts. I picked several more winners. No one, not even I, considered the possibility that these early successes might have been nothing more than a run of good luck. There was no reason to. None of the TA books I studied ever discussed the roles of randomness in market behavior or luck in the performance of an investment method. My early scores were plausible because they were consistent with the anecdotes that filled the books, but it did not last. My track record began to blemish and my fans faded. However, my enthusiasm for TA continued to grow because it was always possible to explain away my failures. After the fact, I could always see where I had misread the chart. I'd get it right next time. In high school, I was a good science student, although I now realize I was scientifically illiterate. Later, college courses in the philosophy of science taught me that science is more than a set of facts. First and foremost, it is a method for distinguishing real from illusory knowledge. It would take me the better part of 40 years to see the connection between the philosophy of science and TA. My skepticism grew out of my experience as a proprietary or prop trader for the firm of Spear, Leeds and Kellogg from the fall of 1996 through the spring of 2002. Prop traders have the ultimate fun job. They are given the freedom to speculate with a firm's capital. My trading strategy was based on what I had learned about TA over the prior 35 years. I made profits during the first 3.5 years, October 1996 through February 2000. Because my trading methods were subjective, it is not clear if these gains were the result of my abilities with TA or my ever-bullish bias coinciding with an upward trending market. I suspect it was the latter because an analysis of my monthly returns relative to a market benchmark indicated I was not beating the market but merely matching it. In other words, I had not generated a significantly positive alpha. Also suggestive was the fact that I gave back all my gains in the 2 years after the market trend turned down in March 2000. Over the full 5.5 year period, my results, to put it generously, were lackluster. Prior to joining Spear, Leeds, and Kellogg, I had been a proponent of objective trading methods, so while at Spear, I made efforts to develop a systematic trading program in hopes that it would improve my performance. However, with limited time and development capital, these plans never came to fruition. Thus, I continued to rely on classical bar chart analysis, supplemented with several indicators that I interpreted subjectively. However, I was objective in several ways. Early in my trading career with Spear, I began keeping a detailed journal. Prior to each trade, I would note its TA rationale. In addition, each trade was based on an objectively falsifiable prediction, a defined point of adversity where I would admit the trade was wrong. My managers insisted on this. I maintained the journal daily over the 5+ years of trading. After each transaction was completed, I did a post-mortem analysis. This practice made it hard for me to rationalize my failures. There they were staring me in the face. This accelerated my fall from faith in subjective TA. Because my results were for only one person, I considered the possibility I was not properly implementing the dictates of the TA texts I had been studying for the past 30+ years. Yet, I also began to wonder if what they said was correct, or if what they said was even substantive. When I discussed my growing skepticism with colleagues, their response was that TA was obviously valid. trends and patterns in historical charts were simply too evident to be illusory. A widely used TA text asserts that TA is valid on these grounds. This did not satisfy me. When I learned that the same patterns and trends, to which TA attributes such significance, also appear with regularity in purely random data, my faith in chart analysis was shaken to the core. Moreover, it came to my attention that studies have shown that expert chart readers cannot reliably distinguish actual market charts from charts produced by a random process. Such charts, which are generated by random draws from a sample of actual price changes, are by design devoid of authentic trends and patterns and therefore impossible to predict, but to experienced chartists, they look just like authentic price charts. On this basis, it would seem that predictions based on authentic charts could not be trusted. Clearly, obvious validity is an inadequate standard for judging the validity of market patterns. With inspiration from two books, How We Know What Isn't So by Thomas Gilovich, and Why People Believe Weird Things by Michael Shermer, I came to the realization that TA must be approached with the skepticism and rigor of the scientific method. The mind, a natural pattern finder. We are predisposed to look for and find predictive patterns. Human nature is repulsed by the unpredictable and the unexplained, so our cognitive machinery tends to perceive order, pattern, and meaning in the sensory stimuli we receive from the world regardless of whether it truly is ordered, patterned, or meaningful. In many instances, what we experience is nothing more than the vagaries of chance at work. The appearance of a face on the surface of the moon, the perception of satanic messages when rock music is played backwards, or seeing the face of Jesus in the wood grain of a hospital door are examples of the mind imposing order on random visual sensory stimuli. The tendency to perceive order evolved because this ability was crucial for our survival. The early humans who were best at it produced the most offspring, and we are descended from them. Unfortunately, evolution did not endow us with an equal ability to distinguish valid from invalid patterns. As a consequence, along with the valid knowledge came many falsehoods. Acquiring knowledge, whether in prehistoric times or today, can fail in two ways: learning a falsehood or failing to learn a truth. Of these two mistakes, we seem to be more prone to adopting falsehoods than we are to overlooking vital truths. Evolutionary biologists speculate that the acquisition of false ideas was less detrimental to the survival of early humans than failing to learn something vital. The belief that a ritual dance prior to a hunt would promote success is a learned falsehood with minimal cost, a little wasted dancing. But the failure to learn the importance of standing downwind of an animal during a hunt was an error with a significant survival cost. As a result, our brains evolved to have a voracious, although indiscriminate, appetite for predictive patterns and causal relations. The false beliefs that accumulated along the way were a price worth paying. Sometimes, a successful hunt did follow a ritual dance, so the superstitious practice was reinforced. Also, performing a ritual reduced anxiety by giving an illusory sense of control over outcomes that were largely a matter of chance. Modern civilized life has changed this picture considerably. Not only are decisions more complex today, but the costs of learned falsehoods are greater. Consider the debate on global warming. Are rising temperatures indicative of a real long-term danger, or are they a false alarm? If those convinced that it is a false alarm are later proven wrong, future generations will pay dearly. However, the cost of treating global warming as a serious threat would be more modest if that view turns out to be mistaken. The evolution of human intelligence has been a slow process. Our intellectual capacities developed over a several million-year period, most of which took place under conditions referred to as the ancestral environment of adaptation. In this environment, the mandates were few and clear: survive and reproduce. Human intellectual capacities and thinking strategies were adapted for those conditions, not for the complexities of modern civilization, which date back a mere 10 to 15,000 years. In other words, 99% of human evolution took place in an environment dramatically less complex than the one we face today. It is not surprising, then, that our intelligence would be maladapted to the complex judgment and decision-making tasks we face today. We seem to be as superstitious today as the cave dweller who believed in ritual dances. The epidemic of weird beliefs. A voracious but indiscriminate appetite for knowledge inevitably leads to weird beliefs. Our susceptibility to the adoption of false beliefs was evidenced dramatically in a 1990 Gallup survey of 1,236 adult Americans. The proportion of people believing in all manner of nonsense, including the paranormal, is frightening. These are statistics presented by Shermer. Astrology 52%, extrasensory perception 46%, which is 19%, aliens from space landing on Earth 22%, a previously existing continent called Atlantis 33%, humans and dinosaurs living at the same time 41%, communicating with the spirits of the dead 42%, ghosts 35%, personal psychic experiences 67%. Astronomer Carl Sagan lamented that more people believe in astrology than the theory of evolution. He attributed this widespread irrationality and superstition to a high rate of scientific illiteracy, which surveys estimate to be over 95%. In such an atmosphere, pseudoscience thrives. Strange beliefs, such as New Age health practices, are supported in ways that purport to be scientific but really are not. The evidence offered is insufficient, and facts that point in other directions are given short shrift. However, the ideas they offer survive and thrive because they speak to powerful emotional needs that science often leaves unfulfilled. As Sagan said, it's no fun to be skeptical. It is a burdensome attitude that leaves our need to believe in fun and comforting ideas, like the tooth fairy and Santa Claus, unsatisfied. Cognitive psychology, heuristics, biases, and illusions. Cognitive psychology is concerned with how we process information, draw conclusions, and make decisions. It studies the mental processes by which sensory input is transformed, reduced, elaborated, stored, and recovered. Over the last 30 years, cognitive psychologies have been investigating the origins of unreliable knowledge. The good news is that common sense and intuitive interpretations of experience are mostly correct. The bad news is that human intelligence is maladapted to making accurate judgments in situations characterized by uncertainty. Under conditions of uncertainty, intuitive judgments and informally acquired knowledge are often wrong. Because financial market behavior is highly uncertain, erroneous knowledge in this domain is to be expected. The pioneering research of Daniel Kahneman, Paul Slovic, and Amos Tversky showed that illusory knowledge originates in two ways. First, people are plagued by various cognitive biases and illusions that distort what we experience and how we learn from that experience. Second, to compensate for the mind's limited abilities to process information, human intelligence has evolved various mental shortcuts called judgment heuristics. These rules of thought, which operate quite automatically beneath our conscious awareness, are the basis of our intuitive judgments and probability assessments. They are a mark of human intelligence crucial to everyday living. Though these quick and dirty rules of thinking are generally successful, in certain kinds of situation, they cause us to make biased decisions and acquire erroneous knowledge. Erroneous knowledge is especially problematic because of its resilience. Studies have shown that once a belief has been adopted, it can survive the assault of new evidence contradicting it, or even a complete discrediting of the original evidence that led to the belief's formation. The sections that follow will discuss a variety of cognitive errors responsible for erroneous knowledge. For purposes of presentation, each will be discussed separately. In actuality, however, they operate conjointly, feeding into and off one another, creating an illusion of validity for subjective TA. This is illustrated in Figure 2.3. Human information processing limitations. Despite its awesome power, the information processing capabilities of the human brain are limited. Nobel laureate Herbert Simon called this the principle of bounded rationality. The capacity of the human mind for formulating and solving complex problems is very small compared with size of the problems whose solution is required. Consequently, we attend to only a small fraction of the torrent of information the world presents and process it in simplistic ways. The number of separate chunks of information that can be held in conscious memory at a given time is estimated to be 7, plus or minus 2. Even more limited is the mind's ability to handle problems requiring configural thinking. A configural thinking problem requires that a multitude of factors, variables, be considered simultaneously as an inseparable configuration. Research indicates that the mind is only able to handle a maximum of 3 factors when they must be evaluated in a configural fashion. Medical diagnosis is typically a configural thinking problem. A set of symptoms and lab results, if considered conjointly, can distinguish one disease from another, but taken in isolation, they may be nothing more than a set of disconnected, uninformative facts. Configural thinking is a more demanding mode of thought than sequential or linear thinking. In a sequential/linear problem, the relevant variables can be analyzed independently, so even though there may be a multitude of variables, the message conveyed by each variable is unaffected by what others' variables are saying. Therefore, once each variable has been interpreted on its own, the set of individual messages can be combined in a linear fashion, i.e., added algebraically to derive their collective meaning. Suppose, for example, that a sequential problem involves 7 variables, each of which can assume a value of either +1 or -1. Further, assume that 5 of the variables have the value +1 and 2 have the value -1. The linear or additive combination would be equal to +3 or. Research has shown that, when experts make multifactored decisions in a subjective fashion, they primarily rely on a linear combining rule, though they do it less effectively than formal linear regression models. These studies have shown that human experts are less effective than linear regression models, because they fail to combine the information in the consistent manner of a formal mathematical model. The combining of information in a linear fashion that satisfies the requirements of a sequential thinking problem falls short when the problem demands a configural solution. In a configural problem, the relevant information is contained in the web of relationships interactions between the variables. This means that the variables cannot be evaluated in isolation as they can in a sequential/linear problem. To clarify what is meant by interactions, imagine a configural problem involving only 3 variables, A, B, and C. Further, suppose that each variable can assume only 2 readings, high or low, i.e., the variables are binary. In a configural problem, a high reading on factor A may mean one thing when B is low and C is high, whereas a high reading on A can mean something entirely different when B is high and C is low. In a sequential/linear problem, a high reading on factor A carries the same message irrespective of the readings on B and C. The difference between the two configurations, Configuration 1, A high, B low, C high, and Configuration 2, A high, B high, C low, are illustrated in the figures 2.4 and 2.5. The 8 cells of the 3-dimensional space show that there are 8 distinctly different possible configurations of 3 binary variables. However, a linear combination of 3 binary variables can only assume 4 distinct values. The type of thinking problem faced by a subjective market analyst attempting to make a forecast by combining the readings on 5 indicators variables, a relatively modest number, is likely to be configural rather than sequential. Simply determining which of the 5 indicators should be combined, some may be redundant or irrelevant to produce an informative prediction, is a huge configural problem in itself. With only 5 indicators, the predictive power of 26 possible combinations must be evaluated 10 pairs, 10 triplets, 5 quadruplets, and 1 quintuplet. Then, once a good combination has been identified, applying the multi-indicator rule would also entail configural thinking. As seen earlier, even if the indicators are binary, the simplest possible, 3 binary variables can have 8 distinct configurations. 4 binaries have 16 possible distinct configurations and 5 binary variables have 32. Subjective analysts who believe they can perform such a feat are too confident, way too confident. This is not surprising. It is merely one example of the overconfidence bias. Too dang certain, the overconfidence bias. In general, people are too confident. The overconfidence bias is the documented 29 tendency for people's self-assessments to err on the high side of the truth. They tend to view their personal attributes and abilities as better than objective evidence would indicate. People view themselves as above average in many ways, including how much they know and how accurately they know it. In other words, people tend to be arrogant about their knowledge. The tendency is so pervasive that psychologists think overconfidence is inborn, and they are quite confident about that. Biologists have speculated that high confidence is a feature of successful mating strategies, so we are most likely the offspring of swaggering parents. High confidence confers benefits on humanity as a whole, even if the daring individual trying something new and dangerous dies. After enough attempts, someone succeeds and we all benefit. In addition, overconfidence is reinforced by yet other cognitive biases that distort what is learned from experience, including the self-attribution bias, the confirmation bias, and the hindsight bias, which are discussed later. Columbia University psychologist Janet Metcalf summed up research on human overconfidence with these humbling words: "People think they will be able to solve problems when they won't. They are highly confident that they are on the verge of producing the correct answer when they are, in fact, about to produce a mistake. They think they have solved problems when they haven't. They think they know answers to information questions when they don't. They have the answer on the tip of their tongue when there is no answer. They think they produced the correct answer when they didn't, and furthermore, they say they knew it all along. They believe they have mastered learning material when they haven't. They think they have understood, even though demonstrably they are still in the dark." Some specific findings about overconfidence. Overconfidence is most extreme for difficult or impossible tasks. Studies have shown extreme overconfidence in tasks such as predicting the outcome of horse races, distinguishing European from American handwriting, and predicting rising versus falling stock prices. In the domain of TA, the analogous task would be that of combining a multitude of indicator readings into a market forecast by subjective configural reasoning. Overconfidence is related to an inability to properly assess the difficulty of various tasks and is more pronounced the more difficult the task. TA analysts may not be aware of the configural reasoning demanded by subjective data analysis. Confidence increases as the number of pieces of information are increased, though prediction accuracy does not. Increased confidence would only be justified if the individual bits of information were non-redundant, were useful, and could be successfully integrated. Confidence increases as the level of agreement among multiple inputs increases. When inputs are independent, uncorrelated, and have predictive information, increased confidence may be justified. When inputs are redundant, it is not. Many TA indicators that appear to be distinct because of naming conventions and specific calculations actually measure similar market attributes. This can encourage unwarranted confidence. Doctors who were 88% confident they had correctly diagnosed pneumonia were correct in only 20% of the cases. Physicians were similarly overconfident in diagnosing skull fractures. Many other professionals were overconfident about their specific areas of expertise. For example, when managers of a chemical company were 90% confident about company facts, i.e., they expected to be wrong only 10% of the time, they were right only 50% of the time. Executives of a computer company were 95% confident about general business facts, but were correct 80% of the time. With respect to specifics about their own company, they were 95% confident, but correct only 58% of the time. The overconfidence of Wall Street's analysts with respect to their ability to forecast quarterly earnings is attested to by the frequency of earnings surprises. According to one study, average forecast error was 44%. This statistic was based on over 500,000 individual earnings predictions. People are surprised when outcomes fall outside of predicted ranges, and setting ranges too narrowly is a sign of overconfidence. Individual investors are overconfident in their ability to predict short-term market trends and pick stocks that will do better than the market, as evidenced by the level of their trading activity. Wall Street strategists exhibit overconfidence in the forecasts for the general stock market and are frequently surprised by actual outcomes. However, they maintain their confidence in spite of these mistakes. If strategists were indeed learning to curb their confidence, they would make subsequent predictions with wider bands of uncertainty, and outcomes would be less likely to fall outside of those bands. They do not appear to do this. Given the pervasiveness of overconfidence, it is likely that practitioners of subjective TA would be afflicted with it as well. It seems likely that their overconfidence would manifest with respect to three areas. 1. The predictive power of specific methods. 2. The efficacy of subjective data analysis and informal inference as a means of knowledge discovery. And 3, the ability to perform configural reasoning, as in synthesizing a market forecast from a multitude of indicator reading and patterns. Both the complexity of the financial markets and the known limits of unaided human intelligence suggest that high confidence with respect to any of these areas is unwarranted. According to one study, there are 2 forecasting professions that have managed to avoid overconfidence: meteorologists and horse race handicappers. Their estimates of their predictive abilities are well calibrated because they face similar problems every day. They make explicit, falsifiable, probabilistic predictions, and they obtain swift and precise feedback on outcomes. When these conditions are not satisfied, overconfidence should be expected for both experts and non-experts. It is impossible for subjective TA practitioners to obtain accurate feedback in the context of historical research simply because their methods for generating forecasts and evaluating forecast accuracy are not well defined. Feedback is only possible with objective methods. However, in the context of real-time forecasting, subjective practitioners could obtain feedback if they were willing to make falsifiable forecasts. A falsifiable forecast is one that has cognitive content. That is to say, it sets up a clearly discernible difference between the outcomes that would indicate the forecast had been correct and outcomes that would indicate the forecast has been in error. Consider the following as an example of a falsifiable forecast. The S&P 500 will be higher 12 months from today and will not decline more than 20% from current levels within that time. If the market is not higher 12 months hence, or if it drops more than 20% from the current level within the next 12 months, it is clear that the forecast was in error. Unfortunately, falsifiable forecasts are rarely given by subjective practitioners, thereby preventing feedback for them and their customers. Overconfidence persists. It's going to be great. Optimism bias. The optimism basis is overconfidence that extends to a generalized and unwarranted hopefulness about the future. As a consequence, most people think their lives will be sprinkled with more favorable and fewer unfavorable events than the lives of their peers. The optimism bias suggests that TA analysts' beliefs about their predictive prowess will persist even if their prior predictions have not worked out well. This is borne out by data provided by the Hulbert Digest, a newsletter that tracks the performance of market forecasters by translating their recommendations into a portfolio whose value can be tracked. Some newsletter writers have attempted to explain away their poor performance ratings by claiming that Hulbert's evaluation methods are flawed. According to Hulbert, these claims are leveled primarily at the assumptions he is required to make to turn a newsletter's vague recommendations into specific recommendations whose performance can be measured. Many newsletters tracked by Hulbert give clear advice, making such assumptions unnecessary. Despite their dismal long-term performance, newsletter writers continue to make confident predictions, and subscribers continue to believe they will be helpful. Both groups are optimistically biased. If subscribers were realistic, they would cancel their subscriptions and the writers could not continue in business. Obviously, something other than predictive success keeps faith alive. One possible explanation is that both subscribers and newsletter authors have bought into a story that explains why the underlying method should work, even if it does not work in practice. As is explained later, a compelling story can overcome statistical evidence because the mind has evolved a greater taste for stories than abstract facts. See the second-hand information bias and the power of narratives. Self-attribution bias, rationalizing failure. The tendency toward overconfidence is amplified by other biases that distort what we learn from experience. The self-attribution bias refers to the tendency to interpret past successes and failure in a biased and self-serving manner. Numerous studies across a wide range of situations have found that people attribute positive outcomes to their abilities while attributing failures to external circumstances. As a result, we come away with a falsely optimistic assessment of our strategies and abilities. Whereas the feedback of past failures might motivate change and improved performance, self-serving interpretations short-circuit such learning. This may explain how newsletter writers can maintain confidence in the face of performance that, by any objective standard, would be regarded as negative. In addition to making us feel good, self-serving explanations make intuitive sense. When we exert ourselves and succeed, The causal chain linking effort to a good outcome is easy to understand and has the ring of truth. Attributing success to good luck or some other factor not under our control not only has less emotional appeal, it also seems less plausible. We all prefer the plausible. However, a failure despite our best efforts seems more likely to be attributable to bad luck. Common sense tends to overlook the role of luck randomness in favorable outcomes. That's the job of the statistician. Studies of the self-attribution bias among gamblers are revealing. By evaluating past losses in a biased manner, they are able to maintain a faith in their abilities in the face of growing losses. Surprisingly, past losses are not ignored. Actually, the gamblers devote a great deal of cognitive energy to failures, thereby recasting them in a more favorable light. Losses are treated as near wins or attributed to bad luck. Wins, on the other hand, are credited to genuine betting skill. In the end, both wins and losses wind up feeding the gambler's sense of competence. As a trader, I frequently heard self-serving rationalizations. I was guilty of it myself until I started keeping a trading log early in my trading career with predefined exit points, where I was forced to admit my earlier forecast was in error. Even though my forecasts were based on subjective TA, my evaluation criteria were objectively defined in advance. I did not start to question my abilities until a considerable amount of negative feedback jarred my faith. Sure, I know that, the knowledge illusion. The knowledge illusion is a false confidence in what we know, both in terms of quantity and quality. It is based on the false premise that more information should translate into more knowledge. When horse race handicappers were given more items of information, they grew more confident in their forecasts, but their actual accuracy did not improve. The additional facts created the illusion of more knowledge. The knowledge illusion is relevant to TA because it is most likely to occur in situations characterized by large amounts of data. Not only do financial markets generate a torrent of individual time series, but each one can be transformed into a far greater number of derivative time series called technical indicators. This provides ample opportunity for TA practitioners to see themselves as more knowledgeable than they really are. The knowledge illusion stems in part from an overconfidence in the mind's ability to perform configural reasoning, the simultaneous interpretation of a multitude of variables. In fact, the unaided mind is able to deal with only 2 or 3 variables in a configural fashion. See Part 2. By failing to appreciate these limits, people easily assume that considering more variables indicators will lead to greater knowledge and a more informed opinion. I can handle that, the illusion of control. The illusion of control is an unwarranted belief in our ability to control outcomes. People who feel in control are happier and more relaxed than people who do not. This cognitive distortion is fed by the self-attribution bias, and it in turn feeds the over-optimism bias. According to Knopfsinger, activities that are most likely to induce the illusion of control have the 5 following characteristics. 1. A high level of personal involvement. 2. A large range of choice. 3. A great amount of information available to consider knowledge illusion. 4. A high level of familiarity with the task. 5. Early success in the activity. The first 4 clearly apply to subjective TA. A high level of personal involvement is engendered by the frequent analysis of market data, the creation of new indicators and new ways to interpret them, the drawing and redrawing of trend lines, the counting and then recounting of Elliott waves, and so forth. There is also a large degree of choice, which markets to follow, which indicators to use, where to place a trend line, and so on. The various methods used become familiar as they are studied and used regularly. The 5th factor, early success, is a matter of chance. Some will experience initial success, and because of the self-attribution bias, are likely to attribute it to their expertise and the efficacy of the TA methods rather than chance. All of these factors can induce and maintain an unjustified sense of control and an ability to earn market-beating returns. Hindsight bias. I knew things would turn out that way. The hindsight bias creates the illusion that the prediction of an uncertain event is easier than it really is when the event is viewed in retrospect, after its outcome is known. Once we learn the upshot of an uncertain situation, such as which team won a football game or in which direction prices moved, subsequent to a TA pattern, we tend to forget how uncertain we really were prior to knowing the outcome. See Figure 2.6. This cognitive distortion can be understood in terms of the way memories are stored in the brain. Past events are stored in categories of similar events, e.g., sports events, rather than as a sequential temporal record. For this reason, similar types of events that occurred at different times become intermixed. As a result, after the outcome of a football game becomes known, the pre-game state of knowledge uncertainty becomes intermixed with definitive post-game knowledge. Our state of knowledge prior to the game was uncertain because of the ambiguous nature of the pre-game evidence. One could have made the case for either team winning. The intermixing of pre-game knowledge with post-game knowledge happens immediately and unconsciously, leaving us unable to recall what we knew before the game or our state of doubt. Consequently, the pre-game evidence, which was in fact quite uncertain, seems less uncertain after the winner became known. This creates a false sense of confidence in our ability to make predictions. It is because of this very pitfall that scientists are especially careful about defining procedures for making predictions and evaluating their accuracy. Subjective TA is especially prone to the hindsight bias because it lacks clearly defined rules for pattern identification, forecast generation, and prediction evaluation. In real time, the practitioner of subjective TA faces a task of overwhelming ambiguity. A single chart contains a mind-boggling number of possible predictive cues that range from the extremely bearish to the extremely bullish. However, when the same chart is viewed in retrospect, the ambiguities that had faced the analyst trying to make a prediction fade away because outcomes are known. This creates a false credibility for subjective chart analysis. Let's consider a hypothetical example illustrating how outcome knowledge might minimize the true ambiguities in a chart, thus overstating the predictive power of subjective chart analysis. Consider figure 2.7 and what was knowable as of time A. The pattern could be interpreted as bullish, a prior uptrend with a bullish flag consolidation temporarily interrupting the uptrend. Or the same chart could be interpreted as bearish, a head and shoulder pattern with a neckline breach and then a return rally providing an ideal time for a short sale. This interpretation is illustrated in figure 2.8. Note that both charts are identical up to point A, except for the price swings that have been highlighted and the forecast made based on the pattern. In reality, at point of the chart is an ambiguous mixture of technical features that could support either a bullish or bearish forecast. The true uncertainty, which is depicted in figure 2.9, explains why chartists shown the same history will often express a variety of predictions. Now let's alter the situation by imagining how chartists might look at the same chart at a later time, point B. We will look at two different outcomes paths subsequent to point A. This is intended to illustrate how the hindsight bias can obscure the ambiguity that existed at time A, thereby creating an illusion of validity for subjective chart analysis, irrespective of which path prices actually took. First, consider an analyst's impression looking at the chart for the first time at time B in figure 2.10. This is the same chart shown previously with an uptrend tacked on after point A. This observer knows an uptrend took place between A and B. It is my contention that the hindsight bias would encourage the subjective analysts to notice the bullish flag pattern rather than the bearish head and shoulder pattern. In other words, the possession of outcome knowledge tends to make patterns that gave incorrect predictions less noticeable, while making patterns that predicted accurately more noticeable. What was in fact an ambiguous pattern to an observer only possessing knowledge up to point A appears as an obviously bullish bull flag to an observer looking back from point B. Similarly, the outcome knowledge possessed by the observer at point B renders the bearish head and shoulders pattern less noticeable. The observer at point B comes away with the impression that the evidence on the chart supports the validity of chart analysis. Alternatively, if the price path from time A to time B had been a downtrend, as depicted in figure 2.11, I contend that the hindsight bias would cause an observer at point B to notice a head and shoulders top pattern that predicted successfully, but the observer would not notice the bullish flag whose forecast proved erroneous. These illustrations were contrived to make a point. Whatever the outcome, it is always possible to selectively notice chart features that seemingly predicted correctly, amongst what is truly an ambiguous mixture of bullish and bearish cues. The vague manner in which subjective chart patterns are defined, the lack of objective evaluation criteria, and the operation of the hindsight bias create an illusion of validity for subjective chart analysis. Who among us, upon first learning of the head and shoulder pattern, did not peruse historical charts to find examples of the head and shoulders pattern to see if it worked as claimed? And who among us did not come away with the impression, this stuff actually works? Were we merely victims of the hindsight bias? There is persuasive experimental evidence that people are afflicted with hindsight bias. In one typical study, students were asked to rate the probability of various outcomes in advance of President Nixon's trip to China in 1972. For example, they were asked to predict if a meeting would take place between President Nixon and Chairman Mao Zedong, and if the United States would establish a diplomatic mission in China but not grant the diplomatic recognition that China wanted. Both events were uncertain prior to the trip. 2 weeks after the trip, when the events that did take place were known, the students were asked to recall what they had previously predicted. After a 2-week interval, 67% of the students remembered their predictions as being more accurate than they actually were. In other words, they were unable to recall their prior uncertainty. After several months, the percentage of students afflicted with hindsight bias jumped from 67% to 84%. The hindsight bias has been found to operate powerfully in trial testimony. Witnesses believe they are giving accurate accounts, but their recall of the order of events and of specific details are altered by knowing how matters actually turned out. The hindsight bias infects historical accounts. Historians, having the benefit of hindsight, will often point out that the rise of the Third Reich was quite predictable. They claim that the seeds of Nazism were obvious in various writings that preceded the Third Reich. In actuality, the rise of the Third Reich was only one of numerous possible interpretations that could have been read into these accounts. The outcome, the rise of the Third Reich, which seems so inevitable to the historians when looked at in retrospect, was merely one among an infinite number of possible paths that history could have taken. Other experimental evidence shows that strategies aimed specifically at reducing the hindsight bias are not effective. Even when people are warned about hindsight bias and told to avoid it, it still occurs. It appears to be beyond rational control. Not even professional expertise is helpful. In one study, a group of doctors were asked to evaluate the diagnostic errors made by other doctors. The doctors doing the evaluations were armed with the knowledge of the disease that was ultimately confirmed by a pathology report. The evaluators were unable to understand how such errors could have been made by a trained physician. Again, outcome knowledge makes the past appear as if it should have been more predictable than it really was. What cognitive processes are responsible for hindsight bias? Though the matter is not settled, it seems to go beyond a desire to see ourselves as smart and in control. One conjecture that has received some support suggests that it has to do with the way memory works, or better said, fails to work. In simplified terms, the recording of memories by the brain is not a passive process in which events are stored in proper temporal sequence ready for replay in that sequence. Rather, memory involves an active deconstruction of events for storage, and then an active reconstruction of events when they are recalled. As events are experienced, they are sliced and diced and stored by associative categories, rather than by time of occurrence. An encounter with a dog last month at a friend's house in the country is dissected and stored in distinct categories and neural locations. Memories of dogs, memories of friends, and memories of trips to the country, all of which may have occurred at various times in the past. When we attempt to recall the last month's visit to the country, the mind reconstructs the memory by splicing together bits of information stored in these separate associative locations. Psychologists have speculated that our brains evolved this way because it is generally effective and efficient. However, because time of occurrence is not an important feature of the storage system, it becomes difficult to recall the order of events. And it is the order of events, such as when we received a bit of knowledge, that is most critical when we are assessing our predictive abilities. In the process of deconstructing events for storage, new experience gets mixed in with old experience. Just as a drop of ink in a glass of clear water becomes thoroughly and irreversibly intermixed, recently acquired knowledge, such as the outcome of an uncertain event, becomes inextricably intermixed with what was known prior to the outcome. Post-outcome knowledge becomes indistinguishable from pre-outcome knowledge and seems as if it were known all along. This explains why it is so difficult for people to reconstruct prior states of uncertainty. Can subjective TA analysts overcome the hindsight bias? To answer this question, we must consider the analyst in the context of two different tasks. 1. Pattern research, the search for patterns with predictive power in historical data. And 2. Real-time forecasting, applying the patterns in current time to make new predictions. The task of pattern research is exemplified by the early investigations of Charles H. Dow, originator of the Dow theory, or of Ralph N. Elliott, originator of the Elliott wave principle. In the process of formulating their ideas, they informally proposed and tested various hypotheses about which chart patterns had predictive power. The task of making real-time predictions by applying those patterns in current time would be exemplified by Dow theorist Richard Russell applying the Dow theory today, or Robert Pritzker, an Elliott wave expert, making a forecast today. In the context of historical pattern research, I contend that hindsight bias is unavoidable because it is impossible to shield oneself from outcome knowledge. Simply knowing the path that prices took biases the analyst's perception of the predictive power of whatever method is being evaluated. Only objective TA methods offer the opportunity of avoiding hindsight bias because only information known at a given point in time is used to generate signals, and signals are evaluated in an objective manner. In the context of current time forecasting, subjective analysts could protect themselves from hindsight bias if they were willing to make falsifiable forecasts. A forecast is falsifiable if, at the time a forecast is made, the analyst specifies 1. Outcomes that would constitute a forecast error, or 2. The procedure that will be used to evaluate the forecast as well as when the procedure will be employed. For example, the market will be higher 6 months from now, and within that time frame the market will not decline more than 20% from current levels, or the market will advance 20% from current levels before it declines 20% from current levels. A buy signal has been given. Hold long position until a sell signal is given. The first two forecasts specify outcomes that would clearly define a forecast error. For example, if the market were to drop 20% before it advanced 20%, the prediction would be wrong. End of story. The third forecast, a signal, implies a clear procedure for evaluation. Compute the gain or loss from date of the buy until the date of the sell signal. Falsifiable forecasts would provide the analysts and their customers with valuable feedback. Unfortunately, few subjective forecasters do this. Second-hand information bias, the power of a good story. No one has the time, much less the expertise, to obtain all necessary knowledge via direct experience. Therefore, by necessity, most of what we know we learn second-hand from those who purportedly do know. Among the myriad ways knowledge is communicated, the narrative account or story is by far the most popular. Biologist Stephen Jay Gould called humans the storytelling primate. We have been sharing ideas this way for thousands, perhaps millions of years. Consequently, much of what we know, even including how to do arithmetic, is stored in the mind in a narrative format. For this reason, good stories are more powerful persuaders than objective facts. Psychologists speculate that concrete, colorful, and emotionally interesting tales have a powerful impact on our beliefs because such stories call to mind pre-existing mental scripts. Concepts and abstractions simply cannot light up the brain's story networks the way a lively tale can. Philosopher Bertrand Russell said that when we learn things informally, non-scientifically, we are impacted by the emotional interest of the instances, not by their number. It is for this very reason that scientists train themselves to react in exactly the opposite way, that is, to discount dramatic stories and pay attention to objective facts, preferably those that can be reduced to numbers. Not all stories are equally compelling. To command attention, a story must be interesting and understandable yet not bore us with what we already know. We are most captivated by vivid accounts about real people, preferably people we know. Stories that speak to our emotional needs while being entertaining and informative sell the best. A good tale not only enlivens us, but it gains a life of its own as it is told and retold over and over again. The conflict between truth and tale. A conflict exists between our desire for knowledge and our desire that it be delivered in the form of a good story. Humorist H. L. Mencken put it eloquently, "What ails the truth is that it is mainly uncomfortable and often dull. The human mind seeks something more amusing and more caressing." Reality tends to be full of inconsistencies. So an audience must rely on the integrity of the storyteller to tell it like it is rather than how they would like to hear it. Regrettably, even when the primary intent of a second-hand account is the delivery of knowledge, it is often biased to satisfy the audience's appetite for an engaging story. Storytellers know full well that information delivered with too many qualifiers is unappealing. Consequently, inconsistencies and ambiguities are minimized while cohesive aspects are amplified. Although these editorial modifications make the account more digestible, they can rob it of its essential truth. In the end, the audience comes away with an exaggerated impression of the information's clarity and validity. This even occurs when the findings of scientific papers are summarized and communicated. Over numerous retellings, the truth gets left further and further behind. What started out as a result with possible significance may end up being reported as a discovery of high significance. Especially persuasive are accounts that link events with the chain of cause and effect. The perception of causal relationships is a natural cognitive capacity, and causal chains satisfy our need to explain events in the world around us. Studies of jury decisions show that the best causal narratives win in the courtroom. 62. The side offering the story that best ties the evidence into a coherent and credible sequence often carries the day. The problem is that cause-effect explanations that are, in fact, fallacious are hard to detect when they are plausible and appeal to a sense of the ironic. One story that has been making the rounds since the 1950s is as follows. The Ten Commandments contain 297 words. The Declaration of Independence has 300 words. Lincoln's Gettysburg Address has 266 words. But a directive from the government's Office of Price Stabilization to regulate the price of cabbage contains 26,911 words. The truth is the Office of Price Stability never made such a directive. Nevertheless, the tale had such appeal, it remained alive despite the agency's efforts to convince the public it was false. Even the dissolution of the Office of Price Stability did not stop the story. It was merely modified so that the directive was described as a federal directive. The story would not die because of its irony and the plausibility of long-winded bureaucrats. Eliot's tale. The power of a good story may explain the enduring appeal of the Elliott wave principle, UP, one of TA's more grandiose conjectures. The Elliott wave principle holds that price waves express a universal order and form that is found not only in the fluctuations of financial markets but throughout the natural world, including the shapes of seashells, galaxies, pine cones, sunflowers, and numerous other natural phenomena. According to EWP, market trends are fractal, a nested hierarchy of waves sharing the same form but ranging in magnitude and duration from microwaves that last only minutes to grand millennial microwaves that can last for thousands of years. This shared form, called the Elliott wave, is an 8-segment configuration of rising and falling price movements. In fact, this universal pattern of growth and decay is alleged to describe not only the evolution of prices in financial markets. It is also manifested in the evolution of trends in mass psychology, the rise and fall of civilizations, cultural fashions, and other social trends. The theory claims to describe just about anything that goes through cycles of growth and change. Even the business career of Elliott Wave's leading advocate Robert Pritzker, according to Pritzker himself, has followed a series of ups and downs that conform to the Elliott wave principle. This all ties in with a sequence of numbers called the Fibonacci series and the golden ratio phi, which does have many fascinating mathematical properties. However, that which purports to explain everything explains nothing. The Elliott wave principle, as popularly practiced, is not a legitimate theory but a story, and a compelling one that is eloquently told by Robert Pritzker. The account is especially persuasive because EWP has the seemingly remarkable ability to fit any segment of market history down to its most minute fluctuations. I contend this is made possible by the method's loosely defined rules and the ability to postulate a large number of nested waves of varying magnitude. This gives the Elliott analyst the same freedom and flexibility that allowed pre-Copernican astronomers to explain all observed planet movements, even though their underlying theory of an Earth-centered universe was wrong. The analogy between the medieval astronomer fitting epicycle upon epicycle to their data and EWP analysts fitting wave within nested wave to market data is strong. Thus, even if the fundamental notion of EWP is wrong, the method of analysis will still be able to obtain a very good fit to past data. In fact, any sufficiently flexible model can fit a prior set of observations with perfection. For example, a polynomial function with a sufficient number of terms, equal in number to the number of data points, can also produce a perfect retrofit. However, a model or method with an unlimited ability to fit past observations, but which cannot make testable, falsifiable predictions of future observations, is neither meaningful nor useful. Though the Elliott wave principle is said to hold even the heavens, where galaxies conform to the logarithmic spiral, its performance here on Earth has been less than stellar. What then explains its enduring appeal? I contend that it is attributable to the fact that EWP is a comprehensive cause-effect story that promises to decipher the market's past and divine its future better than any other TA method. Some stories are too good to let die. Stories shaped by self-interest. Self-interest can motivate distortion in second-hand accounts. People with an ideological or theoretical position tend to selectively sharpen some aspects of a story and minimize others, to bring it into better alignment with their point of view. Purveyors of specific TA methods, or of TA in general, have clear ideological and financial interests at stake. This charge can be leveled at me, 71, or any author arguing a position. However, when the storyteller is constrained by objective evidence and repeatable procedures, there is less leeway for the distorting effects of self-interest to operate. Confirmation bias, how existing beliefs filter experience and survive contradicting evidence. Once a belief forms, we filter information in ways that sustain it. The confirmation bias is the tendency to view as credible new evidence that confirms our prior beliefs, but to view as incredible evidence that contradicts them. This tendency inhibits learning from new experience and stifles the elimination of incorrect ideas. The confirmation bias explains why we get stuck with erroneous beliefs. The confirmation bias has a rational basis. In many instances, it is rational to give weight and preference to evidence that supports an existing belief and to view with skepticism that which contradicts it. Beliefs would be highly unstable without such a rule. The use of prior knowledge as an interpretive filter is a mark of human intelligence, so long as the prior knowledge is well supported. Scientists were justifiably skeptical of a claim that nuclear fusion had been achieved at room temperatures in an apparatus constructed from parts available at the local hardware store. Their doubts were subsequently borne out by objective tests that were unable to reproduce the so-called cold fusion effect. Few of us would accept at face value the supermarket tabloid headline, "Elvis returns on UFO and will build an alien theme park." However, when prior beliefs are unjustified because they lack the support of sound inferences from solid evidence, it is not rational to grant them the status of intellectual gatekeeper. The problem is that people are often not aware of which of their held beliefs are unjustified. Consequently, the confirmation bias operates even when it should not. Biased perception. The confirmation bias is a consequence of the way perception works. Beliefs shape expectations, which in turn shape perceptions, which then shape conclusions. Thus we see what we expect to see and conclude what we expect to conclude. As Henry David Thoreau put it, we hear and apprehend only what we already half know. The truism, "I'll believe it when I see it," might be better stated, "I'll see it when I believe it." The potent effect of expectations on perception was demonstrated in the following experiment. When subjects were given a drink that they thought contained alcohol, but in fact did not, they experienced reduced social anxiety. However, other subjects who were told they were being given non-alcoholic beverages when they were, in fact, alcoholic did not experience reduced anxiety in social situations. Not only do we fail to perceive new information that is in conflict with prior beliefs, we are also reluctant to draw conclusions that are at odds with what we already believe to be so. As a result, we tend to accept at face value information that is consistent with pre-existing thinking, while we critically scrutinize and discount information that is inconsistent with prior beliefs. The confirmation bias explains why our beliefs fail to change in response to new information as much as they should. It gets worse. The confirmation bias, operating in conjunction with the laws of chance, predicts that erroneous beliefs will strengthen with time and familiarity. A TA method with no predictive power, e.g., a signal based on a coin flip, will enjoy occasional success due to chance. Over time, these confirming instances will accumulate, and because of the confirmation bias, will be given greater weight than instances where the method fails. The result is a vicious cycle of growing self-deception. This suggests that the belief in a flawed method's efficacy will increase over time irrespective of its actual merit. It also implies that TA practitioners most experienced with a useless method will be the least able to recognize its flaws because of more lengthy exposure to the method's chance-based successes. Motivational factors. The confirmation bias is also driven by motivational factors. TA practitioners have a large emotional and financial investment in their favored method. This is especially true of practitioners whose professional lives are tied to a particular method. There is also a strong motive to maintain consistency within our system beliefs and attitudes. The theory of cognitive dissonance formulated by Festinger contends that people are motivated to reduce or avoid psychological inconsistencies. The discomfort provoked by evidence that contradicts what we believe makes it hard to digest such evidence. Biased questions and search. The confirmation bias also slants the way questions are framed, thereby biasing the search for new evidence. This search bias increases the chance of encountering new evidence that supports the prior belief, while reducing the possibility of encountering non-confirming or contradictory facts. This occurs in the context of subjective TA research. By definition, it is confined to the search for supportive anecdotal examples. Contradictory examples are difficult, if not impossible, to find because subjectively defined patterns do not specify the conditions of a prediction error. People trained in the scientific method do two things to combat this tendency. First, at the inception of a test, they establish objective criteria for evaluating outcomes. Second, they actively pursue evidence that might contradict prior beliefs and assumptions. Scientists are guided by the notion that ideas that can survive a vigorous search for contradictory evidence have greater validity than ideas that are merely backed by confirmatory evidence discovered by a search directed at exactly that. The confirmation bias can occur in the context of objective TA as well. Consider an analyst searching for profitable rules with backtesting. If the first rule that is tested gives unsatisfactory performance, the search for a rule with good performance continues. This involves testing a sequence of rules with altered parameters, logic, indicators, and so forth until a good one is found. This is data mining. Because the decision about when to end this process is entirely up to the analyst, the scope of the search is unbounded. This guarantees that ultimately a rule with good past performance will be discovered. The researcher's initial belief that a good rule will be found is thus confirmed. In fact, the past performance of a rule discovered by data mining overstates its likely performance in the future. This overstatement is called the data mining bias and is discussed in Chapter 6. This problem is not data mining per se. In fact, when done properly, data mining is a productive research method. The error is the failure to take into account the upward bias caused by data mining. As will be explained in Chapter 6, by taking into account the extent of the search that led to the discovery of the good rule, it is possible to draw sound inferences about the rule's future profit potential. How vague evaluation criteria contribute to the confirmation bias? Because subjective TA is vague about how its forecasts should be evaluated, evidence of its success and failure is ambiguous. This facilitates the analyst's ability to point to prior predictions that worked confirmation bias, while at the same time preventing the identification of prediction errors. This effectively immunizes subjective practitioners from the negative feedback that might cause them to change their beliefs. Prediction errors of a subjective method can be obscured in a number of ways. One is what I refer to as pattern renaming. An upside breakout pattern that fails is relabeled a successful bull trap. According to TA doctrine, upside breakouts are alleged to predict upward trends. This is illustrated in Figure 2.12. When an uptrend does not materialize, it should be counted as a prediction error. If instead, the pattern is renamed a bull trap, we wind up with a successful signal from a different pattern, as shown in Figure 2.13. Objective pattern definitions and clearly predefined evaluation criteria would prevent such after-the-fact evidence fiddling. Another way prediction errors are obscured is when forecasts lack a clear endpoint. The endpoint of prediction is a future time or event that calls for the prediction to be evaluated. A forecast or signal that does specify or imply a clear endpoint is effectively meaningless. The talking heads of TA typically issue predictions without clear endpoints. I'm bullish for the intermediate term. This vague pronouncement provides the forecaster with enough post-prediction wiggle room to avoid getting nailed with a bad call. Either a defined time period or a specific subsequent event, such as a certain percentage of adverse price movement, prevents the forecaster from engaging in an after-the-fact, free-for-all hunt for any evidence that portrays the forecast in a good light. However, the statement, "I expect the market to advance at least 5% from current levels before it declines 5%, leaves no room for fudging. Objective signaling methods imply a clear endpoint, the subsequent signal to exit the position. The freedom to alter the forecast evaluation criterion after the fact makes it likely that supportive evidence will be found. This is precisely why science has a dual personality. It is flexible and receptive to all testable ideas, yet rigidly orthodox about how testing and evaluation are to be carried out. In fact, much of what scientists do can be understood as the use of strict procedures for determining when an idea is worthless. If people were to use similar procedures in their everyday lives, they would be much less likely to adopt erroneous beliefs. People are highly adept at concocting ideas, theories, and explanations for their experience that have a semblance of plausibility. However, they are not nearly as good at testing those beliefs once they have taken root. One of the biggest reasons is the failure to precisely define which outcomes qualify as supportive evidence and which do not. Without objective evaluation criteria, the opportunity and motivation to find supportive evidence for what we already believe is left unchecked and runs rampant. The confirmation bias and vague evidence. The precise way in which the confirmation bias functions to substantiate prior beliefs depends upon the clarity of the new evidence. When the new evidence is vague, the confirmation bias operates unfettered. Because vague evidence can be interpreted as either contradictory or supportive, it is simply taken as supportive. Subjective TA methods are vague on two counts with respect to how patterns and signals are defined, and with respect to how predictions based on said patterns and signals are to be evaluated. This invites the discovery of evidence that is weakly supportive. Weak evidence is not strong enough to compel the belief that the method works, but because weak evidence is open to interpretation, it can be interpreted as being consistent with a belief that the method works. The hallmark of weak evidence is that it can be interpreted as being consistent with several different points of view. For example, the appearance of a certain portion of a price chart could be consistent with a 5-wave Elliott impulse pattern, or an entirely different subjective pattern or purely random price movement. Objectively defined patterns and evaluation criteria permit no such leeway. Either the data is an example of a particular pattern or it is not. Either the outcome is consistent with the pattern's prediction, or it is not. The confirmation bias and clearly contradictory evidence. Let's now consider how the confirmation bias operates when there is evidence that clearly contradicts a prior belief. In many situations, the evidence is a mixture. Some evidence clearly confirms the belief and some clearly contradicts it. In these situations, the confirmation bias still operates, but in a more complex manner. It might be thought that the dissonant evidence would simply be ignored or twisted into being supportive. But this tends not to happen because people value seeing themselves as rational and cognitively consistent. They are reluctant to simply disregard pertinent evidence that is contradictory in order to see what they expect to see and believe what they expect to believe. However, what they do is to alter the dissonant information in order to reduce its conflict with prior cherished beliefs. In other words, the confirmation bias encourages subtle cognitive manipulations to the clearly dissonant evidence to reduce its importance, and reduce its clash with confirming evidence and cherished belief. One way people discount discordant evidence is by applying a harsher standard of acceptance. The standard applied to evidence that supports a favored position is the gentle requirement that it have a ring of plausibility or the possibility of being valid. In contrast, the standard applied to evidence that conflicts with cherished beliefs is that it must be convincing beyond any possible doubt. For believers in faith healing, a colorful corroborating account is accepted without question. However, a controlled scientific study denying the efficacy of faith healing would be faulted on any and every possible ground, reasonable or otherwise. By demanding that dissonant evidence be so strong that it be compelling beyond any doubt, while only requiring that harmonious evidence be weakly consistent, holders of erroneous beliefs are able to keep their faith alive. One of the most surprising findings about the confirmation bias is that evidence that contradicts a prior belief can actually have the effect of strengthening that belief. One would think that a mixture of pro and con evidence should at least reduce the strength of the prior belief. Studies have shown otherwise. For example, in one experiment, subjects were presented with clear and convincing evidence that was both pro and con capital punishment. The subjects were of two types: those with a prior belief that capital punishment was good, and those with a prior belief that capital punishment was bad. Both groups were given summaries and critiques to two different studies on capital punishment. One study presented evidence showing that capital punishment was an effective deterrent against crime, while the other provided evidence showing it was not effective. The experiment showed that participants perceived the study that was consistent with their prior belief to be valid and important evidence, whereas the study that conflicted with their view was seen as flawed research and weak evidence. After being exposed to evidence on both sides of the issue, participants came away from the experiment with their prior beliefs strengthened. In other words, a mixture of pro and con evidence caused the two groups to become more polarized. It is also informative to consider what subjects in the study did not do. Hostile evidence was neither misconstrued to be favorable nor ignored. Rather, it was scrutinized for flaws, thus reducing its import. In other words, significant cognitive effort was expended to explain away or minimize contradictory evidence. An experiment that is closer to TA examined how the confirmation bias encouraged unsuccessful bettors to maintain their delusions of gambling greatness despite swelling losses. Losing money would seem to be unambiguous evidence of failure, yet bad gamblers remained optimistic. Thomas Jailovich showed they accomplished this by evaluating their wins and losses in a biased manner. As was true for subjects in the study on capital punishment, the gamblers did not forget or ignore discordant evidence losses. Rather, they applied significant cognitive effort to transform their losses into less derogatory evidence. This was displayed in journals kept by the gamblers. It was found that they devoted more commentary to losses than gains, and gains and losses were interpreted differently. Gains were easily attributed to the gambler's betting acumen's self-attribution bias, whereas losses were attributed to bad luck, and with a bit of fine-tuning to the betting system, would have been wins. These findings predict how subjective TA practitioners might react if presented with objective evidence contradicting the validity of a favored method. 91, for example. Suppose a subjective method was to be transformed into an objective method, and tests indicated the method was not effective. It is likely that devotes of the method would find any number of grounds to criticize the study. There is no study in any field of science that cannot be criticized on some grounds. It is also likely that the subjective practitioner would trot out cherry-picked examples showing instances where their method was successful. In the end, it is probable that the practitioners would come away from the exercise more convinced than ever in the value of their method, while muttering about ivory tower academics having their heads stuck in the clouds or somewhere worse. Beyond the confirmation bias, the true believer. We have seen that erroneous beliefs thrive on vagueness and can even grow stronger in the face of evidence that would, at the very least, call for reduced belief. However, belief longevity goes beyond even this. Studies have shown that once a belief takes root, it can even survive a complete discrediting of the evidence that gave rise to the belief in the first place. It has been demonstrated that, when subjects are tricked into forming an erroneous belief, their belief survives even after they are told that they had been tricked. One study is particularly relevant to TA because it involves pattern discrimination. Subjects were asked to distinguish authentic suicide notes from fictitious ones. Initially, experimenters gave the subjects fake feedback, thus deceiving them into believing that they had learned to discriminate authentic suicide notes from fakes. In reality, the subjects had not learned how to perform this task. Later, the experimenters told the subjects of the deceit. Even with such clear discrediting evidence, the subjects continued to believe, to a considerable degree, that they were able to discriminate real from fake suicide notes. Other experiments conducted along similar lines have found the same effect. A belief can survive a total discrediting of its original basis. These findings predict how believers might react if Ralph Elliott, W.D. Gann, or Charles Dow were to return from the grave and announce that their methods had been intentional scams. It is likely that many current-day practitioners would continue to believe. Given that Elliott wave analysis, or at least one version of it, has now been reduced to an objective algorithm, it will be interesting to see the reactions of EWP believers if objective tests fail. Subjective methods most likely to suffer the confirmation bias. Some subjective TA methods are more likely to encourage the confirmation bias than others. These methods will possess three characteristics. 1. An elaborate causal explanation or compelling story about why the method works. 2. High retrofit power, the ability to fit or explain past market behavior accurately. And 3. No ability to generate falsifiable, testable predictions. TA methods fitting this profile include Elliott waves, Hurst cycle theory, astrology-based forecasting, and W.D. Gann analysis, among others. For example, the Elliott wave principle is based on an elaborate causal explanation invoking universal forces that shape not only the physical world but mass psychology, culture, and society as well. Moreover, it has high retrofit power. By employing a large number of nested waves that can vary in both duration and magnitude, it is possible to derive an Elliott wave count, i.e., fit for any prior segment of historical data. However, except for one objective version of Elliott waves, the method does not generate testable/falsifiable predictions. Let's consider the first element, an elaborate causal explanation. TA methods that are based on intricate causal stories are able to withstand empirical challenges because they speak to the deeply felt human need to make sense of the world. Because we are compelled to explain our experience, we have highly developed abilities to generate plausible stories after the fact. To live, it seems, is to explain, to justify, and to find coherence among diverse outcomes, characteristics, and causes. With practice, we have learned to perform these tasks quickly and effectively. Studies in which people are encouraged to form erroneous beliefs, and then requested to construct rationales for those beliefs are more resistant to belief change than subjects who were not asked to formulate explanations. Subjects who developed reasons to explain their beliefs became so stuck in their opinions that, even after they were told that they had been manipulated into adopting a false belief, they continued to believe. In fact, they continued to believe almost as strongly as other subjects who were manipulated to form false beliefs, but were not told of the manipulation. The second and third elements that make a TA method immune to evidentiary challenge is a high capacity to retrofit past market movements combined with an inability to make testable, falsifiable predictions of future movements. The ability to bring all past market movement into conformity with the method has the effect of eliminating any contradictory evidence. When forecast errors do occur, because outcomes are so completely out of whack with forecasts that even subjective evaluation is unable to hide the error, the standard explanation is that the error was caused by a misapplication of the method rather than a flaw in the method itself. This fallacious reasoning is then supported by reapplying the method so it fits the discordant outcome. The ability to always obtain a good retrospective fit combined with the inability to make testable predictions eliminates the possibility that any evidence will ever surface that contradicts the method. In science, the rationale for eliminating an erroneous theory is the fact that its predictions of future observations are shown to conflict with those observations. This is the scientist's signal that the theory needs to be eliminated or reformulated. If the latter, the new version of the theory is then tested against a subsequent set of future observations. This essential mechanism for pruning away false theories is illustrated in Figure 2.14 and is discussed in depth in Chapter 3. The entire motivation for revising or abandoning a TA method, or any theory for that matter, comes from seeing clear examples where its predictions are wrong. If it is easy to make after-the-fact adjustments that eliminate all errors, the rationale to abandon the method is lost. Other research suggests that some people are more prone to the confirmation bias than others. Strangely, they are the most intelligent people. Harvard psychologist David Perkins conducted an interesting study showing that the higher a person's intelligence measured in IQ points, the better they are able to construct articulate rationales for their beliefs and defend them. However, Perkins also found that, because of their strong ability to rationalize existing beliefs, highly intelligent people are less able to consider alternative explanations and points of view. Hence, they are more apt to form beliefs that are resistant to change. Social scientist J. Stuart Snelson calls this ideological immunity. He claims that intelligent and successful adults rarely change their most fundamental presuppositions. This effect is most pronounced in people who have accumulated significant knowledge in a particular area. This suggests that the most intelligent and experienced subjective practitioners will be the least able to abandon a method in which they previously believed. Illusory correlations. The studies discussed up to this point have dealt with people's erroneous beliefs about themselves and their abilities. We now consider studies that examined people's beliefs about the world at large, specifically whether a predictive relationship exists between a pair of variables. These have shown that people have a tendency to perceive illusory correlation. An illusory correlation is the false perception of a relationship between a pair of variables. It is a significant problem for subjective TA practitioners. Subjective TA methods represented as binary variables. A pair of variables is said to be correlated when one, referred to as the predictor, can be used to predict the other, referred to as the outcome or dependent variable. Although subjective TA methods are not usually described in these terms, all such methods can be viewed as asserting the existence of a correlation between a pair of variables. The predictor is a TA pattern or signal such as the head and shoulders top pattern. The outcome is the post-pattern price movement the pattern is purported to predict. A head and shoulders top pattern is supposed to predict a downtrend upon the pattern's completion. In fact, the entire enterprise of TA, both objective and subjective, can be viewed as the search for such correlations. These are then used individually, though more often in combination, to forecast market trends. It can also be said of subjective patterns that both the predictor and the outcome are binary variables. That is to say, they assume only two possible values. With respect to the predictor variable, the pattern or signal is either 1, currently present, or 2, not present. With respect to the outcome variable, the future price movement the pattern or signal is purported to predict, either 1 occurs or 2 does not occur. For example, the head and shoulders top pattern is purported to be correlated with predictive of a post-pattern downtrend. At a given point in time, a head and shoulder top pattern and neckline break signal is either present on the chart, or it is not. Following the signal, the downtrend either occurs or it does not. All subjective patterns and signals can be interpreted within this framework. The central contention of this chapter is that subjective TA knowledge possesses only illusory validity. This section examines a specific illusion of validity, illusory correlation. An illusory correlation is the perception of a correlation between two variables that are not truly related. Why we are prone to illusory correlations. A substantial body of research indicates that people easily fall prey to the illusion of correlation. These illusions seem to result from faulty information processing. The specific fault is paying too much attention to instances that confirm the existence of the correlation, while paying too little attention to cases that either do not confirm the presumed correlations or that outrightly contradict its existence. In TA, confirmatory instances are those cases in which the pattern/signal occurs, and the outcome that the pattern/signal is purported to predict also occurs. For example, the head and shoulders top pattern occurs, and then a downtrend ensues. If you believe in the efficacy of a particular subjective pattern/signal, ask yourself if your belief is not entirely or primarily founded upon having seen instances in which the pattern has been successful, confirmatory examples. Now ask yourself if you are similarly aware of examples where it failed, false positive or false negative signals. However, confirmatory instances constitute only one type out of 4 possible types of outcomes that can occur between a pair of binary variables. The other 3 types are 2, the pattern/signal does occur, but the market trend the pattern is supposed to predict does not occur. 3, the pattern/signal does not occur, but the outcome the pattern is supposed to predict occurs anyway. And 4, the pattern/signal does not occur, and the outcome the pattern/signal purports to predict does not occur either. Types 1 and 4 are correct predictions. Types 2 and 3 are prediction errors. Type 2 is called a false signal or false positive. Type 3 is called a failure to signal or false negative. The allure of the upper left cell. The 4 possible outcomes between a pair of binary variables can be illustrated with a 2x2, 2x2 contingency table, figure 2.15. This common data analysis tool is composed of 4 cells, one for each of the 4 possible outcome types. Into each cell goes a count of the number of instances of that type of outcome occurring within a sample of observations. Such a table would be useful to represent subjective TA patterns and their outcomes were it not for the fact that their subjectivity precludes obtaining the counts. Studies show that people fall prey to illusory correlations because they pay excessive attention to the number of confirmatory instances, those falling into the upper left cell of the table. At the same time, they fail to take proper account of the number of cases falling into the other 3 cells. We make this mistake for 2 reasons. The first has to do with the salience of the confirmatory instances, and the second has to do with a faulty intuitive notion of what constitutes sufficient evidence to conclude that a correlation exists. The salience of evidence refers to how noticeable, vivid, or outstanding it is. Salient evidence is attention-grabbing. Confirmatory examples are salient because they confirm a suspected hypothesis. In other words, they are rewarding. When subjective technicians think they have discovered a useful pattern or signal, they typically will examine historical data to see if their initial supposition was correct. Thus, they are engaged in informal hypothesis testing. In this situation, confirmatory instances, examples in which the pattern occurred and it made a correct prediction, will be highly noticeable because they reward the analyst's initial conjecture. Consider what it might have been like for R.N. Elliott just after formulating his initial hunch that all market movements conform to the same fundamental pattern. A 5-segment impulse wave followed by a 3-segment corrective wave, 5-3 pattern. At that point, his hypothesis had not yet attained the status of a strong belief. It was merely a suspicion. However, once that hypothesis was born in Elliott's mind, it motivated a search for additional confirming cases. In other words, it was Elliott's initial conjecture itself that made confirmatory cases salient. Necessary versus sufficient evidence. Once the confirmatory instances take front stage, a faulty intuition that is quite common enters the picture. This intuition, which is responsible for producing the illusion of a correlation, concerns the amount of evidence that is thought to be sufficient to establish a valid correlation. It is commonly thought that confirmatory evidence by itself is sufficient. This is incorrect. It's not that this intuition is wrong so much as it is incomplete. Intuition correctly tells us that confirmatory instances, events in the upper left cell, are indeed necessary to establish the existence of a correlative relationship. If the head and shoulders pattern, or any pattern or signal for that matter, is a valid predictor, then there ought to be instances in which the pattern occurred and the expected outcome also occurred. However, it is a mistake to assume that a goodly number of confirmatory instances are sufficient to establish a correlative relationship. In other words, although confirmatory instances are necessary, they are not by themselves sufficient to establish the existence of a correlative relationship. In reality, the number of instances falling into all 4 cells of the contingency table must be taken into account to determine if valid correlation exists. It is because we fail to realize that a given belief is not supported by sufficient evidence that it takes on an illusion of validity. Thus, we come to see it not as an opinion or an article of faith, but as a reasonable inference from objective evidence. Numerous studies have shown that, when people rely on informal analysis to determine if there is a relationship between 2 variables, they tend to make 2 kinds of errors. They fail to detect correlations that are, in fact, valid, even when the correlation is relatively strong in visible correlations, and they falsely perceive correlations that are invalid illusory correlations. Both errors are related to the observer's expectations stemming from pre-existing beliefs. First, let's consider what happens when people are shown data for two variables that are in fact related but which are not expected to be correlated. Experiments have shown that they are unable to detect the relationships unless the correlation exceeds approximately 0.70 on a scale of 0 to 1.0, where 1.0 represents a perfect correlation and 0 represents no correlation. A correlation of 0.70 is far stronger than anything likely to be encountered within the domain of TA. This finding suggests that subjective TA analysts relying on informal/intuitive data analysis methods will be prone to missing valid correlations that they do not expect to exist. What is even more relevant to the problem of illusory TA knowledge is the tendency to perceive correlations that do not exist. When observers have a prior belief that a relationship exists between pattern and outcome, or there is a motivation to find one, the confirmation bias, discussed previously, makes it likely that a correlative relationship will be detected even if none exists. It is hard to imagine a TA analyst who is not impacted either by prior belief, motivation, or both. Even if there is no prior belief or no motivation to believe, people still display a pronounced tendency to perceive illusory correlations. Smedslund performed one of the earliest experiments showing this tendency. Nurses were shown 100 cards that were supposed to represent actual patients. Each card indicated if the patient manifested a particular symptom or not, the binary predictor, and whether that patient was ultimately diagnosed with a specific disease, the binary outcome. The nurse's task was to determine if the symptom was truly correlated with the disease. The data shown to the nurses is summarized in the contingency table in Figure 2.16. Over 85% of the nurses said the symptom was correlated with the disease. They were persuaded by the 37 salient confirmatory instances falling in the upper left cell, symptom present and disease present. However, their conclusion was not supported by the data. A proper analysis of this data, which takes all cell counts into consideration, indicates that the symptom is not correlated with the disease. Giving all cells their due. A formal statistical test that considers all cell counts would be the rigorous way to determine if the nurse's data was indicative of a valid correlation. However, one need not even resort to a formal test to see that there is no correlation between the symptom and the disease. All cells can be taken into consideration by computing some simple ratios of the cell counts. For example, the proportion of patients that manifested the symptom and who ultimately proved to have the disease was approximately 0.69. Cella divided by 37/54 equals 0.685. However, the proportion of patients that did not have the symptom that ultimately were diagnosed with the disease was almost the same, or 0.72. Cell C divided by 33/46 equals 0.717. This quick and dirty calculation shows that likelihood of having the disease was about the same, 0.69 and 0.72, regardless of whether the symptom was present. Had the symptom really been correlated with the disease, the two proportions would have been quite different, such as 0.90 of those with the symptom had the disease, whereas only 0.40 of those without the symptom had the disease. This would not necessarily suggest that the symptom was a cause of the disease, but only that it was a valid predictor of it. In light of the fact that even simple ratios showed no correlation between symptom and disease, it is surprising that 85% of the nurses concluded that the symptom was a reliable predictor of the disease. The nurses were presented with other data sets as well. Overall, the factor that best explained whether the nurses perceived a correlation was simply the number of confirmatory instances. Cell A, symptom and disease both occur. Their judgments were unaffected by the relative proportions that went into the calculation done earlier. In other words, the nurses did not pay attention to the number of cases in the other three cells. As previously noted, many psychological studies have supported Smedslund's findings. The statistically correct way to detect a correlation between two binary variables is the chi-square test. The test determines whether the number of instances falling into each cell differs significantly from the number that would be expected in each cell if there were no correlation between the variables. In other words, the test determines if cell counts depart significantly from a random sprinkling of the instances among the 4 cells. When cell counts do depart significantly 115 from a random pattern, the chi-square statistic takes on a large value. This is legitimate evidence of a correlation. In Figure 2.17, the data from the nurse's study have been altered to illustrate how cell counts might appear for a symptom that is correlated with the disease. Each cell also contains the number of instances that would be expected if there were no predictive relation between symptom and disease, the random pattern. For example, in cell B, there were only 7 occurrences of disease with the symptom present a false signal. If the instances conformed to a random pattern, one would expect about 16 false signals. Thus, the relative proportion of disease if symptom is present is 0.87 versus 0.50 when the symptom is not present. The difference in the proportions shows that the symptom is correlated with the disease. The role of asymmetric binary variables in illusory correlation. Illusory correlations are especially likely to emerge when the variables involved are binary variables of a particular type, asymmetric binary variables. Binary variables can be either symmetric or asymmetric. A binary variable is said to be of the symmetric type if each of its possible values is associated with the presence of an attribute red/blue or Republican/Democrat, or the occurrence of an event rain/snow or flood/fire. However, in the case of an asymmetric binary variable, one of the variable's 2 values depicts the absence of an attribute or the non-occurrence of an event. For example, attribute present/attribute not present, or event occurred/event did not occur. In other words, one of the variable's states represents something not happening or a feature not being present. Research shows that when both the predictor and outcome variables are of the binary asymmetric type, the confirmatory instances, pattern occurs and expected outcome occurs, are extraordinarily salient and especially likely to consume the attention of the informal data analyst. This attentional shift to the upper left cell strongly encourages the perception of illusory correlations. Recall that when the variables are asymmetric binaries, the other 3 cells of the contingency table contain instances in which one or both of the variables are registering the absence of the pattern, the non-occurrence of the expected outcome or both pattern absence and outcome non-occurrence. The non-occurrence of an event or the absence of an attribute is easily overlooked because people have difficulty conceptualizing and evaluating this kind of evidence. The research just alluded to has shown it takes more cognitive effort to evaluate instances where something does not occur than instances where something does. To illustrate the extra cognitive effort required to process a statement involving the non-occurrence of an event or the absence of an attribute, consider the following 2 statements. Although they both convey the same information, the meaning of the first, which is given in an affirmative form, is intuitively obvious. However, the meaning of the second, which is given in the negative form, requires some thought. Statement 1, all humans are mortal. Statement 2, all non-mortals are non-humans. Many of the propositions of subjective TA assert the existence of a correlation between a pair of asymmetric binary variables, a signal/pattern that is either present on the chart or not, and an outcome that the signal/pattern is supposed to predict, which either occurs or does not. Thus, the psychological research described earlier suggests that subjective TA practitioners will be especially likely to fall prey to illusory correlations. They will tend to be overly impressed with confirmatory instances, in which the pattern/signal did occur and the expected outcome also occurred, and give too little attention and weight to the 3 other types of instances. Some examples of subjective patterns along with their expected outcomes are illustrated Table 2.1. Hidden or missing data compounds the problem of illusory correlations. The discussion so far shows how people come to believe in bogus correlations because of an insufficient consideration of all relevant information in a contingency table. However, the subjective technician's plight does not end here. Further compounding the propensity to detect illusory correlations is the problem of missing data. The cell counts needed to fill in the contingency table are not even readily available. The missing data problem is yet another consequence of subjective analysis. Without objectively defined signals/patterns, and without objectively defined standards for evaluating their outcomes, it is impossible to obtain the requisite counts that are needed to fill the cells of the contingency table. Without these counts, the true efficacy of the signal/pattern cannot be evaluated. This applies even to the confirmatory instances found in the upper left cell of the table, although subjective practitioners seem never to run short of confirmatory examples. Objective definitions are the only solution to the missing data problem. Until TA adopts objectivity, it will continue to operate on the basis of magical thinking and myth. Once an illusory correlation is accepted as fact, two previously mentioned cognitive errors assure the misconception's longevity. The mere belief in the specious relationship increases the likelihood that additional supportive evidence will be noticed, confirmation bias. Moreover, the alleged correlation is easily assimilated into one system of beliefs. As Jilovich points out, once a phenomenon is suspected to exist, people are easily able to come up with an explanation about why it exists and what it means. In other words, humans are very good at inventing stories after the fact. Studies show that when people are falsely informed that they are either above average or below average at some task, they can readily invent a reason that explains why. Part of the appeal of subjective TA is the fascinating story offered about why it works. The story itself helps sustain belief. A behaviorist's explanation of illusory correlations. Thus far, the discussion has explained the birth and longevity of erroneous beliefs in terms of cognitive psychology. A separate subdiscipline of psychology, behaviorism, offers a somewhat different account of why erroneous beliefs as to the efficacy of subjective TA should be so durable. Behavioral psychology is concerned with roles of reward, positive reinforcement, and punishment, negative reinforcement, in the learning of habitual behaviors. If a pigeon is put in a cage and rewarded with a food pellet each time it pecks at a button, it will eventually learn the habit of pecking the button. Once this behavior has been acquired, the bird will continue pecking the button so long as the food pellets keep coming. However, if the reward is stopped, the bird eventually learns that the behavior no longer pays, and the learned behavior is extinguished. One area of interest within behavioral psychology is the relationship between the strength of a habit, indicated by the degree to which it resists extinction, and the specific type of reinforcement schedule that originally led to the habit's formation. The question is which type of reinforcement schedule produces the strongest habits. The simplest type of reinforcement is rewarding every action, each peck earns a pellet. Another is partial reinforcement, in which rewards come only at fixed time intervals, such as every 60 seconds, or fixed behavior intervals, such as every 10th peck. It has been discovered that partial reinforcement schedules produce slower learning. Habit takes longer to form, but stronger habits. Most relevant to the domain of TA is the fact that of all the partial reinforcement schedules investigated, random reinforcement 121 produces habits that are most resistant to extinction. Under random reinforcement, the organism's behavior is not truly associated with the receipt of a reward. Behavior is rewarded by chance. In one experiment, a pigeon pecked at a colored button and received random reinforcement for a mere 60 seconds. However, the pecking behavior continued for 3.5 hours after the reward was stopped. In other words, the pathetic bird engaged in a fruitless activity for a period that was 210 times longer than the random reinforcement period that produced the habit. Random reinforcement is precisely the type of reward received by someone who believes in an illusory TA correlation. Every so often, by chance, the signal/pattern is followed by the expected outcome, thus reinforcing the belief. Behaviorist studies would predict that such a belief would be extremely resistant to extinction. Superstitions and compulsive gambling, two habits that rest on illusory correlations, are known to be extremely difficult to cure. When I worked on the floor of the American Stock Exchange, I met several traders who displayed superstitious behavior. One fellow insisted on wearing the same tie every day, which contained an accurate historical record of his tastes in soup. Another was adamant about entering the trading floor through one particular door of the several available. Another refused to use a red pen. Each of these odd habits was probably initiated by an accidental pairing of the behavior with a desired or undesirable outcome, and then perpetuated by random reinforcement. Misplaced faith in chart analysis. Subjective technicians, irrespective of the specific method they practice, believe in the efficacy of visual chart analysis. Price charts are presumed to be a valid method for detecting exploitable order in financial market data. The pioneers of TA used charts to discover the discipline's foundational principles, and today they remain the primary analysis tool. This section explains why confidence in chart analysis is misplaced. This is not to say that charts have no role in TA. They can serve as a source of inspiration that leads to the formation of testable hypotheses about market behavior. However, unless and until these conjectures are vigorously and objectively tested, they remain mere suppositions rather than trustworthy knowledge. An informal search for order is sure to find it. Humans have both the need and the capacity to find order and meaning in their experience. It may have been bred into us through evolution. Because of its general adaptiveness, we can capitalize on ordered phenomena in ways that we cannot on those that are random. The predisposition to detect patterns and make connections is what leads to discovery and advance. The problem is that the tendency is so strong and so automatic that we sometimes detect coherence even when it does not exist. A trait of intuitive, non-scientific thinking is the tendency to accept without question surface impressions and obvious explanations. Unfortunately, what is obvious at first blush is not necessarily valid. To the ancients, it seemed obvious the sun orbited the earth. To the pioneers of TA, it seemed obvious that financial market prices formed patterns and trends. Just as early observers of the heavens perceived mythical figures like Leo the lion and Orion the hunter in the random arrangements of stars, the first technicians saw heads and shoulders, double and triple tops, and other patterns in the meandering movements of stock and commodity prices. These patterns form the lexicon of subjective chart analysis. Our nervous system seems to be wired to see shapes regardless of whether they are real. Dr. John Elder, a noted authority on predictive modeling and data mining, calls this the bunnies in the clouds effect. There is, however, good reason to question the validity of chart analysis, and by extension, to question the validity of knowledge based on it. I contend that trends and patterns on charts that appear real to the eye may often be illusions born of the mind's voracious, though indiscriminate, appetite to perceive order. This is not meant to imply that financial markets are devoid of authentic trends and patterns. In fact, there is sound empirical evidence that patterns exist which have predictive power. It does mean, however, that visual inspection of charts is an inadequate means for discovering or verifying the authenticity of patterns. Studies have shown that even expert chartists cannot reliably distinguish between authentic stock charts and simulated charts produced by a random process. A method of analysis that cannot discriminate real charts from fakes cannot provide reliable analysis of the real. A jeweler who can't tell the difference between authentic diamonds and dime store costume jewelry is in no position to appraise a diamond necklace. Illusory trends and patterns in financial data. Statistician Harry Roberts said that technical analysts fall victim to the illusion of patterns and trends for two possible reasons. First, the usual method of graphing stock prices gives a picture of successive price levels rather than of price changes, and levels can give an artificial appearance of pattern or trend. Second, chance behavior itself produces patterns that invite spurious interpretations. Roberts showed that the same chart patterns to which TA attaches importance appear with great regularity in random walks. A random walk is, by definition, devoid of authentic trends, patterns, or exploitable order of any kind. However, Roberts' random walk charts displayed head and shoulder tops and bottoms, triangle tops and bottoms, triple tops and bottoms, trend channels, and so forth. You can create a random walk chart from a sequence of coin flips by starting with an arbitrary price, say $100, and adding $1 for each head and subtracting $1 for each tail. In other words, the face of the coin represents a price change, and the chart shows a sequence of simulated price levels. Each simulated price in the sequence is equal to the cumulative algebraic sum of all prior random changes added to the starting value. If you carry out this process for 300 or so flips, you may be amazed at the patterns that appear. Many will be similar to the patterns found on actual charts of financial assets. Clearly, the patterns or trends that appear on a coin flip chart cannot predict its future evolution. This raises an important question: if chartist-like patterns can appear with such regularity in random walks, and it is known that these patterns cannot be predictive, how can the same patterns be considered predictive simply because they happen to appear on a real chart? Perhaps we should not trust the eye of Roberts. He was a statistician, not an expert in TA. If an expert chartist were able to spot the patterns occurring in random walk charts as fakes the way a competent jeweler can spot a counterfeit diamond, then Roberts's random walk experiment would not prove anything other than his lack of chart expertise. Certainly, expert chartists should claim that they can tell the difference between patterns occurring in random walks and those occurring on real charts. After all, if the patterns on actual markets charts form as a result of changes in supply and demand and slash or oscillations in market mood, as TA claims, they should look different from the accidental meanderings on a random walk chart. Unfortunately, expert chartists have been unable to tell the difference between real and fake charts. Arditi put them to the test. When presented with an assortment of real charts mixed with random walk charts, the chartists examined by Arditi were no more accurate at telling the real from the fake than a guess. This result was subsequently confirmed in an informal study by Professor Jeremy Siegel of the Wharton Business School. Siegel presented the graphs shown in Figure 2.18 for real and for random to a group of top Wall Street stockbrokers who considered themselves competent chart readers. Again, the experts were unable to reliably distinguish the real from the random. I conducted a similar experiment using graduate business students who had just completed a course in technical analysis. Their accuracy was consistent with guessing. The real charts are indicated by the X. What can we conclude from these results? First, they do not imply that financial markets are random and hence devoid of valid trends and patterns. But they do call into question the efficacy of subjective/visual chart analysis as a means of knowledge acquisition and forecasting. If chart reading were a valid skill, it should at least be possible to distinguish an actual chart from a random fake. Evidence of illusory trends in sports. Financial markets are not the only arena in which observers are plagued by the illusion of order. Many sports fans and athletes believe in performance trends, periods of hot and cold performance. What baseball fan or player does not think batting slumps or hitting streaks are real? Basketball fans, players, coaches, and sports commentators speak of the so-called hot hand, a trend of above-average shooting accuracy. These beliefs are widely held because trends in athletic performance seem so obvious. However, rigorous statistical analysis of player performance indicates that the hot hand phenomenon is an illusion. The fans have been duped by their intuition. This erroneous belief stems from a faulty notion about how random phenomena ought to behave. Common sense would have us believe that streaks, a sequence of strikeouts, or a sequence of successful shots, and so forth, should not occur in a random process. Rather, intuition incorrectly tells us that random processes should display something resembling an alternating pattern of positive and negative outcomes. The truth is that sports trends are, by and large, a cognitive illusion. What appears to be a batting slump or a hitting streak is often nothing more than a run of similar outcomes, a phenomenon that is quite common in random processes. A valid trend is a streak of longer duration than those that are ordinary in random data. That is to say, a real trend is a streak of sufficient length that it would be rare in a random process. Jailovich points out that, although a player's performance does not display longer streaks than those allowed by chance, it does not mean that the player's performance is chance-determined. It is not. Whether a given shot is hit or missed is determined by a host of non-chance factors, foremost among them being the skill of the offensive and defensive players involved. However, one factor that does not influence or predict the outcome is the player's recent hit rate. To understand why sports fans, athletes, and chart analysts fall prey to the illusion of trends and patterns in data that may in fact be random, we must delve a bit deeper into the nature of intuitive judgment. The intuitive judgment and the role of heuristics. To simplify, there are basically two types of thought processes: automatic and controlled. Intuition is automatic. It is our capacity for direct knowledge, for immediate insight without observation or reason. It is perception-like, rapid, and effortless, notes Princeton University psychologist Daniel Kahneman. In contrast, deliberate or controlled thinking is reasoning-like, critical, and analytic. The prototype of controlled thought is scientific reasoning. The prototype of intuition is the brilliant medical diagnostician who always seems to sniff the underlying disease. Subjective technicians rely primarily on intuition, and they do so to their detriment. Human intelligence has limits. We can only pay attention to an extremely small fraction of the information that comes to us through our sensory organs. Moreover, the mind is not well suited to complex tasks, such as estimating probabilities and making decisions in a logically and probabilistically correct manner in situations characterized by uncertainty. To cope, we must simplify. We reduce the complexities of estimating and decision-making by resorting to a variety of quick and dirty rules of reasoning known as judgment heuristics. They focus our attention on a limited portion of the total information picture and utilize relatively simple forms of information processing and reasoning to arrive at conclusions quickly. All of this is done without awareness or exertion. We make intuitive judgments as automatically and effortlessly as we recognize someone's face, a task for which the mind is very well suited. We acquire judgment heuristics from life experience. The term heuristic refers to the notion of discovery by trial and error, and this is how these rules of thought are acquired. Moreover, they slip into usage so subtly that we are unaware of how or when we learn them, and we adopt them because, in general, they work. However, they work imperfectly, and when they fail, our judgment suffers. The good news is that heuristic judgment tends to err in a consistent manner. In other words, the judgments are biased. They tend to be wrong in the same way over and over again. This consistency makes it possible to predict the conditions under which heuristic judgments will fail and how they will fail, whether the deviation from true value will be a positive or a negative one. In general, heuristic judgments tend to err in situations characterized by uncertainty. Financial markets are highly uncertain, so intuitive judgments in this arena are likely to be biased. The specific bias that afflicts subjective technicians is the propensity to see trends and patterns in data where such structures are not truly present. In other words, there is a systematic tendency to perceive order where only random behavior exists. This may explain why chartists are unable to distinguish real charts from pseudocharts produced from random data. In the words of Professor Burton Malkiel, randomness is a difficult notion for people to accept. When events come in clusters and streaks, people look for explanations and patterns. They refuse to believe that such patterns, which frequently occur in random data, could equally be derived from tossing a coin. So it is in the stock market as well. Malkiel takes the extreme position that the market is random. I do not share this conviction, but agree that people misperceive order in data that is random. For this reason, visual inspection of price charts cannot be trusted. The illusion of trends and patterns in data that is truly random may be attributable to the failure of a specific judgment heuristic called reasoning by representativeness. That is to say, a faulty application of the generally useful representativeness rule biases us toward the perception of order where it does not exist. Heuristic bias and the availability heuristic. To recap, heuristics help us make complex decisions rapidly in spite of the limitations of human intelligence, but they can cause those decisions to be biased. The notion of heuristic bias is easily explained by considering the availability heuristic. We rely on the availability heuristic to estimate the likelihood of future events. It is based on the reasonable notion that the more easily we can bring to mind a particular class of events, the more likely it is that such events will occur in the future. Events that are easily brought to mind are said to be cognitively available. For example, plane crashes are a class of events with high cognitive availability. The availability heuristic makes a certain amount of sense. The ability to recall a class of events is indeed related to how frequently they have occurred in the past, and it is also true that events that have happened frequently in the past are generally more likely to occur in the future. This is in keeping with one theory of probability that asserts that the future likelihood of an event is related to its historical frequency. Taken as a class, thunderstorms have been more frequent in the past than asteroid impacts, and they do indeed have a higher future likelihood. The problem with the availability heuristic is that there are factors that can enhance an event's cognitive availability that have nothing to do with its historical frequency, and are therefore irrelevant to estimating its future likelihood. Consequently, our judgments of likelihood are sometimes falsely inflated by the intrusion of these irrelevant factors. Two factors that have no relevance to an event's likelihood, but that do increase its cognitive availability, are recency and vividness. That is to say, how recently an event of the type in question took place, and how vivid the event was both impact how easily we can bring such events to mind. Consider plane crashes as a class of events. A plane crash that just occurred is both vivid and recent. As a result, in the period right after a well-publicized plane crash, many people tend to overestimate the likelihood of future plane crashes and are inordinately fearful of flying. Note the bias in the judgment is one of overestimating a probability. The availability heuristic never causes us to underestimate an event's likelihood. The error is always one of overestimating the probability. The representativeness heuristic, reasoning by similarity. The representativeness heuristic, which was first identified by Tversky and Kahneman 145, is of particular relevance to subjective TA. We use this rule to make intuitive classification judgments. In other words, it is used to estimate the probability that a particular object, for example the dog before me, belongs to a particular class of objects, for example the class of poodles. The underlying premise of the representativeness heuristic is that each member of a class should display the key common attributes that define the class. It is quite reasonable to expect that objects from the same class should possess a similar set of characteristics. In arriving at a judgment by representativeness about whether a given object belongs to a particular class, we unconsciously consider the degree of similarity or match between the attributes of the object and the set of attributes presumed to be representative of that class. This is why this heuristic is referred as a reasoning by representativeness. In this section and the next, I will argue that visual chart analysis is inherently flawed because of a bias toward the perception of order and pattern even in data that is truly random. I will contend that this bias is due to a misapplication of the representativeness heuristic. In other words, a bias stemming from a faulty application of the representativeness heuristic can explain why subjective technicians fall prey to an illusion of order in charts that were, in fact, produced by a random process. To explain how chartists make this mistake, which is rather subtle, we will take a brief detour by considering a more easily understood case of heuristic bias caused by representativeness reasoning. As mentioned earlier, reasoning by representativeness is premised on the notion that a class of objects or events can be represented by a class stereotype, a typical example that possesses the class's key distinguishing characteristics. Often this line of reasoning works well. However, it fails when an object's most noticeable features are not reliable indicators of the object's class. In other words, when the characteristics that most draw our attention are not relevant in judging the object's class, reasoning by representativeness tends to fail. Unfortunately, intuitive judgment tends to be based on the most obvious features of an object or event regardless of whether these features are truly useful indicators of its class. Reasoning by representativeness estimates the probability that an object belongs to a given class by considering the degree of match between the object's most salient attributes and the most salient attributes of the class stereotype. The greater the number of matching attributes, the higher the adjudged probability that the object is indeed a member of the class in question. Modern psychologists hypothesize that our concepts of categories, classes like bank tellers, feminists, microcomputers, skunks, and all kinds of things, are represented cognitively as lists of attributes that we believe are defining characteristics of those entities. 147. This is illustrated in Figure 2.19. In many instances, this fast and frugal classification rule gives accurate results. People would not use such a rule if it did not. Let's consider an example where the application of the representativeness rule leads to an erroneous judgment about an object's class. Imagine that you have just taken your seat on a commercial airline flight, and you become concerned that a person, the object seated next to you, may be a terrorist, the class. Your apprehension is aroused because the person has the following obvious characteristics: man of apparently Middle Eastern origin, mustache, 25-30 years of age, wearing a turban, reading the Quran, and appearing nervous. Your conclusion that the man may very well belong to the class of terrorists occurred quite spontaneously because his obvious characteristics are similar to a set of characteristics that was also possessed by i.e. is representative of the terrorists who conducted the attacks of September 11, 2001. Your inference was based on the representativeness heuristic. Now consider how you would have reacted if the passenger were a young Middle Eastern man, but was wearing blue jeans and a t-shirt with an obscene logo, had on a New York Yankee baseball cap instead of a turban, was reading a copy of Playboy instead of the Quran, and was listening to rock music on an iPod while blowing chewing gum bubbles. You would not have been worried. Intuitive judgments of class rest on the assumption that the most obvious characteristics of an individual are reliable indicators of that individual's class. Judgments based on representativeness can err because they fail to take into account statistical and or logical elements of a situation that are truly relevant to an accurate judgment about its class. The probabilistically correct way of estimating the class of an event or object is called Bayes' theorem, which is derived from the axioms of probability theory. If it were applied to the airline passenger suspected of being a terrorist, it would take into account such things as the proportion of terrorists in the world, i.e., the base rate of the class of terrorists, the proportion of people in the world that possess the set of observed characteristics, i.e., the base rate of the pattern, and the proportion of terrorists that have this pattern of characteristics, i.e., the conditional probability that these characteristics are present given that the individual is in fact a terrorist. When these values are plugged into the equation that expresses Bayes' theorem, we obtain the conditional probability that the person is a terrorist, given that they possess the pattern of characteristics. Because intuition operates on the basis of representativeness, rather than Bayes' law, we tend to commit an error called the base rate fallacy. This is the failure to consider the base rate statistics characterizing a situation. Terrorists, fortunately, are very rare, i.e., have a very low base rate. Thus, among the entire set of people who possess the same salient characteristics as the terrorists of 9/11/01, the fraction that are actually terrorists is extremely small. Perhaps only one person in a million with these traits is actually a terrorist. This fact is highly relevant to judging the likelihood that the person seated next to us is dangerous. However, we tend to neglect base rate statistics, because intuitive judgment is focused on the attention-grabbing features of a situation or object rather than relevant facts such as a base rate. An example of fallacious reasoning by representativeness was displayed by market analysts who predicted that a deflationary depression would follow the stock market crash of October 1987. They were captivated by the very noticeable similarity between the behavior of the stock market in 1929, which did lead to a deflationary depression, and its behavior in 1987. Both witnessed market crashes. This glaring similarity took analysts' attention away from significant dissimilarities between 1987 and 1929. In other words, 1987 and 1929 were different with respect to factors that do have some predictive information with respect to deflationary collapses. An examination of market crashes over the last 100 years shows that a price crash is not a reliable predictor of a deflationary depression. Another error associated with representative reasoning is called the conjunction fallacy, a failure to take into account a basic law of logic telling us that a proper subset must contain a smaller number of objects than the larger set to which it belongs. The set horses is a proper subset of the larger set, animals. It follows that horses must be fewer in number than animals in general, which includes horses, bluebirds, aardvarks, and so forth. However, when people rely on the representativeness rule, they seem to ignore this law of logic and commit the conjunction fallacy. In one experiment conducted by Tversky and Kahneman, subjects were presented with the following description: Linda is 31 years old, single, outspoken, and very bright. She majored in philosophy. As a student, she was deeply concerned with issues of discrimination and social justice, and also participated in anti-nuclear demonstrations. Which possibility is most likely? 1. Linda is a bank teller, or 2. Linda is a bank teller and is active in the feminist movement. Astoundingly, 85% of the subjects responded that it was more likely that Linda was a bank teller and active in the feminist movement than that Linda was simply a bank teller. This conclusion ignores the logical relationship between a set and a proper subset. Subjects became so fixated on the fact that Linda possessed a set of salient characteristics that matched an intuitive stereotype of a feminist that they committed the conjunction fallacy. Clearly, the set of women who are both bank tellers and active in the feminist movement is a subset of a larger category which contains all female bank tellers, including those who are feminists and those who are not. Other studies confirmed these findings and led Tversky and Kahneman to conclude that people's probability judgments are biased by the addition of salient detail. Even though each additional detail describing an object reduces the probability that such an object exists, when people reason by representativeness, additional detail increases the number of characteristics that match a class stereotype, thus increasing an intuitive estimate of probability. The conjunction fallacy is illustrated in Figure 2.20. The conjunction fallacy can have disastrous consequences when it seeps into jury verdicts. For example, consider which of two possibilities would seem more likely. 1. The defendant left the scene of the crime. 2. The defendant left the scene of the crime for fear of being accused of murder. The second hypothesis involves a conjunction of left the scene and fear of accusation. Because the second alternative is a subset of the first, it is by definition less probable. Clearly, there are reasons for someone's leaving a crime scene other than fear of being accused, like going to pick up the dry cleaning. However, the additional detail of the second hypothesis lends a ring of plausibility because it increases a sense of match to actions that would be representative of a guilty party. The representativeness heuristic and the illusion trends and patterns in charts, real and fake. So far, the representativeness heuristic has been discussed with respect to its use in classifying objects. In fact, the heuristic is also involved in a more abstract type of classification judgment that is central to the practice of subjective TA, judging that a sample of data evidences trends and patterns, and is, therefore, worthy of further analysis, or alternatively, that the data is a random hodgepodge not worthy of further analysis. Bear in mind the judgment about whether a data set appears random or non-random is not made with conscious awareness or intention. It occurs as automatically and unconsciously as the judgment involved in recognizing the face of a friend. All heuristic judgments, including reasoning by representativeness, occur automatically and without conscious awareness. As a result, when a chartist concludes that a sample of price history contains authentic patterns and trends, i.e., that the data is non-random and is, therefore, worthy of analysis, it is not a matter of controlled thinking. That is to say, the chartist does not consciously pose the question, does this data appear as if it contains exploitable order and structure? Although heuristic judgments slip into our thinking unnoticed, they can have a profound influence on our beliefs. The problem is that heuristic thinking fails to take into account important features of the data that are relevant to determining if it does contain authentic patterns and trends that might be exploited with further analysis. In a previous section, I asked you to create an artificial price history random walk chart by flipping a coin 300 times. If you did not do so then, I urge you to do so now. Not only will it make this section more meaningful, it may permanently change the way you look at charts. To quote Martha Stewart, that's a good thing. If this was your first exposure to data generated by a random process, you may be surprised by how non-random it looks. You may not have expected to see formations that look like chart patterns, head and shoulders, double top, etc. The question we must consider is this: why does this sequence, which we know to be random in origin, give the appearance of having authentic patterns and trends? Or, said differently, why does data generated by a purely random process appear as if it were generated by a process governed by rules, which, if discovered, would make prediction possible? Your chart may have looked something like Figure 2.21. The bottom line is this: that which appears to be non-random is not necessarily non-random. My contention is that the perception of trends and patterns in randomly generated data occurs because of a faulty application of the representativeness heuristic. Specifically, the heuristic creates a faulty intuitive notion of how random data is supposed to look. That is to say, it produces a false stereotype of randomness. Thus, when we view data that does not appear to match this false stereotype, we automatically and erroneously conclude that the data is non-random. From this flawed conclusion, it is a short leap to the equally false perception of patterns and the equally false notion that the patterns contain predictive information. One consequence of representativeness-based reasoning is the expectation that an effect should resemble its cause. This is often reasonable. The Earth, big cause, is responsible for gravity, big effect, while a mere pebble in our shoe causes only a minor annoyance. However, the rule that an effect should resemble its cause does not always hold. The 1918 flu pandemic, a big effect, was caused by a creature of submicroscopic proportions. How does this relate to charts of asset prices? A set of data on a chart can be seen as an effect of a process, the activity of a financial market. The process is the cause, whereas the data is the effect. A chart of our body's hourly temperature over a 24-hour period is an effect caused by a process that happens to be our body's metabolism. Because representativeness-based thinking operates involuntarily beneath conscious awareness, when we view the chart of an asset's price history, we tend to draw an automatic conclusion about the nature of the process that generated the chart. Perhaps, if stock charts looked something like the trace in Figure 2.22, the pioneers of TA would have been less likely to see exploitable structure, and the practice of TA would never have been born. This data is supposed to approximate an intuitive stereotype of randomness, haphazard, disorderly, and without any hint of trend. On the basis of the representativeness heuristic, we presume that if a process, the cause, is random, its effect, the data, should also appear random. As a consequence of this assumption, any sample of data that deviates from the presumed stereotype of randomness, because it manifests some sense of pattern or trend, is concluded to be the product of a non-random process. Stock charts give the appearance of having been generated by a non-random process. In other words, they match an intuitive notion of order and predictability. Bear in mind that financial markets may indeed be non-random to some degree and hence be amenable to prediction. However, that is not the issue here. Rather, the issue is, can non-random structure that is amenable to prediction be detected by visual inspection and intuitive appraisal? As mentioned previously, the deficiencies of reasoning by representativeness are due to an excessive focus on obvious appearances and the simultaneous disregard of important statistical and logical features. As will be explained in Chapter 4, one of the most important features of a sample of data, from the standpoint of data analysis, is the number of observations comprising the sample. Valid conclusions about a sample of data must take the number of observations into account. Moreover, the statistical characteristics of a large number of observations are required to accurately represent the true nature of the process that generated the data, e.g., random or non-random. Conversely, small samples of data often convey the illusion of patterns and trends because the statistical characteristics of a small sample of data can be wildly unrepresentative of the data generating process. I contend that the belief that visual chart analysis is a valid method for detecting trends and patterns is based on a flawed chain of thinking that goes something like this. 1. On the basis of the representativeness heuristic, it is erroneously thought that data generated by a random process should look random, a formless haphazard flip-flop without any hint of patterns, organized shapes, or trends. 2. This stereotype is erroneously assumed to manifest in all samples of random data, irrespective of the number of observations comprising the sample. 3. A small sample of data is examined and it appears not to match the intuitive stereotype of randomness. 4. The data is thus deemed to be the product of a non-random process. 5. Non-random processes are amenable to prediction, hence it would be reasonable to look for patterns and trends in the data to make predictions. This is illustrated in Figure 2.23. The principal flaw in this chain of reasoning is the failure to consider the matter of sample size, step 2 of the preceding list. The presumption that a sample of data can accurately reflect the nature of the data generating process, irrespective of the number of observations comprising the sample, violates an important principle of formal data analysis, the law of large numbers. Reasoning by representativeness fails to respect the law of large numbers. In other words, it commits the crime of small numbers or sample size neglect. The penalty is automatic membership in the Fools of Randomness Club, the law of large numbers and the crime of sample size neglect. The law of large numbers tells us that sample size is of paramount importance because it determines the confidence we can have in inferences based on a sample of data. Also known as the law of averages, the law of large numbers tells us that only samples comprised of large numbers of observations reliably and accurately reflect the characteristics of the process that generated the sample. Or, said differently, only large samples can inform us about the characteristics of the population from which the sample came. Thus, the larger the number of coin tosses, the more closely the proportion of heads in the sample will reflect an essential truth about fair coins. The probability of heads is 0.50. The bottom line is we can have greater confidence in what we learn from large samples than from small ones. The law of large numbers will be discussed in greater depth in connection with statistics in Chapter 4. For the present discussion, what is important is the connection between the law of large numbers and the appearance of illusory patterns and trends in small samples of data. Small samples can be misleading because they can manifest characteristics that are very different from the true characteristics of the process that generated the sample. This explains why a small segment of a pseudo-stock chart, one that was actually generated by a random process, gives the appearance of authentic patterns and trends. Of course, by design, such a chart cannot have real trends and patterns. Thus, a reliable conclusion about whether a sample of data was the result of a random or non-random process cannot be obtained from a small sample. This is depicted by figures 2.24 and 2.25. When the parts small samples of the chart look non-random, an illusion of non-randomness is created in the entire chart when they are put together. Coin toss experiments illustrate how small samples can produce misleading impressions. The obvious statistical characteristic of this random process is that there are two equally likely outcomes. This is the basis for an expectation that the proportion of heads is 0.50. This intuition is indeed correct when the number of tosses is large. In a sample of 100,000 tosses, the proportion of heads will be extremely close to 0.50. If one were to repeat this experiment many times, the proportion of heads would always be very close to 0.50. In fact, it would be unlikely to fall outside the range of 0.497, 0.503. The problem is intuition pays no attention to sample size or the law of large numbers, so we also expect 0.50 heads to appear in all samples. Although it is true that the expected proportion of heads in any sample is always 0.50, even for just 2 tosses, the proportion of heads that will actually appear in a given small sample can depart significantly from 0.50. In 10 tosses, for example, 3 heads 0.30 or 7 heads 0.70 can easily happen. In a sample of 100,000 tosses, 0.30 heads 30,000 or 0.70 70,000 would be virtually impossible with a fair coin. Another faulty intuition about random processes is that outcomes should alternate up/down, head/tail, more than they really do. When people are asked to imagine what a sequence of coin tosses would be like, they tend to imagine sequences that show far more head/tail alternation than would really occur in a random sequence. In reality, random process displays less alternation and longer streaks of similar outcomes up than is widely believed. Therefore, when a set of data does not match the false expectation of an alternating sequence, it gives rise to the illusion of a trend. For example, it seems intuitively correct that a coin toss would be more likely to produce the sequence H, TH, TH, T than the sequence H, 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 H. However, both sequences are in fact equally probable, so we come away with the erroneous impression that the former sequence suggests a random process, whereas the latter suggests a process that displays a trend. Because random sequences actually alternate less and streak more than our intuitive conception, sequences that actually are random appear as if they are non-random. For example, the average basketball player makes about 50% of their shots, similar to the probability of getting heads. Thus, there is a reasonably good chance of making 4, 5, or even 6 shots in a row if 20 shots are taken in a game. In other words, chance favors the appearance of what sports fans call a hot hand, which is, in fact, nothing more than a streak typical of a random sequence. The erroneous notion that random processes should alternate more and streak less is responsible for 2 false perceptions: 1, the clustering illusion, and 2, the gambler's fallacy. In this context, the term cluster refers to a clump, either in time or space, of similar events. A cluster of similar outcomes in a random time series gives the illusion of a trend that has momentum, and this creates the false expectation that the trend should persist. The gambler's fallacy is the equally false expectation that a cluster of similar outcomes should not occur, and when one does, it gives rise to the false expectation that a reversal is due. The gambler's fallacy is exemplified by a person who thinks a tail is more likely after a string of heads. It is an observer's prior beliefs about a process that determines whether he will fall prey to the clustering illusion or the gambler's fallacy. Suppose a person is observing a process that is, in fact, random but does not realize that it is. That person will tend to fall prey to the clustering illusion if they hold a prior belief that the process is non-random and that it should manifest trends. Sooner or later a streak occurs and the prior belief is confirmed. The observer has fallen prey to the clustering illusion. In contrast, if the observer has a prior belief that the process is random, it is more likely that they will fall prey to the gambler's fallacy. Sooner or later a streak occurs, for example 4 heads in a row, which is then followed by a tail. Although this would be quite normal in a random process, the appearance of the tail reinforces the false belief that a tail was due. Therefore, when a process is truly random, both the observer who thinks the process is non-random and believes that trends clusters should occur, and the observer who thinks the process is random and that the trends should reverse will have their beliefs rewarded. In truth, when a process is random, both observers' expectations are false. Random walks have no memory, and prior outcomes have no effect on subsequent events. The clustering illusion can also occur in a spatial context. The perception of illusory shapes in random data is simply another manifestation of a false expectation about randomness. The false expectation is that random data should not display any hint of organization or form. Any departure from this expectation is interpreted, falsely, as a sign of a non-random process at work. A case in which illusory spatial patterns in random data encouraged the formation of erroneous perceptions occurred during the World War II bombing of London by German V-1 and V-2 missiles. The newspapers ran maps of missile impact sites, and readers had the immediate perception that the strikes were clustered. This gave rise to an equally false, after-the-fact interpretation that impact patterns were evidence of an effort by the Germans to avoid hitting certain parts of London, which in turn spawned fallacious causal reasoning. Londoners came to believe that these areas were spared V-2 attacks because they housed German spies. However, a formal analysis of the missile impact sites showed that they were entirely consistent with a random pattern. A more recent example of illusory spatial clustering that fostered erroneous causal reasoning was the so-called cancer cluster hysteria in California. People became alarmed if the number of diagnosed cases of cancer of a particular type, e.g., lung cancer caused by asbestos, was far above average in their community. It turns out that clusters can occur by chance. What is not apparent to the statistically unsophisticated is this: given 5,000 census tracts in California and 80 possible environmental cancers, there will be some tracts in which the number of cancer cases will be far above average simply due to chance. In some cases, such clusters really are attributable to environmental toxins, but not always and not nearly as often as intuition would suggest. This brings us back to TA and the appearance of orderly patterns like double tops, head and shoulders bottoms, and so forth. The occurrence of such shapes is not consistent with an intuitive notion of data produced by a random process. Such data is erroneously presumed to be completely haphazard and shapeless, so we jump to the conclusion the patterns must be the byproduct of a non-random process that is not only amenable to visual analysis, but that the patterns themselves are useful for making predictions. As Roberts showed, random walks can easily trace the patterns that subjective technicians hold so dear. In summary, people have a hard time telling when a set of data is random or not. Because the mind is predisposed to the perception of order and adept at inventing stories that explain why that order exists, it is not at all mysterious that the pioneers of TA would find patterns and trends in price charts, and then invent theories about why such patterns should occur. Methods more rigorous than visual analysis and intuition are needed to find the exploitable order that may exist in financial market fluctuations. The antidote to illusory knowledge, the scientific method. This chapter examined many ways we can be fooled into adopting erroneous knowledge. The best antidote ever invented for this problem is the scientific method, the subject of the next chapter. Chapter 3, the scientific method and technical analysis. TA's central problem is erroneous knowledge. As it is traditionally practiced, much of TA is a body of dogma and myth, founded on faith and anecdote. This is a consequence of the informal, intuitive methods used by its practitioners to discover patterns with predictive power. As a discipline, TA suffers because it is practiced without discipline. Adopting a rigorous scientific approach would solve this problem. The scientific method is not a cookbook procedure that automates knowledge discovery. Rather, it is a set of methods designed to describe and interpret observed or inferred phenomena, past or present, aimed at building a testable body of knowledge open to rejection or confirmation. In other words, it is a specific way of analyzing information with the goal of testing claims. This chapter summarizes its logical and philosophical foundations and discusses the implications of its adoption by TA practitioners. The most important knowledge of all, a method to get more. Of all the kinds of knowledge that the West has given to the world, the most valuable is the scientific method, a set of procedures for acquiring new knowledge. It was invented by a series of European thinkers from about 1550 to 1700. Compared to informal approaches, it is unsurpassed in its ability to separate fact from falsehood. The dramatic increase in our understanding of and control over the natural world over the last 400 years attests to the power of the scientific method. The method's rigor protects us from the frailties of mind, which often impair what we learn from experience using less formal methods. Although informal knowledge acquisition works well for many of the obvious truths of daily living, sometimes what seems obvious is not true. It was obvious to the ancients that the sun revolved around the earth. It took science to show this was false. Informal observation and intuitive inference are especially prone to failure when phenomena are complex or highly random. Financial market behavior displays both. Historically, TA has not been practiced in a scientific manner, but this is now changing. In academia and the business world, a new breed of practitioners, known as quants, have been adopting a scientific approach. Indeed, some of the most successful hedge funds are using strategies that could be called scientific TA. Unsurprisingly, many traditional TA practitioners have resisted this change. Vested interests and habitual ways of thinking are hard to abandon. No doubt there was opposition when folk medicine evolved into modern medicine, when alchemy progressed into chemistry, and when astrology advanced into the science of astronomy. Rancor between traditional and scientific practitioners is to be expected. However, if history is any guide, traditional TA will in the end be marginalized. Astrologers, alchemists, and witch doctors still practice, but they are no longer taken seriously. The legacy of Greek science, a mixed blessing. The Greeks were the first to make an effort at being scientific, though their legacy proved to be a mixed blessing. On the positive side of the ledger was the invention of logic by Aristotle. The formal reasoning procedures he developed remain a pillar of today's scientific method. On the negative side were his faulty theories of matter and motion. Instead of being generalized from prior observations and tested against freshly observed facts, as is the practice in modern science, his theories were deduced from metaphysical principles. When observations conflicted with theory, Aristotle and his disciples were prone to bending the facts rather than altering or abandoning the theory. Modern science does the opposite. Aristotle ultimately realized that deductive logic was insufficient for learning about the world. He saw the need for an empirical approach based on inductive logic, observation followed by generalization. Its invention was his most significant contribution to science. However, he failed in the application of his own invention. At his institution of higher learning, the famed Lyceum in Athens, Aristotle and his students made meticulous observations on a wide range of natural phenomena. Unfortunately, the inferences they drew from these facts were biased by Aristotelian dogma and often based on inadequate evidence. There was too much theorizing from too little evidence. When facts contradicted favored first principles, Aristotle would contort the facts to conserve the principle. Ultimately, the Aristotelian legacy would prove to be an obstruction to scientific progress. Because his authority was so great, his flawed theories were transmitted as unquestioned dogma through the next 2,000 years. This hindered the growth of scientific knowledge, or at least the sort of knowledge that we now characterize as scientific. In a like manner, the teachings of TA's pioneers like Dow, Schabacker, Eliot, and Gann have been passed along unquestioned and untested. Just as there is no room for dogma in science, neither should there be in TA. The birth of the scientific revolution. Science was the major discovery or invention of the 17th century. Men of that time learned, and it was a very revolutionary discovery how to measure, explain, and manipulate natural phenomena in a way that we call scientific. Since the 17th century, science has progressed a great deal and has discovered many truths, and it has conferred many benefits that the 17th century did not know, but it has not found a new way to discover natural truths. For this reason, the 17th century is possibly the most important century in human history. The revolution began in Western Europe around 1500 in an atmosphere of intellectual stagnation. At that time, all knowledge was based on authoritarian pronouncements rather than observed facts. The doctrines of the Roman Church and the dogma of Greek science were taken as literal truths. On Earth, objects were assumed to be governed by Aristotelian physics. In the heavens, the laws invented by the Greek astronomer Ptolemy and later endorsed by the Church were thought to rule. The Ptolemaic system held that the Earth was the center of the universe and that the sun, stars, and planets orbited about it. To the casual observer, the facts seemed to agree with the Church's orthodox theory. Everyone was happy until people began to notice facts that conflicted with these accepted truths. Artillerymen observed that projectiles hurled by catapults and shot from cannons did not fly in conformity with Aristotle's theory of motion, figure 3.1. The objects were repeatedly observed to follow arced paths, a distinct departure from the trajectory predicted by Greek theory, which would have had them fall directly to Earth as soon as they left the apparatus. Either the theory was wrong or the solders were deceived by their senses. The notion of testing the validity of a theory by comparing its predictions with subsequent observations is fundamental to the modern scientific method. This was an early step in that direction. Also, at that time, observations of the heavens began to collide with the Church's theory of an Earth-centered universe. Increasingly accurate astronomical measurements revealed that planets did not move as the theory said they should. For a time, bewildered astronomers were able to patch up the Church's theory to make it agree with observed planetary paths. As discordant observations occurred, new assumptions were added to the theory, in the form of smaller orbits revolving about a planet's principal orbit. These ad hoc fixes, called epicycles, permitted the theory to account for the troublesome observations. For example, epicycles were able to explain why planets were sometimes seen to move backwards retrograde motion rather than follow a continuous path across the sky. Over time, a succession of epicycle fixes transformed the fundamentally incorrect theory of an Earth-centered universe into an unwieldy monstrosity of complexity with epicycles upon smaller epicycles, upon even smaller epicycles. A landmark in scientific history took place when the telescope of Galileo Galilei, 1564–1642, showed that 4 moons circled the planet Jupiter. This observation contradicted church orthodoxy that all celestial objects must revolve around the Earth. Galileo's findings would have called for the rejection of deeply held beliefs and the destruction of the church's view of reality. Religious authorities were not about to face these facts. Though Galileo had originally been given permission by the church to publish his findings, it subsequently withdrew the permission and found him guilty ex post facto. As punishment, he was forced to give up astronomy and live out his days under house arrest. Eventually, the Church's theory of the heavens was replaced by the far simpler and more correct Copernican model. It placed the sun at the center of the universe and managed to explain astronomical observations with far fewer assumptions. Today, we know that the sun is not the center of the universe, but at the time the Copernican model represented a true increase in man's knowledge of the heavens. Faith in objective reality and objective observations. Science makes a fundamental assumption about the nature of reality. There is an objective reality that exists outside and independent of those who observe it, and this reality is the source of the observer's sensory impressions. This faith is the basis of science's emphasis on observation. It is properly characterized as a faith because there is no experiment or logic that can prove the existence of an objective reality. For example, I cannot prove that my perception of a red traffic signal is caused by a light that exists outside of myself rather than by something that arose entirely within my own mind. One might ask why we should make a big deal about a fact that seems so obvious to common sense. Everyone can see there is a world out there. However, in the eyes of science, this issue is a mountain and not a molehill, and it points to an important difference between knowing scientifically and knowing intuitively. Science does not accept something as true simply because it seems to be so. The history of science has shown repeatedly that the obvious is not necessarily true. Science assumes the truth of an independent objective reality, not because it is self-evident, but because it is consistent with a principle that shapes much of the scientific enterprise, the principle of simplicity. The principle says simpler is better. Thus, when judging which of several theories is most likely to be true, when all theories are equally good at fitting a set of observed facts, the principle of simplicity urges us to accept the simplest theory. This is the theory that invokes the fewest and least complicated assumptions. The principle of simplicity, also known as Occam's razor, tells us to cut away a theory's excess complexity. The Copernican model of the universe was preferable to the Church's model because it replaced a complex arrangement of epicycles with one orbit for each planet. In a like manner, if a segment of market history can be explained either as a random walk, which assumes very little, or as an Elliott wave pattern that assumes waves embedded within waves, golden ratios, Fibonacci sequences, and a host of other complexities, the random walk is the preferred explanation. That is, unless the Elliott wave principle is able to make more accurate predictions than the random walk theory. Assuming the existence of an external reality simplifies matters greatly. To do otherwise would require a far more complex set of assumptions to explain why two people, observing the same phenomenon, will come away with generally the same impression. Explaining why I see other cars stopping when I see the traffic signal turning red is simple if I assume that there really is a traffic light out there. However, without that assumption, many more complicated assumptions would be required to explain why other motorists stop when I do. As a consequence of its faith in an objective reality, science holds that objective and subjective perceptions are essentially different. My objective observation of a red traffic signal and my subjective experience of being annoyed because it will make me late for work are not the same. Objective observations can be shared with and confirmed by other observers. For this reason, objective observations lend themselves to the establishment of knowledge that can be shared with and confirmed by others. Subjective thoughts, interpretations, and feelings cannot, and this flaw alone is sufficient to disqualify subjective TA as legitimate knowledge. The nature of scientific knowledge. Albert Einstein once said, "One thing I have learned in a long life that all our science measured against reality is primitive and childlike, and yet it is the most precious thing we have." Scientific knowledge is different than wisdom gained by other modes of inquiry such as common sense, faith, authority, and intuition. These differences, which account for science's higher reliability, are considered in this section. Scientific knowledge is objective. Science strives for maximum objectivity by confining itself exclusively to facts about the world out there, although it is understood that perfectly objective knowledge is never attainable. This eliminates from consideration subjective assessments that are inherently private and accessible by only one person. Inner thoughts and emotive states cannot be shared accurately with others, even when that is the intent of an artist, poet, writer, or composer. In Naked Lunch, William Burroughs attempts to convey his personal experience of heroin. However, I will never know his experience and may take away from those passages something quite different than Burroughs's experience or that of someone else reading it. Scientific knowledge is, therefore, public in the sense that it can be shared with and verified by as many people as possible. This promotes maximum possible agreement among independent observers. Scientific knowledge is empirical or observation-based. In this way, it differs from mathematical and logical propositions that are derived from and consistent with a set of axioms, but need not refer to the external world or be confirmed by observation. For example, the Pythagorean theorem tells us that the squared length of the hypotenuse of a right triangle C is equal to the sum of the squares of the other two sides, A and B, or C square equals A square plus B square. However, this truth was not derived by studying thousands of examples of right triangles and generalizing from those many observations. Rather, it is derived from a set of accepted mathematical postulates. Scientific knowledge is quantitative. The notion that the world is best understood when described in quantitative terms originated with the Greek mathematician Pythagoras. It was his contention that both the world and the mind are essentially mathematical. The importance science places on quantification cannot be overemphasized. Wherever mankind has been able to measure things, which means transform or reduce them to numbers, it has indeed made great progress in understanding them and controlling them. Where human beings have failed to find a way to measure, they have been much less successful, which partly explains the failure of psychology, economics, and literary criticism to acquire the status of science. Observations must be reduced to numbers if they are to be analyzed in a rational and rigorous fashion. Quantification makes it possible to apply the powerful tool of statistical analysis. Most scientists would say that if you cannot describe what you are doing in mathematical terms, you are not doing science. Quantification is the best way to ensure the objectivity of knowledge and to maximize its ability to be shared with and tested by all qualified practitioners. The purpose of science, explanation, and prediction. The goal of science is the discovery of rules that predict new observations and theories that explain previous observations. Predictive rules, often referred to as scientific laws, are statements about recurring process, such as event A tends to predict event B, but laws don't try to explain why this happens. Explanatory theories go further than predictive rules by telling us why it is that B tends to follow A, rather than simply telling us that it does. Chapter 7 will describe some theories advanced by the field of behavioral finance that attempt to explain why the behavior of financial markets is, at times, non-random. These theories give hope to TA and may explain why certain methods of TA can work. Scientific laws and theories differ with respect to their generality. The most prized are the most general, that is, they predict and or explain the widest range of phenomena. A TA rule that is effective on all markets and all time scales would have higher scientific stature than one that works only on copper futures on hourly data. Laws also differ with respect to their predictive power. Those that depict the most consistent relationships are the most valuable. All other things being equal, a TA rule that is successful 52% of the time is less valuable than one that works 70% of the time. The most important type of scientific law is the functional relationship. It summarizes a set of observations in the form of an equation. The equation describes how a variable that we wish to predict, dependent variable, typically denoted by the letter y, is a function of i.e., dependent on one or more other variables called predictors, usually designated by the letter x. This is illustrated as typically the values of the predictors are known, but the value of the dependent variable is not. In many applications, this is because the dependent variable y refers to a future outcome, whereas the x variables refer to values that are currently known. Once a functional relationship has been derived, it is possible to predict values for the dependent variable by plugging in known values of the predictor variables. Functional relationships can be derived in two ways. They can be deduced from explanatory theories, or they can be estimated induced from historical data by function fitting, e.g., regression analysis. Currently, TA is primarily constrained to the latter because theories of TA are just now being formulated, see Chapter 7. The role of logic in science. Scientific knowledge commands respect, in part because its conclusions are based on logic. By relying on logic and empirical evidence to justify its conclusions, science avoids two of the common fallacies that contaminate informal reasoning: appeals to authority and appeals to tradition. An appeal to authority offers as proof the statement of a purportedly knowledgeable person. An appeal to tradition offers a long-standing way of doing things as proof. To its detriment, much of popular TA is justified on grounds of tradition or authority rather than formal logic and objective evidence. In many instances, current authorities merely quote prior authorities who in turn quote yet earlier experts and so on back to an original source whose knowledge was primarily intuitive. Thus, the fallacies of authority and tradition are mutually reinforcing. The first rule of logic, consistency, Aristotle 384–322 BC, is credited with the invention of formal logic, which evolved from geometry. The Egyptians had been making accurate measurements of lines and angles and calculating areas for over 2,000 years. But it was the Greeks who extended these basic notions and transformed them into a compelling system of irrefutable conclusions derived from mathematical definitions, axioms. Formal logic is the branch of mathematics concerned with the laws of correct reasoning that are used to formulate and evaluate the validity of arguments. In contrast to informal inference, if the rules of formal logic are followed, a true conclusion is guaranteed. The most fundamental principle of formal logic is the rule of consistency. It is expressed in two laws, the law of the excluded middle and the law of non-contradiction. The law of the excluded middle requires that a thing must either possess or lack a given attribute. There is no middle alternative, or said differently, the middle ground is excluded. A statement is either true or false. It cannot be both. However, the law is only properly applied to situations that are binary and is easily misapplied to situations that are not truly two-state. Closely related to the law of the excluded middle is the law of non-contradiction. It tells us that a thing cannot both be and not be at the same time. A statement cannot be true and not true at the same time. An argument that allows for its conclusion to be true and not true at the same time is said to be a self-contradictory. As will be shown in subsequent sections, these laws of logic are used to great effect in science. Although observed evidence, such as the profitable back test of a TA rule, cannot logically prove that the rule has predictive power, that same evidence can be used to logically disprove, contradict the assertion that the rule is devoid of predictive power. By the law of non-contradiction, this indirectly proves that the rule does possess predictive power. This method of proving empirical laws, called the method of indirect proof or proof by contradiction, is the logical basis of the scientific method. Propositions and arguments. Logical inference takes two distinct forms, deduction and induction. We will consider each separately and then see how they are used together in the logical framework of modern science, the hypothetico-deductive method. However, before considering these forms of inference, some definitions are in order. Proposition, a declarative statement that is either true or false, sometimes referred to as a claim. For example, the statement "the head and shoulder pattern has more predictive power than a random signal" is a proposition. A proposition differs from other kinds of statements that do not possess the attribute of truth of falsity, such as exclamations, commands, and questions. Therefore, only propositions may be affirmed or denied. Argument, a group of propositions, one of which is referred to as the conclusion, which is claimed to follow logically from the other propositions, called premises. Thus, an argument asserts that its premises provide the evidence to establish the truth of its conclusion. Deductive logic. As mentioned earlier, there are two forms of logic, deductive and inductive. This section considers deductive logic, the next considers inductive. Categorical syllogisms. A deductive argument is one whose premises are claimed to provide conclusive, irrefutable evidence for the truth of its conclusion. A common form of deductive argument is the categorical syllogism. It is comprised of two premises and a conclusion. It is so named because it deals with logical relations between categories. It begins with a premise that states a general truth about a category, for example, all humans are mortal, and ends with a conclusion that states a truth about a specific instance, for example, Socrates is mortal. Premise 1, all humans are mortal. Premise 2, Socrates is a human. Therefore, Socrates is mortal. Notice that the argument's first premise establishes a relationship between two categories, humans and mortals. All humans are mortal. The second premise makes a statement about a particular individual member of the first category, Socrates is a human. This forces the conclusions that this individual must also be a member of the second category, Socrates is mortal. The general form of a categorical syllogism is as follows. Premise 1, all members of category A are members of category B. Premise 2, X is a member of category A. Therefore, X is a member of category B. Deductive logic has one especially attractive attribute, certainty. A conclusion arrived at by deduction is true with complete certainty, but this is so if and only if two conditions are met: the premises of the argument are true and the argument has valid form. If either condition is lacking, the conclusion is false with complete certainty. Therefore, a valid argument is defined as one whose conclusion must be true if its premises are true. Or, said differently, it is impossible for a valid argument to have true premises and a false conclusion. In summary, conclusions arrived at by deduction are either true or false. If either valid form or true premises are lacking, then the conclusion is false. If both are present, the conclusion is true. There is no middle ground. It is important to note that truth and validity are two distinct properties. Truth and its opposite, falsity, are properties that pertain to an individual proposition. A proposition is true if it conforms to fact. Because premises and conclusions are both propositions, they are aptly characterized as either true or false. The premise all pigs can fly is false. The premise Socrates is a man is true, as is the conclusion Socrates is mortal. Validity is a property that pertains to the form of an argument. In other words, validity refers to the logical relationships between the propositions comprising the argument. Validity, or lack thereof, describes the correctness of the logical inference linking the premises to the conclusion, but validity makes no reference to the factual truth of the argument's premises or conclusion. An argument is said to be valid if, when its premises are true, its conclusion must also be true. However, an argument can be valid even if it is composed of false propositions so long as the logical connections between the propositions are sound. The categorical syllogism that follows has valid form because its conclusion is logically compelled by its premises, yet its premises and conclusion are clearly untrue. All humans are immortal. Socrates is a human. Therefore, Socrates is immortal. Because validity has nothing to do with matters of fact, validity can best be demonstrated with arguments or diagrams of arguments, called Euler circles, which make no factual references whatsoever. In an Euler diagram, the set of elements comprising a category is represented by a circle. To show that one category, such as sports cars, is a subset of the more general category, cars in general, the circle representing sports cars resides within the larger circle representing cars. See Figure 3.2. Figure 3.3 makes clear why Argument 1 is valid but Argument 2 is not. Argument 1 is valid because its conclusion, X is a B, follows necessarily from i.e., is compelled by its premises. However, argument 2 is not valid because its conclusion, X is an A, is not logically compelled by its premises. X may belong to category A, but not necessarily. The Euler diagrams portray validity more forcefully than the argument itself because the argument alone requires some thinking. Argument 1, all A's are B's, X is an A, therefore X is a B. Argument 2, all A's are B's, X is a B, therefore X is an A. Conditional syllogisms, the logic of scientific arguments. Another form of deductive argument, and the one that is central to scientific reasoning, is the conditional syllogism. It is the logical basis for establishing the discovery of new knowledge. Like the categorical syllogism, the conditional syllogism is also composed of 3 propositions, 2 premises, and a conclusion. It is so named because its first premise is a conditional proposition. A conditional proposition is a compound statement that combines 2 simple propositions using the words if-then. The proposition following if is referred to as the antecedent clause, and the proposition following then is referred to as the consequent clause. The general form of a conditional proposition is, if antecedent clause, then consequent clause. For example, if it is a dog, then it has 4 legs. In the example, it is a dog is the antecedent clause and it has 4 legs is the consequent clause. A second example that is closer to the purpose at hand would be, if the TA rule has predictive power, then its back-tested rate of return will exceed 0. Our ultimate goal will be to establish the truth of the antecedent clause of these conditional propositions, like the preceding example. As will become clear, the route to establishing its truth is an indirect one. The second premise of a conditional syllogism is a proposition that either affirms or denies the truth of either the antecedent clause or the consequent clause of the first premise. Referring to the prior example, the second premise could be one of the following 4 statements. It is a dog affirms the truth of the antecedent. It is not a dog denies the truth of the antecedent. It has 4 legs affirms the truth of the consequent. It does not have 4 legs denies the truth of the consequent. The conclusion of the conditional syllogism affirms or denies the truth of the remaining clause of the first premise. In other words, the conclusion references the clause that is not mentioned in the second premise. For example, if the second premise refers to the antecedent clause of the first premise, it's a dog, then the conclusion would refer to the consequent clause, it has 4 legs. An example of a conditional syllogism is as follows: if it is a dog, then it has 4 legs. It is a dog affirms the truth of the antecedent. Therefore, it has 4 legs affirms the truth of the consequent. When a conditional syllogism possesses valid form, its conclusion is logically compelled by the 2 premises. Moreover, if it has valid form and its premises are factually true, then the conclusion of the conditional syllogisms must also be true. Valid forms of the conditional syllogism. There are 2 valid forms of the conditional syllogism: affirming the antecedent and denying the consequent. In an argument that affirms the antecedent, the second premise affirms the truth of the antecedent clause of the first premise. In an argument that denies the consequent, the second premise asserts that the consequent clause of the first premise is not true. These 2 valid forms of argument are shown here. They assume all dogs possess 4 legs. Affirming the antecedent, premise 1, if it is a dog, then it has 4 legs. Premise 2, it is a dog. Valid conclusion, therefore, it has 4 legs. In this valid form, the second premise affirms the antecedent clause by stating it is a dog. These 2 premises deductively compel the conclusion it has 4 legs. The general form of a conditional syllogism in which the antecedent is affirmed is: premise 1, if A is true, then B is true. Premise 2, A is true. Valid conclusion, therefore B is true. The other valid form of the conditional syllogism is denial of the consequent. In this form, the second premise asserts that the consequent clause of premise 1 is a falsehood. From this, one may conclude that the antecedent clause of premise 1 is also false. This is illustrated by the following example. Premise 1, if it is a dog, then it has 4 legs. Premise 2, it does not have 4 legs. Valid conclusion, therefore, it is not a dog. Denial of the consequent follows the general form. Premise 1, if A is true, then B is true. Premise 2, B is not true. Valid conclusion, therefore, A is not true. This is sometimes shortened to if A, then B, not B, therefore not A. Notice that this form of argument uses evidence creature does not have 4 legs to prove that antecedent, it is a dog, is false. It is this form of reasoning that is used in science to prove that a hypothesis is false. The hypothesis plays the role of the antecedent. We hypothesize that the creature is a dog. The consequent clause predicts what will be observed if the hypothesis is true. That is, if the creature is truly a dog, then, when it is observed, it will be seen to possess 4 legs. In other words, the conditional proposition if A, then B predicts that B would be observed in an experiment if the hypothesis, A, were in fact true. The second premise states that when the observation was made, the observation contradicted the prediction, that is, B was not observed. Given this, we can validly deduce that the hypothesis, A, is false. As will be shown in due course, if we can prove that hypothesis, A, is false, we can indirectly prove that some other hypothesis is true. That other hypothesis is the new knowledge that we wish to establish as true, for example, that a new vaccine is more effective than a placebo, or that some TA rule predicts more effectively than a randomly generated signal. Invalid form of the conditional syllogism. An important reason for using formal logic is the difficulty people often have when reasoning informally about conditional syllogisms. Consistent with the numerous biases and illusions discussed in Chapter 2, psychological studies have shown that people tend to commit 2 fallacies when reasoning about conditional propositions: the fallacy of affirming the consequent and the fallacy of denying the antecedent. An example of the fallacy of affirming the consequent is: Premise 1, if it is a dog, then it has 4 legs. Premise 2, it has 4 legs. Invalid conclusion, therefore, it is a dog. The fact that a creature has 4 legs certainly does not compel the conclusion that the creature is a dog. It may be a dog. The evidence is consistent with the fact that it is a dog. However, the evidence is also consistent with other conclusions. It could just as easily be a cow, a horse, or any other 4-legged creature. The fallacy of affirming the consequent has the general form: Premise 1, if A is true, then B is true. Premise 2, B is true. Invalid conclusion, therefore, A is true. This fallacy is a very common error in poor scientific reasoning and one committed in many articles on TA. Consider the following syllogism, which commits the fallacy of affirming the consequent. Premise 1, if TA rule X has predictive power, then it should produce profits in a back test. Premise 2, the back test was profitable. Invalid conclusions, therefore, the TA rule has predictive power. Both of these premises may be true, but the conclusion is not necessarily true. With respect to the first premise, it is true that if the TA rule X does possess predictive power, it should back test profitably. In other words, a profitable back test would be consistent with the supposition that the rule has predictive power. However, a profitable back test could also be consistent with the supposition that the rule was merely lucky. Similarly, just as evidence of 4 legs is consistent with a dog, it is also consistent with all other 4-legged creatures. The fallacy of affirming the consequent is the reason that empirical evidence cannot be used to prove that a hypothesis is true. As we shall see, one philosopher of science, Karl Popper, contended that the scientific method must, therefore, rest on denial falsification of the consequent, which, as pointed out earlier, is a valid form of inference. The other fallacy associated with conditional syllogisms is the fallacy of denying the antecedent. It is illustrated here. Premise 1, if it is a dog, then it has 4 legs. Premise 2, it is not a dog. Invalid conclusion, therefore, it does not have 4 legs. The fact that a creature is not a dog does not preclude its having 4 legs. The general form of this fallacy is: Premise 1, if A is true, then B is true. Premise 2, A is not true. Invalid conclusion, therefore, B is not true. In logical shorthand, if A, then B, not A. Therefore, not B. Invalid arguments can be hard to notice when they concern complex subjects. The best way to reveal them is to plug in commonplace items for A and B and C if the conclusion follows from the premises. Figures 3.4 and 3.5 summarize the preceding discussion of the conditional syllogism. As mentioned, the great strength of deductive reasoning is its ability to deliver conclusions that are true with certainty. However, deductive logic has a great weakness: it is unable to reveal new knowledge about the world. All that a deductive argument can do is to reveal truths that were already implicit in its premises. In other words, deductive reasoning can only tease out truths that were already present in the premises, though they may not have been evident. This is not meant to minimize or trivialize deduction, but to clarify its role. It may well be that a conclusion implied by the premises is far from obvious. Great mathematical discoveries are exactly that, the revealing of truths that had been implicit in the axioms of a mathematical system, but that had not been understood prior to being proven. Such was the case with the much publicized proof of Fermat's last theorem. It was first hinted at in the margin of a book in 1665, but not proven until 1994 by Andrew Wiles and Richard Taylor. Inductive logic. Induction is the logic of discovery. It aims to reveal new knowledge about the world by reaching beyond the knowledge contained in the premises of an inductive argument. However, this new knowledge comes with a price: uncertainty. Conclusions reached by induction are inherently uncertain, that is, they can only be true with some degree of probability. Thus, the notion of probability is intimately connected with induction. Induction proceeds in a manner opposite to deduction. We saw that deduction progresses from a premise expressing a general truth that is held to apply to an unlimited number of instances. All men are mortal to a conclusion about a specific instance. Socrates is mortal. In contrast, inductive reasoning moves, or better said, leaps from a premise based on a limited number of observed instances to a general conclusion about an unlimited number of similar but not yet observed instances. Thus, this form of inference is often referred to as inductive generalization. It is in leaping beyond what has been directly experienced by observation that induction incurs uncertainty, the possibility that its conclusion may be wrong. Inductive generalization is illustrated by the following premise: each of 1,000 healthy dogs had 4 legs. General conclusions: all healthy dogs will have 4 legs. The conclusion in this example is called a universal generalization because it asserts that all members of the class dog have the attribute 4 legs. Universal generalizations have the form, all x's are y's, or 100% of x's have the attribute y. Generalizations need not be universal. Non-universal generalizations have the form p% of x's are y's, or p% of x's have attribute y, or x's have attribute y with probability p. Again, we see that probability is inextricably tied to the concept of generalization. In fact, non-universal generalizations are also known as probabilistic generalizations. An example would be, a higher percentage of bulldogs are prone to violence than poodles. This statistically sound non-universal generalization 15 does not claim all bulldogs are prone to violent behavior, nor does it claim that even a majority are so inclined. However, it does say that, as a group, statistics show that bulldogs have a higher probability of being dangerous than poodles. Aristotle's defeat as scientist was in part attributable to his failure to appreciate that non-universal generalizations convey useful knowledge. His fascination with the certainty of deductive proofs led him to restrict his search to universal generalizations. He was unable to see that many important regularities of the natural world are inherently probabilistic. Induction by enumeration. The most common form of inductive argument is based on enumeration. It proceeds from a premise that enumerates the evidence contained in a set of observations, and then draws a general conclusion that pertains to all similar observations outside the enumerated set. Premise: over the past 20 years, there have been 1,000 instances in which TA rule X gave a buy signal, and in 700 of those instances, the market moved higher over the next 10 days. Conclusion: in the future, when rule X gives a buy signal, there is a 0.7 probability that the market will be higher at the end of 10 days. This conclusion, or any conclusion reached by induction, is inherently uncertain because it extends to observations that have not yet been made. However, some inductive arguments are stronger than others, and hence arrive at conclusions that are more certain. The strength of an inductive argument and the certainty of its conclusion depend upon the quantity and quality of the evidence enumerated in its premise. The more numerous the instances cited and the higher their quality, the more likely the conclusion will generalize accurately to future observations. Suppose that the conclusion about TA rule X had been based on only 10 instances with a 70% success rate instead of 1,000. In such a case, the conclusion would have been at least 10 times more uncertain. 0.16. This means we should be less surprised if the signal's future accuracy differs greatly from its historic success rate. In science, the evidence offered in support of a conclusion is typically evaluated with statistical methods. This allows one to make quantitative statements about the conclusion's uncertainty. This topic is discussed in chapters 5 and 6. The strength of an inductive argument also depends upon the quality of the evidence. Evidence quality is an entire subject unto itself, but suffice it to say that some observational methods produce higher quality evidence than others. The gold standard in science is the controlled experiment, where all factors but the one under study are held constant. TA does not permit controlled experiments, but there are better and worse ways to make observations. One issue that is relevant to TA is the matter of systematic error or bias. As will be discussed in Chapter 6, objective TA research is prone to a particular type of systematic error called data mining bias if careful steps are not taken. Also relevant to the strength of an inductive argument is the degree to which the evidence cited is representative of the kinds of observations that are likely to be encountered in the future. An inference about a rule that generates long/neutral plus 10 signals that was back-tested only during rising markets is unlikely to be accurate about the rule's performance in a declining market environment. Even if the rule had no predictive power, its restriction to long or neutral positions makes it likely that it would have generated a profit because it was tested during a rising market period. The most common fallacy of induction is the hasty generalization, an induction based on too little evidence or evidence of poor quality. Rule studies that cite a small number of successful signals as a basis for concluding that the rule has predictive power are likely to be hasty generalizations. The philosophy of science. The philosophy of science seeks to understand how and why science works. It explains such things as the nature of scientific propositions and how they differ from non-scientific and pseudoscientific propositions, the way scientific knowledge is produced, how science explains, predicts, and through technology harnesses nature, the means for determining the validity of scientific knowledge, the formulation and use of the scientific method, and the types of reasoning used to arrive at conclusions. That the scientific method is one of man's greatest inventions and is by far the most effective method for acquiring objective knowledge about the natural world is beyond question. The part of the world known as the Industrial West could, in its entirety, be seen as a monument to the scientific revolution. Humankind's ability to predict and control the natural world has improved more in the last 400 years, since the scientific revolution began, than it had in the prior 150,000 years that modern humans, Homo sapiens, walked the face of the earth. Strange as it may seem, the invention of the scientific method and its first fruits came before it was understood why the method worked as well as it did. That insight came gradually, over the course of several centuries, as practicing scientists and their erstwhile critics, the philosophers of science, wrestled with perfecting the method and, in parallel, developed an understanding of how and why it worked. The mere fact that the scientific method did work was not enough. It was seen as necessary to understand why. What philosophers found so vexing was the following apparent contradiction. On the one hand were the great victories of science, such as Newton's laws of motion and gravity and humanity's expanding technological control over nature. On the other was the fact that scientific knowledge was inherently uncertain because conclusions arrived at by logical induction were inherently uncertain. How could so much useful knowledge result from such a flawed method of inference? This section discusses the key steps in the method's development and the milestones in our deepening understanding of how and why it works. The reader may wish to skip this historical development and go directly to the summary of the key aspects of the scientific method. Bacon's enthusiasm. Without invitation, philosophers poke their noses into all sorts of matters. It's their nature. They tell us how to act ethics, how governments should rule, political philosophy, what is beautiful aesthetics and of greatest concern to us, What constitutes valid knowledge, epistemology, and how we should go about getting it, philosophy of science. The scientific revolution was, in part, a revolt against Aristotelian science. The Greeks regarded the physical world as an unreliable source of truth. According to Plato, mentor of Aristotle, the world was merely a flawed copy of the truth and perfection that existed in the world of forms, a metaphysical non-material realm, where archetypes of the perfect dog, the perfect tree, and every other imaginable thing could be found. When the revolt against this view of reality finally arrived, it was harsh and unremitting. The new school of thought, empiricism, resoundingly rejected the Greek paradigm. It contended that not only was the natural world worthy of study, but that careful observation could lay bare its truths. A pioneer of empiricism, and perhaps the first philosopher of science, was Francis Bacon, 1561–1626. Nature, for Bacon, was an open book that could not possibly be misread by an unprejudiced mind. In his famous work, The Novum Organum, The New Tool, Bacon extolled the power of observation and induction. He held science to be a completely objective rational practice that could conclusively confirm or falsify knowledge simply by observing without bias or prejudice, and then generalizing from those observations. In many situations, this approach seemed to work. However, empiricism was not the perfect tool Bacon and his disciples claimed, and philosophers made it their business to say why. First, they pointed out that empiricism, an observation-based enterprise, rested on a crucial assumption that could not be confirmed by observation, the assumption that nature was uniform over all time and space. That assumption was critical in justifying the empiricist's position that if a scientific law was observed to hold true here and now, it would also hold true everywhere and forever. Because the uniformity of nature assumption could not be confirmed by observation, it had to be taken on faith. Second, science often deals with phenomena and concepts that defy direct observation, atomic structure, the force of gravity, and electric fields. Though their effects are observable, these constructs could not be arrived at exclusively by observation and induction. They are better understood as human inventions that explain and predict, rather than observable physical realities. Nevertheless, Bacon's contributions to the development of the scientific method were important. He promoted the idea of experiment and made room for doubt by taking special note of discordant observations. Both ideas eluded the Greeks. Descartes' doubt. If philosophers are good for anything, it's raising doubt, and no one was better than René Descartes, 1596–1650. Regarded as the father of modern philosophy and a key figure in the birth of science, Descartes shared Bacon's skepticism for the authoritarian knowledge of the Greeks and the dogma of the Roman Church. However, Descartes was just as skeptical of the claims made by the empiricists about the power of observation and inductive generalization. His famous expression, "I think, therefore I am," expressed the position that science must start by doubting everything except the existence of the person who experiences doubt. From that point of solidity, knowledge must be built purely by deductive reasoning without being contaminated by error-prone observations made with the imperfect five senses. As a consequence of Descartes' anti-empirical stance and penchant for theorizing in a factual vacuum, his scientific findings were almost meaningless. However, his contributions to science were lasting. Skepticism is central to the scientific attitude. In addition, Descartes' invention of analytic geometry paved the way for Newton's invention of the calculus, which, in turn, allowed him to specify his famous equations of motion and gravity. Hume's critique of induction. Another dose of doubt was administered by Scottish empiricist and philosopher David Hume, 1711–1776. His seminal work, The Treatise on Human Nature, published in 1739, grappled with a central problem of epistemology: how to distinguish knowledge from lesser forms of knowing, such as opinions that happen to be true. Prior to Hume's publication, philosophers generally agreed that the distinction was related to the quality of the method used to acquire the knowledge. What justified calling one bit of wisdom knowledge, but not another, was the pedigree of the method of inquiry. Philosophers could not, however, agree on the best method of knowledge acquisition. Empiricists argued that objective observation followed by inductive generalization was the route to wisdom. Rationalists, on the other hand, contended that pure deductive reasoning from self-evident truths was the correct method. Hume took issue with both schools of thought and ultimately even with himself. As an empiricist, Hume disparaged the rationalists' purely deductive approach because it was disconnected from observed facts. Also, in the spirit of empiricism, Hume said that it was wise to adjust the strength of one's beliefs in proportion to the evidence, and that theories should be evaluated by the degree to which they matched observation. But then, Hume went on to contradict himself by attacking the logical basis of empiricism. He denied the validity of inductive generalization and disparaged the ability of science to establish causal laws. His searing critique of induction has come to be known as Hume's problem. Hume's attack on induction was on both psychological and logical grounds. First, he said the belief that induction could establish correlative or causal connections between events was nothing more than a byproduct of human psychology. Hume asserted that the perception of cause and effect was merely an artifact of the mind. The belief that A causes B or is even correlated to B simply because A has always been followed by B was nothing more than a habit of mind, and a bad habit at that. From a logical perspective, Hume claimed that induction was flawed because no amount of observed evidence, no matter how objectively collected, can compel a conclusion with the force of a valid deduction. Moreover, he said that there was no rule of induction that tells us when we have evidence of sufficient quantity or quality to justify the leap from a finite set of observations to a conclusion about an infinite number of similar but not yet observed instances. A rule of induction would itself have had to be the result of a prior valid induction made on the basis of an even earlier rule of induction, and so forth and so on, ad infinitum. In other words, an attempt to justify induction inevitably rests on an infinite regress, a logically impossible absurdity. In light of Hume's attack, supporters of induction retreated to a narrower claim saying inductive generalizations were merely correct in a probabilistic sense. So as evidence accumulates in favor of a relationship between A and B, the probability that the relationship is authentic also increases. However, philosophers were quick to point out that a probabilistic justification of induction was also flawed. As will be pointed out in Chapter 4, the probability that A predicts B is equal to the number of times that A was followed by B divided by the total number of instances of A, regardless of whether it was followed by B. Because the future holds an infinite number of instances, the probability will always be zero. No matter how numerous the past observations, any number divided by an infinitely large number is still zero. Thus, Hume and his allies created a paradox. On one hand were their seemingly valid concerns about the flaws of induction. On the other hand was the accumulation of stunning scientific discoveries. If science was based on such a flawed logic, how could it have managed to be so successful? William Whewell, The Role of Hypothesis. It took philosophers and scientists 200 years of watching the scientific method succeed to understand how it worked and why it had been so triumphant. By the middle of the 19th century, it was becoming clear that science employs a synergistic combination of inductive and deductive logic. In 1840, William Whewell, 1794–1866, published The History and Philosophy of Inductive Sciences. Whewell was the first to understand the crucial role of induction in the formulation of a hypothesis. Whewell called it a happy guess. He said that scientific discovery starts with a bold inductive leap to a new hypothesis, but it is followed by deduction. That is to say, after a hypothesis has been induced, a prediction is deduced from said hypothesis. This prediction takes the form of a conditional statement. If the hypothesis is true, then specific future observations are predicted to occur. When the observations are made, they will either be consistent with the prediction, thus confirming the hypothesis, or conflict with the prediction, thus contradicting the hypothesis. What is a scientific hypothesis? It is a conjecture of a suspected pattern, for example, X predicts Y, or X brings about Y. This conjecture is spawned by a scientist's prior experience, noticing repeated pairings of X and Y. Once the XY hypothesis has been put forward, a testable prediction is deduced from it. This takes the form of a conditional proposition, which is composed of two clauses, an antecedent and a consequent. The hypothesis serves as the antecedent clause, and the prediction serves as the consequent clause. In situations where it is merely asserted that X is correlated, predicts with Y, the following conditional proposition would apply. If X predicts Y, then future instances of X will be followed by instances of Y. In cases where the hypothesis asserts that X causes Y, the following conditional proposition would apply. If X causes Y, then if X is removed, Y should not occur. The predictions embodied in the consequent clause of the conditional proposition are then compared with new observations. These must be observations whose outcome is not yet known. This is crucial. This does not necessarily mean that the observations concern some future event. It simply means that when the prediction is made, the outcome of the observations is not yet known. In historical sciences like geology, archaeology, and so forth, the observations are about events that have already taken place. However, the outcomes have not yet been observed. If it turns out that future observations of X are not followed by Y, or if removal of X does prevent the occurrence of Y, then the hypothesis antecedent is proven to be false by the valid deductive form falsification of the consequent. If X, then Y, not Y, valid deduction, therefore not X. If, however, future instances of X are indeed followed by Y, or if the removal of X does cause the disappearance of Y, the hypothesis is not proven. Recall that affirming the consequent is not a valid deductive form. If X, then Y. Y, invalid, therefore X. That the prediction has been confirmed merely offers tentative confirmation of the hypothesis. The hypothesis survives for the moment, but more stringent tests of it are sure to follow. Whewell agreed with Hume that inductive conjecture was a habit of human thought, but the habit that Hume so disparaged Whewell regarded as fruitful though mysterious. He was unable to explain the mental processes that gave rise to such creative thoughts, though he believed inductive generalization was part of it. He called the ability to conjure a hypothesis an unteachable inventive talent, but a crucial one because, without a hypothesis, a set of observations remain nothing more than a disconnected collection of facts that could neither predict nor explain. However, with one came the breakthroughs of science. Whewell's description of this crucial creative aspect of science reminds me of a conversation I had many years ago with Charles Strauss, a prolific composer of some of Broadway's most successful musicals. In my early 20s at the time, short on tact and long on audacity, I asked him to explain how he managed to be so productive. With more forbearance than I deserved, Charles described a daily discipline of religiously sitting at the piano from 8 until 11 each morning and from 2 until 5 each afternoon, whether he felt inspired or not. He told me he treated composing music like a job. During this time, he would test tentative melodies, musical hypotheses. He modestly attributed his high productivity to 99% discipline and 1% creative talent. However, as I thought about this conversation years later, it seemed otherwise. With an almost infinite number of note combinations, his success at creating infectious tunes had to be a creative talent, some special ability to see which of those musical conjectures had the potential to be melodies, and which did not. This was what Whewell called the happy guess, that unteachable talent of seeing a theme that meaningfully relates a disparate set of observations or notes that eludes the average person. A few folks have it. The vast majority do not. Whewell's realization that proposing a hypothesis was an act of invention no less than the creation of the steam engine or the light bulb represented a profoundly important advance in thinking about science. Induction could not produce truths on its own, but it was a necessary first step. This was a profound departure from the prior notion of science as a systematic objective investigation followed by inductive generalization. Whewell saw the scientist as a creator as much as an investigator. Karl Popper, Falsification and Bringing Deduction Back into Science. In two landmark works, The Logic of Scientific Discovery and Conjectures and Refutations, Karl Popper, 1902-1994, extended the insight of Whewell and redefined the logic of scientific discovery by clarifying the role of deduction. Popper's central contention was that a scientific inquiry was unable to prove hypotheses to be true. Rather, science was limited to identifying which hypotheses were false. This was accomplished by using observed evidence in combination with the valid deductive form of falsification of the consequent. If hypothesis H is true, then evidence E is predicted to occur under specified conditions, e.g., backtest of a TA rule. Evidence E did not occur under the specified conditions. Therefore, hypothesis H is false. In taking this stance, Popper challenged the prevailing view advocated by a school of philosophy called logical positivism. Just as Francis Bacon had revolted against the strictures of the Greek tradition, Popper was in revolt against the Vienna Circle, the home of logical positivism. Logical positivists believed that observations could be used to prove hypotheses to be true. Popper demurred, saying that observed evidence could only be used to prove a hypothesis false. Science was a baloney detector, not a truth detector. Popper justified his method, called falsificationism, as follows. A given set of observations can be explained by or is consistent with numerous hypotheses. Therefore, the observed data by itself cannot help us decide which of these hypotheses is most likely correct. Suppose the data is that one of my shoes is missing. One hypothesis that might explain this observation is that I'm a disorganized housekeeper who is always misplacing things. Another hypothesis, which is equally consistent with the observation of a missing shoe, would be that my house was burglarized by a one-legged thief who only had use for one shoe. In fact, an infinite number of hypotheses could be proposed that are consistent with explain the missing shoe. We have already seen that data cannot be used logically to deduce the truth of a hypothesis. Attempts to do so commit the fallacy of affirming the consequent. However, and this is the key to Popper's method of falsificationism, data can be used to validly deduce the falsehood of a hypothesis by denial of the consequent. In other words, disconfirming evidence can be used to reveal a false explanation. For example, finding the other shoe would be evidence that would falsify the one-legged thief hypothesis. The logical argument is as follows. Premise 1. If a one-legged thief is responsible for my missing shoe, then I will not find the shoe in my home. Premise 2. Missing shoe is found, consequent denied. Conclusion, therefore, the one-legged thief hypothesis is false. Popper's method of falsification runs against the grain of common sense, which is biased in favor of confirmatory evidence. As pointed out in Chapter 2, intuition often tells us to test the truth of a hypothesis by seeing if confirmatory evidence can be found. We do so under the mistaken impression that confirmatory evidence is sufficient to establish truth. However, using evidence in this way commits the fallacy of affirming the consequent. We are not wrong to suspect that confirmatory evidence should be found if the hypothesis is true, but we are wrong to think that confirmatory evidence is sufficient to establish its truth. Said differently, confirmatory evidence is a necessary condition of a proposition's truth, but not a sufficient condition. Popper's point was that the absence of necessary evidence is sufficient to establish the falsity of a hypothesis, but the presence of necessary evidence is not enough to establish its truth. Having 4 legs is a necessary condition of a creature being a dog, but the presence of 4 legs is not sufficient to establish that a creature is a dog. However, the observation that the creature does not have 4 legs is sufficient to falsify the contention it is a dog. Popper's logic of falsification can be seen as a protection against the confirmation bias that infects informal inference, see Chapter 2. One final example may help clarify the power of falsifying evidence and the weakness of confirmatory evidence. It is the famous problem of the black swan posed by philosopher John Stuart Mill, 1806-1873. Suppose we wish to ascertain the truth of the proposition, all swans are white. Mill said, and Popper concurred, that no matter how many white swans have been observed, that is, no matter how voluminous the confirmatory evidence, the proposition's truth is never proven. A black swan may lurk just around the next corner. This is the limitation of induction that so upset Hume. However, by merely observing a single non-white swan, one may declare with certitude that the proposition is false. The conditional syllogism below shows that the falsity of the proposition all swans are white is based on the valid deductive form falsification of the consequent. Premise 1. If it is true that all swans are white, then all future observations of swans will be white. Premise 2. A. Non-white swan is observed. Valid conclusion. The proposition that all swans are white is false. The general form of argument used to test a hypothesis under Popper's method of falsification is Premise 1. If the hypothesis is true, then future observations are predicted to have property X. Premise 2. An observation occurs that lacks property X. Valid conclusion. Therefore, hypothesis is false. As will be seen in chapters 4 and 5, this is the logic used to test statistical hypotheses, the provisional and cumulative nature of scientific knowledge. One implication of Popper's method of falsification is that all existing scientific knowledge is provisional. Whatever theory is currently accepted as correct is always a target for empirical challenge, and the possibility of its being replaced by a more correct theory always exits. Today, Einstein's theory of relativity is taken as correct. Though its predictions have withstood countless tests, tomorrow a new test may show it to be false or incomplete. Thus, science is a never-ending cycle of conjecture, prediction, testing, falsification, and new conjecture. It is in this way that the body of scientific knowledge continually evolves toward an ever more accurate representation of objective reality. In most instances, when older theories are replaced, it is not because they are proven false so much as they are shown to be incomplete. When Newton's laws of motion were replaced by Einstein's theories, Newtonian physics was still mostly correct. Within the limited domain of everyday experience, where bodies travel at normal speeds approximately less than 90% of the speed of light, Newton's laws still held true. However, Einstein's theory was correct in a wider domain, which not only included the motions of everyday objects, but also objects traveling up to and including the speed of light. In other words, Einstein's theory, which built upon Newton's, was more general and thus subsumed it. The net result of building upon prior successful ideas, those whose predictions have been confirmed, and pruning away wrong ideas, those whose predictions have been falsified, is a body of knowledge that continually improves. This cannot be said of any other intellectual discipline, where new styles are introduced, but where newer is not necessarily better. The fact that a scientist in any field of science knows more today than even the best one living just a generation ago is beyond debate. However, whether gangster rap is better or worse than Mozart could be argued endlessly. The restriction of science to testable statements. Another implication of Popper's method is that science must restrict itself to testable hypotheses, propositions that generate predictions about observations not yet made. To say that a hypothesis has been tested and has survived or has been tested and falsified means that predictions deduced from it have either been confirmed or contradicted by new observations. The comparison of predictions with new observations is the crucial mechanism that fosters the continual improvement of scientific knowledge. For this reason, propositions that do not generate testable predictions must be excluded from the domain of scientific discourse. The term prediction, in the context of hypothesis testing, warrants some clarification, because TA is essentially an enterprise dedicated to prediction. When we speak of prediction as it pertains to testing a hypothesis, it does not necessarily mean foretelling the future, though the predicted observations may indeed lie in the future. Rather, the term prediction refers to the fact that the observation's outcomes are not yet known. Predictions made in historical sciences, such as geology, refer to events that have already taken place perhaps eons ago. For example, geology's dominant theory, plate tectonics, may predict that specific geologic formations that were created millions of years ago would be observed if an investigation of some specific location were to be carried out tomorrow. In finance, the efficient markets hypothesis predicts that if a TA rule were to be back-tested, its profits, after adjustment for risk, would not exceed the risk-adjusted return of the market index. Once the prediction has been deduced from the hypothesis, the operations necessary to produce the new observations are carried out. They may involve a visit to the location of the predicted geologic formation or the back test of the TA rule. Then, it becomes a matter of comparing prediction with observation. Measuring the degree of agreement between observation and prediction, and making the decision about whether the hypothesis is left intact or falsified is what statistical analysis is all about. What is important from the standpoint of science is that the hypothesis is able to make predictions about observations whose outcomes are not yet known. This is what allows a hypothesis to be tested. Observations whose outcomes are known cannot serve this purpose because it is always possible to fashion an explanation after the fact that is consistent with said observations. Therefore, activities that are unable or unwilling to make testable predictions, thus opening them to the possibility of falsification, do not qualify as scientific. The demarcation problem, distinguishing science from pseudoscience. An important consequence of Popper's method was that it solved a key problem in the philosophy of science, defining the boundary between science and non-science. The domain of science is confined to propositions, conjectures, hypotheses, claims, theories, and so forth that make predictions that are open to refutation with empirical evidence. Popper referred to such propositions as falsifiable and meaningful. Propositions that cannot be challenged in this manner are unfalsifiable or meaningless. In other words, they do not say anything of substance, something that sets up a testable expectation. Unfalsifiable propositions may appear to assert something, but in fact they do not. They cannot be challenged because they do not say with any degree of specificity what can be expected to happen. In effect, they are not informative. Hence, the falsifiability of a proposition is related to its information content. Falsifiable propositions are informative because they make specific predictions. They may prove to be wrong, but at least they say something of substance. A proposition that cannot generate falsifiable predictions essentially says any outcome can happen. For example, a weather forecast that says it will be cloudy or sunny, wet or dry, windy or calm, and cold or hot allows for all possible outcomes. It cannot be falsified. The only thing good that can be said about it is that its lack of information is completely obvious. The problem is that pseudoscientists and pseudo-forecasters are clever about the way they word their predictions so as to obscure their lack of information and non-falsifiability. Consider the astrologer's forecast: you will meet a tall, dark stranger, and your life will be changed. This statement is impossible to refute no matter what the outcome. Should you ever go back for a refund, you will be given one of two answers. 1. Be patient, you will meet the stranger soon, or 2. You already did meet a dark stranger and your life is indeed different, but you are oblivious to the change. These answers cannot be challenged because the prediction was vague. It neither stated when your life would change or in what measurable, verifiable manner. This is a far cry from the prediction. Before 7:00 p.m. next Wednesday, you will see a man wearing one red shoe, walking east on 42nd Street, whistling Satin Doll. By 7 p.m. next Wednesday, the evidence will be in, and you will have had the opportunity to evaluate the prediction as true or false. Even if the prediction turns out to be false, it was at least falsifiable, allowing you to decide if future visits to the astrologer are worthwhile. The infomercial pitchmen that inhabit late-night television are masters of the meaningless claim. Wearing our copper bracelet will improve your golf game. What does improve mean? How is it to be measured, and when? As with the astrologer's forecast, the claim's vagueness makes it impossible to deduce a testable, falsifiable prediction. However, it is quite easy to imagine after-the-fact anecdotal evidence that is seemingly confirmatory. Holy cow, I feel so much more relaxed wearing my copper bracelet. I used to get all tensed up before teeing off. Now my drives seem straighter. Last week I almost had a hole in one, and I don't curse nearly as much as I used to. My wife even says I look more handsome in my golf outfit, and I think my hair has stopped falling out. Although meaningless claims invite confirmatory anecdotes, they are protected from objective falsifying evidence. The claimant never gets nailed, and the claim gains support from seemingly confirmational anecdotal reports. In contrast, the statement, "Wearing a copper bracelet will increase the length of your drives by 25 yards, is informative and meaningful because it generates a testable prediction. You hit 100 golf balls not wearing the copper bracelet and determine their average distance. The next day, do the same thing while wearing a copper bracelet and get their average distance. Repeat this alternating series of experiments for 10 days. If the drives on copper bracelet days are less than 25 yards better, evidence refuting the claim would be in hand. Limitations of Popper's method. As important as Popper's method of falsification is to modern science, it has been criticized on a number of grounds. Critics assert that Popper's contention that hypotheses can be definitively falsified overstates matters. Although the observation of a black swan can neatly and logically falsify the universal generalization that all swans are white, the hypotheses of real science are far more complex and probabilistic, non-universal. They are complex in the sense that a newly proposed hypothesis rests on numerous auxiliary hypotheses that are assumed to be true. Thus, if a prediction deduced from the new hypothesis is later falsified, it is not clear whether the new hypothesis was in error or one of the many auxiliary hypotheses was incorrect. This proved to be the case when the solar system's eighth planet, Neptune, was discovered. The aberrant path of Uranus was not due to flaws in Newton's laws, but in the auxiliary hypothesis that the solar system contained only 7 planets. However, when the theory did fail early in the 20th century, it was indeed because of imperfections in Newton's laws. Doing real science is tricky business. TA is a long way from facing these problems because we are still at the point of scratching the data for reliable predictive rules. Moreover, because many of the hypotheses of science are probabilistic, as would be the case in TA, an observation that contradicts the hypothesis can never be taken as certain evidence of falsity. The aberrant observation may be a chance occurrence. It is here that statistical analysis enters the picture. As will be pointed out in chapters 4 and 5, the decision to reject a hypothesis on the basis of observed evidence runs a certain probability of being wrong. Statistics helps us quantify this probability. Despite these and other limitations that go beyond our concerns here, Popper's contributions to the development of the scientific method have been enormous. The information content of scientific hypotheses. To recap, a hypothesis is informative if it can make testable predictions. This opens it to the possibility of being found false. Thus, the falsifiability of a hypothesis and its information content are related. Within the domain of scientifically meaningful hypotheses, there are degrees of information content and falsifiability. Some hypotheses are more information-rich and hence more falsifiable than others. When Popper referred to a bold conjecture, he was speaking of a highly informative hypothesis from which many falsifiable predictions could be deduced. The scientist's job, therefore, is to continually attempt to refute an existing hypothesis and to replace it with an even more informative one. This spurs the improvement of scientific knowledge. An information-rich hypothesis makes many precise, narrow-ranged predictions about a broad range of phenomena. Each prediction presents an opportunity to show the hypothesis is false. In other words, the more informative a hypothesis, the more opportunities it presents for falsification. In contrast, low information, timid hypotheses make fewer or less precise predictions. Consequently, they are more difficult to falsify. For example, a TA rule that claims high profitability on any instrument in any time frame makes a bold and information-rich claim that could be falsified by showing that it is unprofitable on one market in one time frame. In contrast, a method that only claims to be marginally profitable on S&P futures on the 1-week bar time scale is timid, has low information content, and is hard to falsify. The only opportunity to refute it would be limited to backtest of the S&P 500 on a weekly showing that was not at all profitable. Some TA methods that are seemingly informative are not. Elliott wave principle is a case in point. On the surface, it bravely proclaims that all price movement in all markets over all time scales can be described by a single unifying principle. This proposition is seemingly confirmed by the ability of EWP practitioners to produce a wave count for any prior segment of price data. In fact, EWP is timid to the point of being meaningless because it makes no falsifiable predictions of future price motion. A second case in point, one more pleasing to the TA community, is the efficient markets hypothesis, M. In this context, the term efficiency refers to the speed with which prices reflect all known and knowable information that is relevant to the future returns of an asset. In an efficient market, relevant information is presumed to be reflected in price almost instantaneously. EMH comes in three flavors. In descending order of boldness, information content, and falsifiability they are EMH strong, EMH semi-strong, and EMH weak. EMH strong asserts that financial markets are efficient with respect to all information, even private inside information. This version predicts that all investment strategies, be they based on an inside tip from the president about an impending takeover, or based on public information of a fundamental or technical nature, will be useless in earning market-beating excess returns. This most audacious version of EMH is also seemingly the most informative and falsifiable because any evidence of abnormal profits from any investment strategy whatsoever, irrespective of the type of information or form of analysis used, would be sufficient to refute EMH strong. However, because information that is known privately can never be confirmed, this version is not testable in a practical sense. The semi-strong version of EMH makes a less informative and narrower claim, saying that the market is only efficient with respect to public information. This version of EMH can be falsified with any evidence of market-beating returns produced by an investing strategy based on either public fundamental data, PE ratios, book values, and so forth, or technical data, relative strength rank, volume turnover ratios, and so forth. In effect, EMH semi-strong denies the utility of fundamental and technical analysis. Finally, we have EMH weak, which makes the least bold and least informative claim. It asserts that the market is only efficient with respect to past price, volume, and other technical data. Because EMH weak only denies the utility of technical analysis, it presents the smallest and hardest to hit target by would-be falsifiers. Their only hope would be to present evidence that shows excess returns generated by an investment strategy based on TA. Because EMH weak is the hardest version to falsify and is thus the least likely to be proven false, its falsification would also generate the most surprise. In other words, of all versions of EMH, falsification of EMH weak would generate the biggest increase in knowledge. This points out a general principle of science. The largest gains in knowledge occur when the most timid and hardest to falsify hypotheses are falsified. A test showing that inside information, like the tip from a corporate president, was able to generate excess returns, i.e., falsification of EMH strong would not be surprising, nor would we learn very much from it. Big deal, so inside information generates profits. What else is new? In contrast, the falsification of EMH weak would be a highly informative event for both TA practitioners and EMH supporters. Not only would it mean the final destruction of the EMH, an important principle of finance for over 40 years, but it would be an important confirmation of TA's validity. Both would represent large changes in the current state of knowledge. Thus, it can be said that the gain in knowledge that occurs upon falsification of a hypothesis is inversely related to its information content. Likewise, it can be said that the knowledge gained by confirmation of a hypothesis, observations consistent with its predictions, is directly related to the information content of the hypothesis. The most informative hypotheses make the most audacious claims of new knowledge. They attempt to bring within the realm of understanding the broadest range of phenomena with the greatest degree of precision, while at the same time involving the fewest assumptions. When such a hypothesis is falsified, we are not very surprised, nor do we learn very much. Few would have expected the hypothesis to be confirmed, except perhaps for the bold scientist proposing it. For example, suppose a bold new theory of physics is put forward, one of whose predictions is that it is possible to build an anti-gravity device. If true, such a theory would represent a major increase in knowledge. However, if the device fails to work, no one would be surprised by the prediction's failure. However, it is exactly the opposite when a timid hypothesis is falsified. For example, a timid hypothesis would be one that merely asserts that the currently accepted theories of physics are true, and predicts that the anti-gravity device should fail. The falsification of this weak hypothesis via observations of the anti-gravity device working would result in a very significant gain in knowledge, the verification of new physics. The most timid hypothesis that can be put forward is one that asserts that there have been no new discoveries. In other words, it says that all that is currently known is all that there is to know. This hypothesis denies the truth of any other hypothesis that asserts that something new has been discovered. The timid hypothesis that asserts that nothing new had been discovered has a special name in science. It is called the null hypothesis, and it is the starting assumption in the investigation of any claim that a new discovery has been made. Whether that claim asserts that a new vaccine will cure a dreaded disease, that a new principle of physics tells us how to nullify gravity, or that a TA rule has predictive power, we always start by assuming that the null hypothesis is true. Then, if evidence can be produced that falsifies the null hypothesis, a most timid claim, it generates a big gain in knowledge. Thus, science proceeds as follows. Every time a bold new hypothesis is put forward, it spawns an opposing claim, the null hypothesis. The null is as timid as the new hypothesis is bold. Jonas Salk's bold hypothesis that his vaccine would prevent polio better than a placebo spawned a competing claim, the null hypothesis. It made the timid prediction that the vaccine's ability to prevent infection would be no better than a placebo. This was a timid prediction because every prior attempt to develop a vaccine against polio had failed. These two competing claims left no middle ground. If one hypothesis could be falsified by logic's law of the excluded middle, we know that the other must be true. Salk's experimental evidence made it clear that the rate of infection among those receiving the real vaccine was significantly less than those receiving the placebo. In other words, it was sufficient to falsify the null's prediction. This was a surprising result that represented a huge increase in medical knowledge, how scientists should respond to falsification. How should a scientist respond when a hypothesis or theory that has survived many prior tests is ultimately falsified because recent observations conflict with predictions? The proper response is whatever leads to the biggest increase in knowledge. Because scientists are human beings, they sometimes fail to do what is scientifically correct. There are two possible responses that increase knowledge. The first is to preserve the existing hypothesis by using it to predict new, previously unknown facts. If these new facts are confirmed and can explain why the observations that had been in conflict with the hypothesis are no longer in conflict, then the hypothesis deserves to be retained. The new facts represent an increase in what we know about the world. A second proper response is to throw out the old hypothesis and propose a new one that not only accounts for all observations that had been explained by the prior hypothesis, but also explains the new discordant observations. This also represents an increase in knowledge in the form of a new hypothesis, with greater explanatory or predictive power. However, in either case, the correct response is to do whatever advances the frontier of knowledge the most. Unfortunately, the interests of science sometimes take a back seat to personal agendas. Human nature gets in the way of good science. Emotional, economic, and professional ties to a prior hypothesis can motivate attempts to explain away the discordant evidence in a way that reduces the information content and falsifiability of their cherished hypothesis. This moves the frontier of knowledge backward. Fortunately, science is a collective self-correcting enterprise. The community of scientists happily takes their fallen brothers to task when they stray from the path of righteousness in this way. Some examples will clarify these abstract concepts. First, I present an example of a proper response to predictions being contradicted by new observations. In this case, new facts were predicted to rescue an established theory from falsification. This high road was taken by two astronomers during the 19th century, and it led to new knowledge in the form of a new planet being discovered. At that time, Newton's laws of motion and gravity were the accepted physics of planetary motion. They had been confirmed and reconfirmed by countless observations, but then, to the surprise of astronomers of that day, new and more powerful telescopes showed the planet Uranus was deviating from the orbit predicted by Newton's laws. A rigid and improper application of falsificationism would have called for an immediate rejection of Newtonian mechanics. However, all theories rest on a bed of auxiliary assumptions. A key assumption in this case was that the solar system contained only 7 planets, with Uranus being the 7th and furthest from the Sun. This led astronomers Adams and Leverrier to boldly predict the existence of a yet undiscovered 8th planet, the new fact, lying beyond Uranus. If this were true, that new planet's gravitational effects could explain the aberrant motion of Uranus, which seemed to be in conflict with Newton's laws. In addition, if an 8th planet did exist, one of Newton's laws would predict the exact spot in the sky where the new planet would be observable. This was a bold, informative, and highly falsifiable prediction that put Newton's laws to a most stringent test. The astounding prediction made by Adams and Leverrier about where the new planet would appear in the sky was indeed confirmed in 1846 with the discovery of Neptune. They saved Newton's laws from falsification by demonstrating that the theory was not only able to explain the deviant behavior of Uranus, but was also able to make a highly accurate prediction. This is the kosher way to retain a theory when it is confronted with dissonant observations. In the end, however, Newton's laws proved to be provisionally true, as is ultimately the case for all laws and theories. Although Newton's laws had worked perfectly for more than 200 years, early in the 20th century, more precise astronomical observations were found to be truly inconsistent with the theory's predictions. The old theory had finally been falsified, and it was time for a new one. In 1921, Albert Einstein responded properly by putting forward his new and more informative theory of general relativity. Today, almost 100 years later, Einstein's theory has survived all attempts to falsify it. Newton's theory qualified as scientific because it was open to empirical refutation. In fact, Newton's theory was not wrong so much as it was incomplete. Einstein's general theory of relativity not only accounted for all of the phenomena covered by the Newtonian model, but it accommodated the new observations that conflicted with Newton's more limited theory. This is how science progresses. Longevity and seniority mean nothing. Predictive accuracy and explanatory power are everything. The case of Adams and Leverrier make clear why claims must be open to empirical refutation. Falsifiability alone gives scientific knowledge a large advantage over conventional wisdom. The ability to jettison false or incomplete ideas and replace them with ever more informative ones produces a body of knowledge that is self-correcting and in a continual state of improvement. This in turn provides a stable base upon which new ideas can be erected that reach ever higher levels of understanding. Intellectual activities that have no procedure for eliminating erroneous knowledge inevitably get bogged down in nonsense. This is precisely the problem with the popular version of TA. The precedent for this knowledge-regressive method of immunizing the EMH hypothesis against falsification had already been established by earlier flawed defenses of EMH. These earlier and similarly misguided efforts to save EMH were in response to studies that had shown that public fundamental information, such as the price-to-book ratio and PE ratio, could be used to generate excess returns. In response to this inconvenient evidence, EMH defenders claimed that low price-to-book ratios and low PE ratios were merely signals of stocks with abnormally high risk. In other words, the fact that a stock's price is low relative to its book value is an indication that the company is facing difficulties. Of course, this reasoning is circular. What is key here is the fact that EMH advocates had not defined low price to book or low PE as risk factors in advance of the studies showing that stocks with these traits were able to earn excess returns. Had EMH theorists done so, they would have bolstered the information content of EMH with an additional dimension of risk. Instead, EMH theorists invented these risk factors after the fact, for the specific purpose of explaining away discordant observations that had already been made. Such explanations are termed ad hoc hypotheses, explanations invented after the fact for the specific purpose of saving a theory or hypothesis from being falsified. Popper referred to this knowledge regressive, save the theory at any cost behavior as falsification immunization. Had Popper known of it, he would have chastised the die-hard supporters of EMH, but he would have probably applauded the efforts of those advocating behavioral finance. This relatively new field has proposed testable hypotheses that explain the profitability of strategies based on public technical and fundamental data as arising from the cognitive biases and illusions of investors. It is ironic that erroneous beliefs in the validity of subjective TA and the valid profitability of some forms of objective TA may both be the result of cognitive foibles. The scientific attitude, open yet skeptical. Falsificationism makes a clear distinction between two phases of scientific discovery, proposal and refutation. These phases demand different mindsets, openness and skepticism. The coexistence of these opposite mindsets defines the scientific attitude. An attitude of openness to new ideas is vital when hypotheses are being formulated. The willingness to see things in a new way, to advance new explanations and take bold inductive leaps characterizes the proposal phase. Most practitioners of TA function well in this mode. New indicators, new systems, and new patterns get proposed all the time. However, once a bold conjecture has been made, receptivity must morph into skepticism. Doubt about the new idea motivates a relentless search for its flaws. Thus, there is an ongoing tension in the scientist's mind between speculative curiosity and hard-nosed disbelief. However, the doubt is not an unremitting skepticism, but one that yields to persuasive new evidence. This is the quasi-schizoid state that defines the scientific attitude. Beyond the distrust of the new hypothesis, another form of skepticism thrives in the mind of a scientist, doubt about the mind itself. This springs from a profound awareness of the all-too-human tendency to generalize hastily and leap to unfounded conclusions. See Chapter 2. The procedures of science can be seen as safeguards against these tendencies. The end result, the hypothetico-deductive method. Some would say there is no such thing as the scientific method. The scientific method, as far as it is a method, is nothing more than doing one's damnedest with one's mind no holds barred. At its essence, it is intelligent problem-solving. The problem-solving method used in science today has come to be known as the hypothetico-deductive method. It is commonly described as having 5 stages: observation, hypothesis, prediction, verification, and conclusion. In actual scientific work, these stages are so intertwined that it would be hard to fit the history of any scientific investigation into this rigid scheme. Sometimes the different stages are merged or blurred, and frequently they do not occur in the sequence listed. Rather, it is a useful way to think about the process. The hypothetico-deductive method was initiated by Newton in the 17th century, but was not formally named until after Popper's contributions were introduced. It is the outgrowth of several hundred years of tussling between scientists and philosophers. The method integrates both inductive and deductive logic, paying heed to their individual limits while leveraging their respective powers. The 5 stages. 1. Observation. A possible pattern or relationship is noticed in a set of prior observations. 2. Hypothesis. Based on a mysterious mixture of insight, prior knowledge, and inductive generalization, it is hypothesized that the pattern is not an artifact of the particular set of observations, but one that should be found in any similar set of observations. The hypothesis may merely assert that the pattern is real scientific law, or it may go further and offer an explanation about why the pattern exists, scientific theory. 3. Prediction. A prediction is deduced from the hypothesis and embodied in a conditional proposition. The proposition's antecedent clause is the hypothesis, and its consequent clause is the prediction. The prediction tells us what should be observed in a new set of observations if the hypothesis is indeed true. For example, if the hypothesis is true, then X should be observed if operation O is performed. The set of outcomes defined by X makes clear which future observations would confirm the prediction, and more importantly, which future observations would be in conflict with it. 4. Verification. New observations are made in accordance with the operations specified and compared to the predictions. In some sciences, the operation is a controlled experiment. In other sciences, it is an observational study. 5. Conclusion, an inference about the truth or falsity of the hypothesis, is made based on the degree to which the observations conform to the prediction. This stage involves statistical inference methods such as confidence intervals and hypothesis tests, which are described in chapters 4 and 5. An example from TA. The following is an example of the hypothetico-deductive method as it would be applied to testing a new idea about technical analysis. 1. Observation. It is noticed that when a stock market index, such as the Dow Jones Average or the S&P 500, rises above its 200-day moving average, it generally continues to appreciate over the next several months. Probabilistic generalization. 2. Hypothesis. On the basis of this observation, inductive generalization, and prior findings of technical analysis, we propose the following hypothesis. Upward penetrations of the 200-day moving average by the GIA will, on average, produce profitable long positions over the next 3 months. I'll refer to this hypothesis as 200H. 3. Prediction. On the basis of the hypothesis, we predict that an observational investigation or back test will be profitable. The hypothesis and the prediction are turned into the following conditional statement. If 200H is true, then the back test will be profitable. However, this prediction creates a logical problem. Even if the back test is profitable, it will not be helpful in proving the truth of 200H because, as previously pointed out, while a profitable back test would be consistent with the truth of 200H, it cannot prove that 200H is true. An attempt to do so would commit the fallacy of affirming the consequent C argument 1 below. If, on the other hand, the back test turns out to be unprofitable, it would be valid to conclude 200H is false by the valid logical form falsification of the consequent. See argument 2 below. Argument 1. Premise 1. If 200H is true, then a back test will be profitable. Premise 2. The back test was profitable. Invalid conclusion, therefore 200H is true. Fallacy of affirming the consequent. Argument 2. Premise 1. If 200H is true, then a back test will be profitable. Premise 2. The back test was not profitable. Valid conclusion, therefore 200H is false. However, our objective is to prove the truth of 200H. To get around this logical problem, suppose we had formulated a null hypothesis at stage 2, specifically, upward penetrations of a 200-day moving average do not generate profits over the following 3 months. Let's refer to this as null 200. From this, we can formulate the following conditional proposition. If null 200 is true, then a back test will not be profitable. If the back test does turn out to be profitable, we can validly argue that the null hypothesis has been falsified, falsifying the consequent. By the law of the excluded middle, either 200H is true or null 200 is true. There is no middle ground, there is no other hypothesis possible. Thus, by disproving the null, we will have indirectly proven that 200H is true. Thus, we have the following conditional syllogism. Premise 1. If null 200 is true, then the back test will be unprofitable. Premise 2. The back test was not unprofitable, i.e., it was profitable. Valid conclusion. Null 200 is false, therefore 200H is true. 4. Verification. The proposed rule is back-tested and its profitability is observed. 5. Conclusion. Determining the meaning of the results is a matter of statistical inference, the topic treated over the next 3 chapters. Rigorous and critical analysis of observed results. The 5th phase of the hypothetico-deductive method points to another important difference between science and non-science. In science, observed evidence is not taken at face value. In other words, the obvious implication of the evidence may not be its true implication. The evidence must be subjected to rigorous analysis before a conclusion can be drawn from it. The evidence of choice in science is quantitative data, and the tool of choice for drawing conclusions is statistical inference. An important scientific principle is the preference for simpler explanations, Occam's razor. As such, astounding hypotheses are given serious consideration only after more commonplace hypotheses have been rejected. Sightings of a UFO are not immediately interpreted as evidence of an alien visit. More mundane accounts such as ball lightning, weather balloons, or a new aircraft must first be discredited before an invasion from outer space is taken seriously. Thus, a scientific attitude toward an extraordinarily profitable rule-back test would first consider and reject other explanations before entertaining the possibility that a significant TA rule has been discovered. The possible explanations of good performance unrelated to a rule's predictive power are good luck due to sampling error, see chapters 4 and 5, and systematic error due to data mining bias, see chapter 6. Summary of key aspects of the scientific method. The following is a summary of the key points of the scientific method. No matter how voluminous the evidence, the scientific method can never conclusively prove a hypothesis to be true. Observed evidence used in combination with the deductive form falsification of the consequent can be used to disprove a hypothesis with a specified degree of probability. Science is restricted to testable hypotheses. Propositions that are not testable are not within the domain of scientific discourse and are considered to be meaningless. A hypothesis is testable if and only if predictions about yet to be made observations can be deduced from the hypothesis. A hypothesis that can only explain past observations, but that cannot make predictions about new observations, is not scientific. A hypothesis is tested by comparing its predictions with new observations. If predictions and observations agree, the hypothesis is not proven, but merely receives tentative confirmation. If they don't agree, the hypothesis is taken to be false or incomplete. All currently accepted scientific knowledge is only provisionally true. Its truth is temporary until a test shows it to be false, at which point it is replaced or subsumed by a more complete theory. Scientific knowledge is cumulative and progressive. As older hypotheses are shown to be false, they are replaced by newer ones that more accurately portray objective reality. Science is the only method of inquiry or intellectual discipline which can claim that newer is better. Though knowledge, styles, and methods in other disciplines, such as music, art, philosophy, or literary criticism, may change over time, it cannot be claimed that new is necessarily better. Any set of past observations data can be explained by an infinite number of hypotheses. For example, Elliott wave theory, Gann lines, classical chart patterns, and a roster of other interpretive methods can all explain past market behavior according to their own paradigm of analysis. Therefore, all these explanations are said to be empirically equal. The only way to decide which ones are better is by seeing how well they can predict observations whose outcomes are not yet known. Those methods that cannot generate testable, falsifiable predictions about new observations can be eliminated immediately on the grounds that they are scientifically meaningless. Those methods that can generate predictions that are found to conflict with future observations can be eliminated on grounds that they have been falsified. Thus, only methods that can make testable predictions that display genuine predictive power deserve to be retained in the body of TA knowledge. If TA were to adopt the scientific method. This section examines consequences of TA adopting the scientific method. The elimination of subjective TA. The most important consequence of TA adopting the scientific method would be the elimination of subjective approaches. Because they are not testable, subjective methods are shielded from empirical challenge. This makes them worse than wrong. They are meaningless propositions devoid of information. Their elimination would make TA an entirely objective practice. Subjective TA would be eliminated in one of two ways, by transformation into objective methods or abandonment. Perhaps Gann lines, subjective divergences, trend channels, and a host of subjective patterns and concepts embody valid aspects of market behavior. In their present subjective form, however, we are denied this knowledge. Transforming a subjective method into an objective version is not trivial. To illustrate a case where this has been done, I discuss an algorithm for the automated diction of head and shoulder patterns, and test results in the section Objectification of Subjective TA, an example. Elimination of meaningless forecasts. It is not practical to assume that all subjective practitioners will follow my call to objectify or close-up shop. For those who continue to use subjective approaches, there is an important step that can be taken to make their output, if not their methodology, objective. Henceforth, they would issue only falsifiable forecasts. This would at least make the information they provide meaningful and informative. In this context, informative does not necessarily mean correct, but rather that the forecasts have cognitive content that passes the discernible difference test discussed in the introduction. In other words, the forecast would convey something of substance, the truth of which can be clearly determined by subsequent market action. In other words, the forecast will make explicit or clearly imply which outcomes would show it to be wrong. As stated previously, a forecast that does not make clear what future events constitute prediction errors in essence says that any outcome can happen. At the present time, most subjective forecasts, often referred to as market calls, are meaningless. In all likelihood, this is not obvious to either consumers or the analysts issuing the forecasts. First, consider a forecast that is clearly meaningless. My indicators are now predicting the market will either go up an infinite percentage, down 100%, or something in between. On its face, the statement is unfalsifiable because there is no outcome that could possibly conflict with the prediction. The only good thing about the forecast is that its lack of meaning and lack of falsifiability are transparent. A more typical market call goes something like this: on the basis of my indicators, I am bullish. This unfalsifiable statement is just as meaningless, but its lack of substance is not obvious. Though there is a prediction of a rise, the prediction leaves unclear when it might occur or under what circumstances the prediction would be wrong. This bullish stance could have been made meaningful by clearly excluding certain outcomes. For example, I expect the market to rise more than 10% from current levels before it declines by more than 5% from current levels. Any instance of a decline of greater than 5% before a rise of 10% would be sufficient to classify the forecast as an error. If you ever suspect that you are being fed a meaningless prediction, here are some good antidotes. Ask the following question: how much adverse movement opposite to the direction predicted would have to occur for you to admit this forecast is mistaken? Or what outcomes are precluded by your prediction? Or when and under what conditions can the forecast be evaluated, such as the passage of time, change in price, adverse or favorable, or a specific indicator development? Reader, I warn you not to do this if you are squeamish about watching people squirm. Making subjective forecasts meaningful with an upfront statement of when and how the forecast will be evaluated would eliminate the market gurus after-the-fact wiggle room. Some ways of adding meaning to a subjective forecast include 1. Defining a future point in time when the forecast will be evaluated. 2. Defining the maximum degree of adverse movement that would be allowed without declaring the prediction wrong. And 3. Predicting a specified magnitude of favorable movement prior to a specified magnitude of unfavorable movement. X% favorable before Y% unfavorable. Steps like these would allow a subjective practitioner to develop a track record of meaningful market calls. Meaningful track records can also result from specific transaction recommendations made in real time. One limitation of this recommendation is that it would still leave unclear what the profitable track record represents. This is because subjective forecasts are derived in an undefined way, so even if a profitable track record of meaningful predictions is built up over time, it cannot be known that they were the result of a consistent analysis procedure that can be repeated in the future. In fact, it is likely that the method of analysis is not stable over time. Studies of expert subjective judgment indicate that experts do not combine information in a consistent manner from one judgment to the next. Intuitive judgments suffer from serious random inconsistencies due to fatigue, boredom, and all the factors that make us human. In other words, given the exact same pattern of market data at different times, it is quite possible that a subjective analyst would not give the same forecast. Paradigm shift. Refashioning TA into an objective practice would be what Thomas Kuhn calls a paradigm shift. In his highly influential book, The Structure of Scientific Revolutions, Kuhn rejected Popper's notion that science evolves strictly by falsification and conjecture. Instead, Kuhn saw the evolution of a science as a sequence of paradigms or worldviews. While a given paradigm is in place, Practitioners indoctrinated in that point of view confine their activities to posing questions and hypotheses that are consistent with and answerable within that view. A large number of TA analysts have been indoctrinated with the non-scientific intuitive analysis paradigm developed by TA pioneers like Dow, Gann, Schabacker, Elliott, Edwards, and Maggi, and so forth. They established the subjective research tradition and postulated the background wisdom that is accepted as true and taught to aspiring practitioners. The certification exam given by the Market Technicians Association to aspiring Chartered Market Technicians, CMT, exemplifies this tradition. The shift to an evidence-based objective approach would challenge much of this material as either meaningless or not sufficiently supported by statistical evidence. Many of the teachings will go the way of early Greek physics and astronomy. Some methods will survive objectification and statistical testing and will warrant a position in a legitimate body of TA knowledge. Lest the reader think my position too harsh, I am not advocating that the falsifiability criterion be used to cut off all research in budding TA methods, just as they are being formulated. Many of the brilliant theories of science began as half-backed pre-scientific ideas on the wrong side of the falsifiability criterion. These ideas needed time to develop, and one day some turned into meaningful science. One example in TA is the new field of socionomics, an outgrowth of Elliott wave theory. At the current time, I regard this newly developing discipline as pre-scientific, though it may have the potential to become a science. According to a conversation I had with Professor John Knopfsinger, who is working within the field of socionomics, at this time the discipline is not yet able to make testable predictions. This will require the quantification of social mood, the key determinant of market movement according to socionomics. Nascent areas of research such as this and others should not be short-circuited simply because they are not at this time able to generate testable predictions. One day they may be able to do so. Objectification of subjective TA, an example. One of the challenging aspects of moving TA to a science will be transforming subjective chart patterns into objectively defined testable patterns. This section presents an example of how two academic technicians, Keeving Chang and Carol Osler, C&O, objectified the head and shoulders pattern. Not all elements of their pattern are included here. Rather, I have included enough of their rules and the problems they faced and solved to illustrate the challenges of transforming a subjective method into an objective one. For further details, please refer to their original articles. Descriptions of the head and shoulders pattern can be found in many TA texts 43 and are typically accompanied by a diagram similar to the one in Figure 3.8. It represents the pattern as a sequence of noise-free price swings. When the pattern manifests in perfect textbook form, even a beginning student of TA can spot it. The problem occurs when an actual chart pattern departs from this ideal. Even seasoned chartists can debate whether a given pattern qualifies as a legitimate head and shoulders, an unavoidable consequence of the lack of an objective pattern definition. Subjective pattern definitions generally describe how the head and shoulders pattern should look, but they do not provide clear rules for discriminating patterns that do qualify as head and shoulders from patterns that possess some head and shoulders-like features but do not qualify. In other words, the definitions lack clear rules for which patterns to exclude. This problem is conceptualized in Figure 3.6. Without objective rules for deciding what does and what does not qualify as a legitimate head and shoulders pattern, it is impossible to evaluate the pattern's profitability or predictive power. The solution to the problem is to define objective rules that discriminate valid head and shoulders patterns from those that are not. This notion is illustrated in Figure 3.7. The challenge of turning a subjective pattern into an objective one can be thought of as the problem of defining the pattern as a clear subset in the superset of all possible TA price patterns. C&O defined the head and shoulders top pattern as composed of 5 pivot or price reversal points that in turn define the pattern's 3 peaks and 2 troughs. These pivots are denoted by letters A through E on Figure 3.8. All 8 texts consulted by C&O were clear that the head, denoted by letter C, must be higher than the 2 surrounding peaks shoulders, denoted by letters A and E. There has been some debate among chartists about several auxiliary features including the Adam's apple, the double chin, and the cowlick. However, the TA manuals consulted by C&O were inconsistent on these aspects and they were not included. One challenge that faces the real-world chartist is the fact that actual price oscillations do not trace out clearly identifiable peaks and troughs. Rather, peaks and troughs occur at numerous oscillation scales from tiny waves lasting minutes to very large ones lasting years or decades. This property, called fractal scaling, imposes a burden on the subjective analyst trying to identify a head and shoulders pattern. The analyst must visually filter the price behavior to isolate peaks and troughs at one particular scale of interest. This is relatively easy in retrospect, but it is quite difficult as the pattern is actually unfolding in real time. C&O addressed this problem by using a percentage filter, also known as an Alexander filter 45 or a zigzag indicator, which is discussed by Merrill in filtered waves. It is an objective method for identifying peaks and troughs as prices evolve. Troughs are identified after prices have moved up from a recent price low by an amount greater than a specified threshold percentage, and peaks are identified after prices have moved down from a recent price high by the threshold percentage. The problem is that the identification occurs with a time lag, the time it takes for prices to move the threshold amount. For example, if the threshold is set at 5%, then a peak is not detected until prices have fallen at least 5% from the most recent price maximum, and troughs are not detected until prices have risen at least 5% from the recent price minimum. The minimum required price movement causes a lag between the time the peak or trough actually occurred and the time at which it is detected by the zigzag filter. Next, C&O addressed how to determine the correct threshold percentage to define the zigzag filter. Different filter thresholds would reveal head and shoulders patterns of different size scale. For example, a 3% filter might reveal a head and shoulders pattern that a 10% filter would completely ignore. This makes it possible for multiple head and shoulders patterns of differing scale to exist simultaneously. C&O addressed this problem by subjecting each financial instrument, stock, or currency to 10 different zigzag filters, employing a range of threshold values. This allowed them to identify head and shoulders patterns on a variety of scales. This raised yet another problem. What should the 10 filter thresholds be? Clearly, a set of thresholds that would be good for one instrument may not be good for another because they are characterized by different levels of volatility. Realizing this, C&O take each instrument's recent volatility into account to arrive at the set of 10 filter thresholds used for that instrument. This insight allowed their head and shoulders algorithm to generalize across markets with different volatilities. C&O defined a market's volatility, V, as the standard deviation of daily percentage price changes over the most recent 100 trading days. The 10 thresholds were arrived at by multiplying V by 10 different coefficients: 1.5, 2.0, 2.5, 3.0, 3.5, 4.0, 4.5, 5.0, 5.5, 6.0. This resulted in 10 zigzag filters with varying sensitivity. The validity of the set of coefficients chosen by C&O were confirmed by visual inspection of price charts by TA practitioners, who agreed that the 10 zigzag filters did a reasonable job of identifying head and shoulders patterns. Next, C&O addressed the problem of defining rules that qualify a candidate pattern as a valid head and shoulders. These rules were applied to the instrument once its price had been zigzag filtered and the peaks and troughs at a given scale had been identified. First, the head and shoulders identified by C&O's algorithm had to satisfy the following basic rules. 1. The head of the pattern must be higher than both the left and right shoulders. 2. The instrument must be in an uptrend prior to the formation of the head and shoulders pattern. Thus, the pattern's left shoulder has to be above the prior peak, PP, and the pattern's left trough has to be above the prior trough, PT. Next, C&O grappled with more subtle and complex issues to qualify a candidate pattern as a valid head and shoulders. They accomplished this with a set of innovative measurements that qualified the pattern in terms of its vertical and horizontal symmetry and the time it took for the pattern to complete. These rules allowed them to definitively label a candidate pattern as either head and shoulders or a non-head and shoulders. Vertical symmetry rules. The vertical symmetry rules exclude patterns with necklines that are too steeply sloped. The pattern in Figure 3.9 has acceptable vertical symmetry. The rules compare the price levels of the right and left shoulders, A and E, and the price levels of the right and left troughs, B and D, with a price level defined by the midpoint of segment A, B, designated as point X, and the midpoint of segment DE designated as point Y. To qualify as a vertically symmetrical head and shoulders, the pattern must satisfy the following rules. 1. The price level of the left shoulder peak, point A, must exceed the price level of point Y. 2. The price level of the right shoulder peak, point E, must exceed the price level of point X. 3. The price level of the left trough, point B, must be less than the price level of point Y. 4. The price level of the right trough, point D, must be less than the price level of point X. Figures 3.10 and 3.11 show two head and shoulders patterns that would be excluded because the vertical symmetry criteria have not been satisfied. Horizontal symmetry rule. Another feature used by C and O to distinguish head and shoulders patterns from non-head and shoulders patterns was horizontal symmetry. A pattern with good horizontal symmetry is one for which the head, at point C, is roughly equidistant from the peaks representing the pattern's two shoulders, points A and E. C and O's rule was that the distance from the head to one shoulder should not be greater than 2.5 times the distance of the head to the other shoulder. There is nothing magical about the value 2.5 other than it seemed reasonable. See Figure 3.12. Figure 3.13 is an example of a pattern that fails the test for horizontal symmetry. Note the right shoulder is stretched too far to the right. A pattern with excessive leftward stretch would also be disqualified. Pattern completion rule, maximum time to neckline penetration. C and O also specified a rule that excludes patterns that take too long to penetrate the neckline once the right shoulder, point E, has been formed. As with other features, this criterion is defined in terms of the pattern's internal proportions rather than some fixed number of time units. This allows the rule to be applied to all patterns irrespective of their time frame or scale. The maximum time allowed for the movement from the right shoulder, point E, until the penetration of the neckline is the temporal distance separating the two shoulders, points A and E. The pattern in Figure 3.14 meets the time to completion criterion because the temporal distance from the right shoulder until neckline penetration, D4, is less than the temporal separation of the shoulders, D3. The pattern in Figure 3.15 does not qualify because D4 exceeds D3. Future information leakage, look-ahead bias. In their simulation of head and shoulders patterns, C and O took precautions against the future information leakage or look-ahead bias problem. This problem afflicts back tests that assume the possession of knowledge that was not truly available when a trading decision was made. In the context of back testing, this can make results appear more profitable than would be possible in actual trading. An extreme example would be assuming access to the Wall Street Journal the day before its publication. In the context of back testing the head and shoulders pattern, future information leakage can occur if the zigzag threshold percentage is larger than the percentage distance between the right shoulder peak and the neckline. It would not be legitimate to assume a short sales signal due to a neckline penetration until the right shoulder, point E, has been detected. However, it is possible for prices to cross the neckline before the right shoulder is identified by the zigzag filter. To clarify, suppose the right shoulder, point E, lies only 4% above the neckline, but the threshold for the zigzag filter is 10%. It would not be legitimate to assume that a trader knew about the neckline penetration because a 10% decline from the right shoulder would have been required to identify the right shoulder of the head and shoulders pattern. In this example, assuming an entry price only 4% below the right shoulder would be more favorable than waiting for a price 10% below the right shoulder, the price movement required to have a fully formed head and shoulders pattern. To avoid this problem, C&O assumed an entry after the right shoulder had been objectively identified by the zigzag filter. Though this was a less favorable entry price in some instances, the back test was unencumbered by look-ahead bias. I mention this because it shows C&O's attention to detail. C&O's pattern definition also deals with numerous other issues regarding entry and exit of positions, stop-loss levels, and so forth, but the point has been made that it is possible to transform subjective chart patterns into objective testable patterns. Readers may take exception to arbitrary aspects of C&O's pattern. All well and good if the reader has a better objective definition to offer. As a final sanity check, C&O showed patterns that had been identified by their automated head and shoulders algorithm to a number of chartists. C&O claimed that the chartists agreed that the patterns identified by the objective head and shoulders algorithm did indeed conform to subjective head and shoulders criteria. Head and shoulders back test results. Does the head and shoulders pattern carry predictive information with respect to stocks or currencies? In a word, the pattern hailed as a cornerstone of charting is a bust. Tests by C&O show that it is worthless on stocks and only modestly profitable on currencies. The pattern was profitable in 2 out of 6 currencies tested, but the relatively complicated head and shoulders algorithm was far outperformed by a much simpler objective signal based on zigzag filters. Moreover, when C&O tested the occurrence of a head and shoulders in conjunction with the zigzag rule, either as a confirming or disconfirming signal, the head and shoulders pattern added no value. In other words, zigzag signals did no better when the head and shoulders signal was in the same direction as the zigzag signal, and the zigzag did no worse when the head and shoulders signal was in the opposite direction. The bottom line for currency traders, the value of head and shoulders is doubtful. The head and shoulders performed worse on stocks. C&O evaluated the head and shoulders on 100 randomly selected equities over the period from July 1962 until December 1993. On average, each stock gave 1 head and shoulders signal per year, counting both long and short signals, giving a sample of over 3,100 signals. To test the pattern's profitability on actual stock prices, C&O established a benchmark based on the pattern's performance on pseudo-price histories. These simulated price histories were generated from actual historical price changes strung together in a random fashion. By using actual price changes, the pseudo-price histories had the same statistical characteristics as real stocks, but any predictability due to authentic temporal structure, the structure TA patterns are intended to exploit, was eliminated despite the fact that the pseudo-price histories were randomly generated. Head and shoulders patterns that fit C&O's definitions still emerged. This confirms the results of Harry Roberts referred to earlier. If the head and shoulders patterns appearing in real stock data are useful, they should generate profits superior to those achieved by trading the patterns appearing in the fake stock price histories. C&O found that head and shoulders patterns in actual stock prices lost slightly more money than the signals on pseudo-price histories. According to the study, the results uniformly suggest that head and shoulders trading are not profitable. The signals lose on average about 0.25% over a 10-day holding period. This compares with an average loss of 0.03% for head and shoulders patterns in the pseudo-stock data. C&O referred to traders using the pattern as noise traders, speculators who mistake a random signal for an informative one. Confirming C&O's findings is the work of Lowe et al. Lowe used an alternative method of objectifying the H&S pattern based on kernel regression, a sophisticated local smoothing technique. Their study was unable to unseat the null hypothesis that the head and shoulders pattern is useless. Bulkowski found the head and shoulders was profitable, but his research falls short. He does not provide an objective pattern definition that back testable pattern or entry and exit rules. In other words, his study is subjective TA. In addition, his results fail to adjust for the trend of the general stock market over the time period in which he tested the patterns. Subsets of TA. Given the preceding discussion, TA can be seen as comprised of 4 subsets. 1. Subjective TA. 2. Objective TA with unknown statistical significance. 3. Objective TA that is not statistically significant, and 4. Objective TA that is statistically significant. The first subset, subjective TA, has already been defined as methods that cannot be reduced to a back-testable algorithm. Subsets 2, 3, and 4 refer to objective methods. The second subset is comprised of objective methods of unknown value. Though these methods are objective and may have been back-tested, their results have not been evaluated for statistical significance. Here, it is simply a matter of applying the methods discussed in chapters 4, 5, and 6. This is not meant to suggest that applying statistical methods to back-test results is simple, but rather that the decision to do so is. The third subset, which I refer to as useless TA, consists of objective TA rules for which results have been comprehensively back-tested and evaluated with statistical methods, but have been reveled to add no value either on a standalone basis or when used in combination with other methods. In all likelihood, the majority of objective TA methods will fall into this subset. This is to be expected because financial markets are extremely difficult to predict due to their inherent complexity and randomness. In fact, in all fields of science, most proposed ideas do not work. Important discoveries are rare. This is not obvious because the numerous failures are typically not reported in the lay press or even in scientific journals. What is most important is having a procedure in place for getting rid of methods that do not work. The fourth subset, useful TA, consists of objective methods that produce statistically significant or, better yet, economically significant results. Though some rules will be useful on a standalone basis, the complexity and randomness of financial markets make it likely that most rules will add value when used in combination with other rules to form complex rules. Evidence-based technical analysis, EBTA, refers to subsets 3 and 4, objective TA that has been back-tested and subjected to statistical analysis. Given the preceding discussion, the categorization of TA is illustrated in Figure 3.16. The next 3 chapters discuss the application of statistical analysis to back-test results. Chapter 4, Statistical Analysis. Statistics is the science of data. In the late 19th century, renowned British scientist and author H.G. Wells, 1866-1946, said that an intelligent citizen in a 20th century free society would need to understand statistical methods. It can be said that an intelligent 21st century practitioner or consumer of TA has the same need. This chapter and the next 2 address aspects of statistics that are particularly relevant to TA. Statistical methods are not needed when a body of data conveys a message loudly and clearly. If all people drinking from a certain well die of cholera, but all those drinking from a different well remain healthy, there is no uncertainty about which well is infected, and no need for statistical analysis. However, when the implications of data are uncertain, statistical analysis is the best, perhaps the only, way to draw reasonable conclusions. Identifying which TA methods have genuine predictive power is highly uncertain. Even the most potent rules display highly variable performance from one data set to the next. Therefore, statistical analysis is the only practical way to distinguish methods that are useful from those that are not. Whether or not its practitioners acknowledge it, the essence of TA is statistical inference. It attempts to discover generalizations from historical data in the form of patterns, rules, and so forth, and then extrapolate them to the future. Extrapolation is inherently uncertain. Uncertainty is uncomfortable. The discomfort can be dealt with in 2 ways. One way is to pretend it does not exist. The other is the way of statistics, which meets uncertainty head-on by acknowledging it, quantifying it, and then making the best decision possible in the face of it. Bertrand Russell, the renowned British mathematician and philosopher, said, "Uncertainty in the presence of vivid hopes and fears is painful, but must be endured if we wish to live without the support of comforting fairy tales." Many people are distrustful or disdainful of statistical analysis, and statisticians are often portrayed as nerdy number-crunching geeks divorced from reality. This shows up in jokes. We deride what we do not understand. There is the story about the 6-foot-tall man who drowns in a pond with an average depth of only 2 feet. There's the tale about 3 statisticians who go duck hunting. They spot a bird flying overhead. The first shoots a foot too far to the left. The second shoots a foot too far to the right. The third jumps up and exclaims, "We got it?" Even though the average error was 0, there was no duck for dinner. Powerful tools can be put to bad purpose. Critics often charge that statistics are used to distort and deceive. Of course, similar ends can be achieved with words, although language is not held liable. A more rational stance is needed. Rather than viewing all claims based on statistics with suspicion, or taking them all at face value, a more mature response would be to learn enough about statistics to distinguish honest, useful conclusions from skullduggery or foolishness. He who accepts statistics indiscriminately will often be duped unnecessarily. But he who distrusts statistics indiscriminately will often be ignorant unnecessarily. The middle ground we seek between blind distrust and blind gullibility is an open-minded skepticism. That takes an ability to interpret data skillfully. A preview of statistical reasoning. Statistical reasoning is new terrain for many practitioners and consumers of TA. Trips to strange places are easier when you know what to expect. The following is a preview of the next 3 chapters. For reasons discussed in Chapter 3, it is wise to start with the assumption that all TA rules are without predictive power and that a profitable backtest was due to luck. This assumption is called the null hypothesis. Luck, in this case, means a favorable but accidental correspondence between the rule's signals and subsequent market trends in the historical data sample in which the rule was tested. Although this hypothesis is a reasonable starting point, it is open to refutation with empirical evidence. In other words, if observations contradict predictions made by the null hypothesis, it is abandoned and the alternative hypothesis, that the rule has predictive power, would be adopted. In the context of rule testing, evidence that would refute the null hypothesis is a back-tested rate of return that is too high to be reasonably attributed to mere luck. If a TA rule has no predictive power, its expected rate of return will be 0 on detrended 5 data. However, over any small sample of data, the profitability of a rule with no predictive power can deviate considerably from 0. These deviations are manifestations of chance, good or bad luck. This phenomenon can be seen in a coin toss experiment. Over a small number of tosses, the proportion of heads can deviate considerably from 0.50, which is the expected proportion of heads in a very large number of tosses. Generally, the chance deviations of a useless rule from a 0 return are small. Sometimes, however, a useless rule will generate significant profits by sheer luck. These rare instances can fool us into believing a useless rule has predictive power. The best protection against being fooled is to understand the degree to which profits can result from luck. This is best accomplished with a mathematical function that specifies the deviations from 0 profits that can occur by chance. That is what statistics can do for us. This function, called a probability density function, gives the probability of every possible positive or negative deviation from 0. In other words, it shows the degree to which chance can cause a useless rule to generate profits. Figure 4.1 shows a probability density function. The fact that the density curve is centered at a value of 0 reflects the null hypothesis assertion that the rule has an expected return of 0. In Figure 4.2, the arrow indicates the positive rate of return earned by a rule when it was back-tested. This raises the question, is the observed rate of return sufficiently positive to warrant a rejection of the null hypothesis that the rule's true rate of return is 0? If the observed performance falls well within the range of the deviations that are probably attributable to chance, the evidence is considered to be insufficient to reject the null hypothesis. In such a case, the null hypothesis has withstood the empirical challenge of the backtest evidence, and a conservative interpretation of the evidence would suggest that the rule has no predictive power. The strength of the backtest evidence is quantified by the fractional area of the probability density function that lies at values equal to or greater than the rule's observed performance. This portion of the density function is depicted by the darkened area to the right of the vertical arrow in figure 4.2. The size of this area can be interpreted as the probability that a rate of return this high or higher could have occurred by chance under the condition that the rule has no predictive power. Expected return equals 0, or the null hypothesis is true. When this area occupies a relatively large fraction of the density curve, it means that there is an equivalently large probability that the positive performance was due to chance. When this is the case, there is no justification for concluding that the null hypothesis is false. In other words, there is no justification for concluding that the rule does have predictive power. However, if the observed performance is far above 0, the portion of the probability density function lying at even more extreme values is small. Performance, this positive, would be inconsistent with the assertion that the rule has no predictive power. In other words, the evidence would be sufficient to refute the null hypothesis. Another way to think of this is as follows. If the null hypothesis were true, a level of performance this positive would have a low probability of occurrence. This probability is quantified by the proportion of the density function that lies at values equal to or greater than the observed performance. This is illustrated in figure 4.3. Note that the observed performance lies in the extreme right tail of the density curve that would pertain if the rule were devoid of predictive power. It is important to understand what this evidence does not tell us. It tells us nothing about the probability that either the null hypothesis or the alternative hypothesis is true. It only speaks to the probability that the evidence could have occurred under the assumption that the null hypothesis is, in fact, true. Thus, the probability speaks to the likelihood of the evidence, not the likelihood of the truth of the hypothesis. Observed evidence that would be highly improbable under the condition that the null hypothesis is true permits an inference that the null hypothesis is false. Recall that in Chapter 3, it was shown that evidence that a creature has 4 legs cannot conclusively establish the truth of the hypothesis. The creature is a dog. Although evidence of 4 legs would be consistent with the hypothesis that the creature is a dog, it is not sufficient to prove deductively that the creature is a dog. Similarly, while the observation of positive performance would be consistent with the hypothesis that a rule has predictive power, it is not sufficient to prove that it does. An argument that attempts to prove the truth of a hypothesis with observed evidence that is consistent with the hypothesis commits the logical fallacy of affirming the consequent. If the creature is a dog, then it has 4 legs. The creature has 4 legs. Invalid conclusion, therefore, the creature is a dog. If a rule has predictive power, then it will have a profitable back test. Back test was profitable. Invalid conclusion, therefore, rule has predictive power. However, the absence of 4 legs is sufficient to prove that the hypothesis, the creature is a dog, is false. In other words, observed evidence can be used to conclusively prove that a hypothesis is false. Such an argument uses the valid deductive form, denial of the consequent. The general form of an argument in which the consequent is denied is as shown. If P is true, then Q is true. Q is not true. Valid conclusion, therefore, P is not true, i.e., P is false. If the creature is a dog, then it has 4 legs. Creature does not have 4 legs. Valid conclusion, therefore, it is false that the creature is a dog. The argument just given uses the evidence, the absence of 4 legs, to conclusively falsify the notion that the creature is a dog. However, this level of certitude is not possible in matters of science and statistics. One can never conclusively falsify a hypothesis. Nevertheless, a similar logic can be used to show that certain evidence is highly unlikely if the hypothesis were true. In other words, the evidence gives us grounds to challenge the hypothesis. Thus, a highly profitable backtest can be used to challenge the hypothesis that the rule has no predictive power, i.e., that it has an expected return of 0. If a rule's expected return is equal to 0 or less, then a backtest should generate profits that are reasonably close to 0. The back-tested performance was not reasonably close to 0. In fact, it was significantly above 0. Valid conclusion, therefore, the contention that the rule's expected return is equal to 0 or less is likely to be false. How unlikely or rare must the positive performance be to reject the notion that the rule is devoid of predictive power? There is no hard and fast rule. By convention, most scientists would not be willing to reject a hypothesis, so unless the observed performance has a 0.05 probability or less of occurrence under the assumption the null is true. This value is called the statistical significance of the observation. The discussion so far pertains to the case where only one rule is backtested. In practice, however, TA rule research is typically not restricted to testing a single rule. Economical computing power, versatile backtesting software, and plentiful historical data make it easy, almost inviting, to test many rules with the aim of selecting the one with the best performance. This practice is known as data mining. Although data mining is an effective research method, testing many rules increases the chance of a lucky performance. Therefore, the threshold of performance needed to reject the null hypothesis must be set higher, perhaps much higher. This higher threshold compensates for the greater likelihood of stumbling upon a useless rule that got lucky in a back test. This topic, the data mining bias, is discussed in Chapter 6. Figure 4.4 compares two probability density functions. The top one would be appropriate for evaluating the significance for a single rule back test. The lower density curve would be appropriate for evaluating the significance of the best performing rule out of 1,000 back-tested rules. This density curve takes into account the increased likelihood of luck that results from data mining. Notice that if this best rule's observed performance were to be evaluated with the density curve appropriate for a single rule, it would appear significant because the performance is far out in the right tail of the distribution. However, when the best rule's performance is evaluated with the appropriate probability density function, it does not appear statistically significant. That is to say, the rule's rather high performance would not warrant the conclusion that it has predictive power or an expected return that is greater than zero. The need for rigorous statistical analysis. The tools and methods of a discipline limit what it can discover. Improvements in them pave the way to greater knowledge. Astronomy took a great leap forward with the invention of the telescope. Though crude by today's standards, the earliest instruments had 10 times the resolving power of the unaided eye. Technical analysis has a similar opportunity, but it must replace informal data analysis with rigorous statistical methods. Informal data analysis is simply not up to the task of extracting valid knowledge from financial markets. The data blossoms with illusory patterns, whereas valid patterns are veiled by noise and complexity. Rigorous statistical analysis is far better suited to this difficult task. Statistical analysis is a set of well-defined procedures for the collection, analysis, and interpretation of data. This chapter and the next two will introduce the way statistical tools and reasoning can be used to identify TA rules that work. This overview is necessarily condensed, and in many instances I have sacrificed mathematical rigor for the sake of clarity. However, these departures do not dilute the essential message. If TA is to deliver on its claims, it must be grounded in a scientific approach that uses formal statistical analysis. An example of sampling and statistical inference. Statistical reasoning is abstract and often runs against the grain of common sense. This is good and bad. Logic that runs counter to informal inference is good because it can help us where ordinary thinking lets us down. However, this is exactly what makes it difficult to understand. So we should start with a concrete example. The central concept of statistical inference is extrapolating from samples. A sample of observations is studied, a pattern is discerned, and this pattern is expected to hold for extrapolated to cases outside the observed sample. For example, a rule observed to be profitable in a sample of history is projected to be profitable in the future. Let's begin to think about the concept in the context of a problem that has nothing to do with technical analysis. It comes from an excellent book, Statistics, a new approach by Wallis and Roberts. The problem concerns a box filled with a mixture of white and gray beads. The total number of beads and the numbers of gray and white beads are unknown. The task is to determine the fraction of beads that are gray in the entire box. For purposes of brevity, this value will be designated as FG, fraction gray in box. To make this situation similar to statistical problems faced in the real world, there is a wrinkle. We are not allowed to view the entire contents of the box at one time, thus preventing a direct observation of FG. This constraint makes the problem realistic because, in actual problems, observing all the items of interest, such as all beads in the box, is either impossible or impractical. In fact, it is this constraint that creates the need for statistical inference. Although we are not allowed to examine the box's contents in its entirety, we are permitted to take samples of 20 beads at a time from the box and observe them. So our strategy for acquiring knowledge about FG will be to observe the fraction of gray beads in a multitude of samples. In this example, 50 samples will be taken. The lowercase fg stands for the fraction of gray beads in a sample. A sample is obtained as follows. The bottom of the box contains a sliding panel with 20 small depressions, sized so that a single bead is captured in each depression. The panel can be slid out of the box by pushing it with a similar panel that takes its place. This keeps the remaining beads from dropping out of the bottom. Consequently, each time the panel is removed, we obtain a sample of 20 beads and have the opportunity to observe the fraction gray Fg in that sample. This is illustrated in Figure 4.5. After the fraction of gray beads Fg in a given sample has been determined, the sample beads are placed back into the box, and it is given a thorough shaking before taking another sample of 20. This gives each bead an equal chance of winding up in the next sample of 20. In the parlance of statistics, we are making sure that each sample is random. The entire process of taking a sample, noting the value Fg, putting the sample back in the box, and shaking the box is repeated 50 times. At the end of the whole procedure, we end up with 50 different values for Fg, one value for each sample examined. By placing each sample back in the box before taking another sample, we are maintaining a stable concentration for the fraction of gray beads in the box. That is to say, the value for Fg is kept constant over the course of the 50 samplings. Problems in which the statistical characteristics remain stable over time are said to be stationary. If the beads were not replaced after each sample, the value Fg would change over the course of the 50 samplings, as groups of beads were permanently removed from the box. A problem in which the statistical characteristics change over time is said to be non-stationary. Financial markets may indeed be non-stationary, but for pedagogical purposes, the box of beads problem is designed to be stationary. It is important to keep in mind the distinction between Fg and Fg. Fg refers to the fraction of gray beads in the entire box. In the language of statistics, all the observations in which we are interested are called a population. In this example, the term population refers to the color of all the beads in the box. The term sample refers to a subset of the population. Thus, Fg refers to the population while Fg refers to the sample. Our assigned task is to gain as much knowledge as possible about the value of Fg by observing the value Fg over 50 separate samples. It is also important to keep clear the distinction between two numbers: the number of observations comprising a sample, in this case 20 beads, and the number of samples taken, in this case 50. Probability experiments and random variables. Probability is the mathematics of chance. A probability experiment is an observation on or a manipulation of our environment that has an uncertain outcome. This would include actions such as noting the precise time of arrival after a long trip, observing the number of inches of snow that falls in a storm, or the face of a coin that appears after the tossing of a coin. The quantity or quality observed in a probability experiment is called a random variable, such as the face of a coin after a flip, the number of inches of snow that fell, or a value that summarizes a sample of observations, e.g., a sample average. This quantity or quality is said to be random because it is affected by chance. Whereas an individual observation of a random variable is unpredictable by definition, a large number of observations made on a random variable may have highly predictable features. For example, on a given coin toss, it is impossible to predict head or tails. However, given 1,000 tosses, that the number of heads will lie within a specified range of 500 is highly predictable. Depending on how it is defined, A random variable assumes at least two different values, though it can assume more, perhaps even an infinite number. The random variable in a coin toss, the face visible after the toss, can assume two possible values, heads or tails. The random variable, defined as the temperature at noon taken at the base of the Statue of Liberty, can assume a very large number of values, with the number limited only by the precision of the thermometer. Sampling, the most important probability experiment. The most important probability experiment in statistical analysis is sampling. It involves the extraction of a subset of observations from a population. Here, the random variable at issue is called a sample statistic. It is any computable characteristic of the sample. The value Fg is an example of a sample statistic. Sampling can be done in a number of different ways, but it is crucial that the observations that are selected for the sample be chosen in a random manner and that they be selected independently of each other. This means that all observations that could possibly end up in the sample have an equal chance of doing so. Because no particular observation has a better chance of appearing in the sample than any other, the observations that wind up in the sample do so by chance. Samples must be constructed in this manner because the principles of probability, upon which statistical reasoning rests, assume that the observations that wind up in the sample got there randomly. Consider the test of a new medicine on a sample of volunteers. The sample must be constructed so that anyone who might eventually take the medicine has an equal chance of being selected for the test group. If the subjects in the experiment are not selected this way, the results of the test will not lead to a sound conclusion. A medical experiment that selects test subjects who are expected to respond favorably to the medication will produce a biased conclusions. In other words, the estimates of the medication's efficacy in the general population will be too optimistic. Imagine taking a single bead at random from the box with your eyes closed and then observing its color. This is a sampling experiment with a sample size of 1. The bead's color, gray or white, is the random variable. Now imagine randomly selecting 20 beads from the box. Here the sample size is 20 and the fraction gray in that sample, Fg, is a sample statistic that is also a random variable. As discussed earlier, we will call this random variable Fg. It is a random variable because its value is affected by chance. It can assume 21 different values: 0, 0.05, 0.10, 0.15, 1.0. Now let's get back to the goal, increasing our knowledge about the value of Fg, the knowledge gleaned from one sample. Suppose the first sample contains 13 gray beads out of 20. The value of the sample statistic Fg is 0.6513/20. What does this tell us about Fg? With only this information, some might be tempted to conclude that we have solved the problem, and that 0.65 is the fraction gray for the entire box, i.e., Fg equals 0.65. This view tacitly and naively assumes that a single sample can provide perfect knowledge. At the opposite extreme are those who just as wrongly conclude that the sample is too small to supply any information. Both conclusions are wrong. First, there is no basis for thinking that we could acquire perfect knowledge from one sample. Though it is possible that a single sample of 20 beads might be a perfect replica of the entire contents of the box, it is not likely. For example, if the true value of Fg were 0.568, a 20-bead sample could never produce such a value. An Fg value of 0.55, 11 gray of 20, is as close as one could get. 10 gray beads in the sample would give an Fg of 0.50, 11 would give 0.55, and 12 would give 0.60. Those who assert that nothing has been learned are also mistaken. On the basis of this sample alone, two possibilities can be eliminated. We can reject with absolute certainty that Fg equals 1.0, i.e., all beads gray because there were 7 white beads in the sample. With equal certainty, we can reject the proposition that Fg is 0 because there were 13 gray beads in the sample. However, more precise estimates of Fg on the basis of the single observed value of Fg are subject to uncertainty. Even if we were to take numerous samples and have numerous values of Fg, the value of Fg would remain uncertain. This is because a sample is, by definition, a partial representation of the full contents of the box. Only by observing every bead in the population could all uncertainty about FG be eliminated, and this is prohibited. However, with what has been learned from the single sample, some intelligent guesses can be made that go beyond the certain knowledge that FG is neither 0 nor 1.0. For example, although a claim that FG is as low as 0.10 cannot be conclusively ruled out, no one would take it seriously. The observed FG value of 0.65 obtained from the first sample is too far above 0.10 for it to be a credible estimate of FG. If FG really were as low as 0.10, the probability of getting a sample with an FG of 0.65 would seem unlikely just based on common sense. We could apply the same kind of logic to dispense with a claim that FG equals 0.95. An FG reading of 0.65 would seem too low if the entire box were composed of 95% gray beads. The bottom line, it is fair to say that a single sample does provide some knowledge about FG, what can be learned from 50 samples. Greater knowledge about FG can be obtained by analyzing more samples. Assume another 49 samples are taken and the value FG for each sample is measured. The first thing we would notice is that FG varies in an unpredictable fashion from sample to sample. This particular form of random behavior is one of the most important phenomena in all of statistics. It is called sampling variability or sampling variation. Sampling variation is important because it is responsible for the uncertainty in statistical conclusions. Greater sampling variability translates to greater uncertainty. The greater the fluctuations in FG from one sample to the next, the greater will be the uncertainty about the value of FG. Regrettably, this important phenomenon, sampling variability, is unfamiliar to many people who analyze data. This is understandable because real-world problems do not offer the luxury of looking at more than one independent sample. The box of beads provides this opportunity. As will be seen, by conducting 50 sampling experiments, the random variation in FG becomes obvious. This is quite different from the situation faced by rule researchers. They typically have a single historical sample of the market, and if all that data is used to test a rule, only one observed value of the performance statistic is obtained. This provides no opportunity to see how the rule's performance would vary if it were tested in numerous independent samples. The bottom line is this: sampling variation is an important fact that may not be obvious to data analysts unfamiliar with statistical analysis. This is a huge blind spot. Sampling variation can be seen in a table of the 50 FG values. See Table 4.1. Not surprisingly, the value of FG, a random variable, fluctuates from sample to sample. This is an example of chance in operation. However, FG's value is not entirely determined by chance. Its value is also strongly influenced by the value of FG, the proportion of gray beads in the entire box. Thus, it can be said that each observed value of FG is the result of two influences: the underlying phenomenon, FG, and randomness caused by sampling. FG acts like a center of gravity, always keeping FG within a certain range. In some samples, randomness nudged the value FG above FG. In other samples, randomness nudged FG below FG. From sample to sample, the value of FG oscillates randomly around this center of gravity. This is sampling variability. Another important aspect of this situation is that the number of observations impacts our level of uncertainty about the value of FG. The greater the number of observations comprising the sample, the more precisely the value FG will reflect the value FG. Suppose that, instead of taking a 20-bead sample, we took a 200-bead sample. The random variation in FG around FG would be smaller. In fact, it would be about 1/3 of what it is for a 20-bead sample. This is a very important point. The larger the sample size, the smaller the impact of randomness. 200 beads dampen the ability of any single bead to push FG away from FG. In a 1-bead sample, the single selected bead will produce an FG of either 0 or 1.0. In a 2-bead sample, FG can be 0, 0.50 or 1.0. In a 3-bead sample, FG can be 0, 0.33, 0.66 or 1.0. Thus, the larger the sample size, the smaller will be the magnitude of random variation in Fg. Large samples give Fg, the truth that we wish to know, the ability to reveal itself. This is an effect of the law of large numbers. Large samples reduce the role of chance. In other words, it can be stated that the larger the size of a sample, the more tightly the values of Fg will cluster about the value Fg. This is one of the most important principles in statistics. We have learned an important concept of statistics that can be stated as follows. Even though the value of Fg does not change over the course of the 50 sampling experiments, the value Fg can vary considerably from sample to sample. The phenomenon is called sampling variability. It is present whenever a random sample of observations is used to form a conclusion about a larger universe, i.e., population. Sampling variability is the source of the uncertainty that is addressed by statistical inference. Frequency distribution of the sample statistic Fg. In the box of beads experiment, the random variable Fg can assume 21 possible values ranging from 0, when there are no gray beads in a sample, to 1.0 when the sample is composed entirely of gray beads. The 50 observed values of Fg are shown in Table 4.1. A casual examination shows that some values of Fg occurred with greater frequency than others. Values in the range of 0.40 to 0.65 occurred quite often, whereas values less than 0.40 and greater than 0.65 almost never occurred. In the 50 samples taken, Fg assumed the value 0.509 times, 0.558 times, and 0.6010 times. Note that the value 0.65, which characterized the first sample, appeared only 5 times. Therefore, that value was not among the most common values, but it was not particularly unusual either. A plot called a frequency distribution, or frequency histogram, communicates this information more forcefully than words or a table. It displays how frequently each of Fg's possible values occurred over the 50 sampling experiments. The term distribution is apt, because it depicts how a set of observations on a random variable are distributed or sprinkled across the variable's range of possible values. Arrayed along the horizontal axis of the frequency distribution is a sequence of intervals, or bins, one for each possible value of Fg. The height of the vertical bar over each interval represents the number of times that a specific value of Fg occurred. Figure 4.6 shows the frequency distribution of the 50 Fg values, the equivalence of frequency and area. Frequency distributions depict an important relationship between the frequency of a particular value or set of values and the area covered by the bars representing that value or set of values. This concept can be understood if we first consider the entire distribution. In Figure 4.6, all the gray bars comprising the frequency distribution represent all 50 of the observed values of Fg. Thus, the area covered by all the vertical bars corresponds to 50 observations. You can verify this by summing the counts associated with all of the vertical bars. They will add up to 50. The same principle applies to any fraction of the distribution's area. If you were to determine the fraction of the frequency distribution's total area covered by the area of a single bar, you would find that the bar's fractional area is equal to the fraction of the total observations represented by that bar. For example, the vertical bar associated with the Fg value 0.60 shows a count frequency of 10. Thus, the bar represents 20% 10/50 of the observed values. If you were to then measure the area covered by this vertical bar, you would find that its area represents 0.20 of the total area covered by the entire distribution. This idea is illustrated in Figure 4.7. Although this idea may seem obvious, even trivial, it is an essential aspect of statistical reasoning. Ultimately, we will use the fractional area of a distribution to measure the probability that the back-test profits of a rule could have occurred by chance under the assumption that the rule has no predictive power. When that probability is small, we are led to the conclusion that the rule does have predictive power. Relative frequency distribution of Fg. The relative frequency distribution is similar to the ordinary frequency distribution discussed earlier. The height of a bar in an ordinary frequency distribution represents an absolute number or count of the number of times a particular value of a random variable was observed to occur. In the relative frequency distribution, the height of a bar represents the number of observed occurrences relative to divided by the total number of observations comprising the distribution. For example, Fg assumed the value 0.60 on 10 out of 50 observations. Thus, the value 0.60 had a relative frequency of 10/50, or 0.20. The distribution's bar for the value 0.60 would be drawn to a height of 0.20 along the vertical scale. This is illustrated in Figure 4.8. The equivalence between frequency and area that applies to ordinary frequency distributions also applies to relative frequency distributions. The relative frequency of all bars is equal adds up to 1.0. This simply says that a random variable always, 1.0 of the time, assumes a value somewhere in the range encompassed by all bars. If you were to add up the relative frequencies associated with all of the individual bars comprising the distribution, they would sum to 1.0, 100% of the observations. This has to be so because each bar represents the fraction of observations falling into that interval. And by definition, all the bars together represent all 1.0 the observations. The relative frequency of any single bar or group of contiguous bars is equal to their proportion of the distribution's total area. Thus, the relative frequency of an Fg value of 0.65 and larger is equal to 0.10 plus 0.06 plus 0.02 plus 0.02 equals 0.20. This is equivalent to saying that the combined area of the contiguous bars associated with Fg values of 0.65 and larger is 20% of the distribution's total area. We will be making statements similar to this when testing claims about TA rules. Based on this, it can be said that the relative frequency of Fg values equal to or greater than 0.65 is 0.20. This is illustrated in Figure 4.9. What knowledge has been gained about Fg from sampling? So far, sampling has increased our level of knowledge about Fg. In the first 20 bead sample, Fg had a value of 0.65. Based on this observation, two possibilities were conclusively ruled out, that Fg is equal to 0 and that Fg is equal to 1.0. Not being content with these meager morsels of wisdom, another 49 samples were taken, and the value Fg was observed in each. These 50 values showed that Fg varies randomly from sample to sample. However, despite the unpredictability of any single Fg value, an organized pattern emerged from the randomness that was informative. The Fg values coalesced about a central value, forming a well-organized hump. We suspect that this central tendency is related to the value Fg, yet Fg's precise value remains uncertain because of the random variation in Fg. However, in light of the hump's relatively narrow width, it seems reasonable to conjecture that Fg lies somewhere in the range 0.40 to 0.65. Given that we started with no knowledge of Fg, and given that we were precluded from examining the contents of the box in its entirety, a lot was learned from these 50 samples. A second box of beads. Now we will use sampling to learn the color proportions of a second box of beads. It too is a mixture of gray and white. The objective is the same, to learn the relative proportion of gray beads to the total number of beads in a second box. We call this quantity Fg2. As before, we are not allowed to examine the full contents of box 2, but we are permitted to take 50 samples, each composed of 20 beads. The value Fg2, which refers to the proportion of gray beads in a sample from box 2, is measured in each sample. Again, note the distinction between the terms Fg2 and Fg2. Fg2 refers to the proportion of gray beads in the entire box 2, whereas Fg2 refers to the proportion of gray beads in an individual sample. Fg2 is not observable while Fg2 is. Figure 4.10 is the relative frequency distribution for 50 values of Fg2. There are several things to notice. 1. The general shape of the distribution for box 2 is similar to that of box 1, a hump clustering about a central value. 2. The central value of the distribution for box 2 is different than that of box 1. The distribution for box 1 was centered near a value of 0.55. The central value for box 2 distribution is near 0.15. This is clearly seen in figure 4.11, which shows both distributions on the same horizontal scale. An arrow has been placed above each distribution at their approximate central values. Thus, the arrows represent average values for FG and FG2. From this, we can conclude that box 1 has a higher concentration of gray beads than box 2. 3. Even though the samples from box 1 and box 2 were both affected by random variation, the degree of random variation differs. Box 2 results are less variable than those of box 1. This is evidenced by box 2 narrower clustering about its central value. Given the lower degree of sampling variation in box 2, it would be fair to say that we know the value of FG2 with greater certainty than we know FG. What the box experiments taught us about statistics. Yogi Berra, former manager of the New York Yankees, said you can observe a lot just by looking. If he were a statistician, he might have said that you can learn a lot just by sampling. Even though a sample is only a portion of a larger universe population, it can teach us a lot about that population. However, there are limits to what a sample can tell us, limits imposed by randomness. A fundamental task of statistics is to quantify the uncertainty due to sampling variability. This makes it possible to quantify the reliability of statements of knowledge based on samples. Without such quantification, such statements are of limited value. Statistics cannot eliminate uncertainty, but it can inform us about it, and in so doing, it tempers assessments of how much we know or how accurately we know it. Thus, statistical analysis is a powerful antidote to the tendency to be overconfident. Statistical theory. The box of beads experiments touched on many of the key ideas of statistical inference. We will now mix in some theory to extend those ideas to the evaluation of TA rules. The 6 elements of a statistical inference problem. Evaluating a claim that a TA rule has predictive power, that a new vaccine can prevent illness, or any other claim of knowledge are examples of a statistical inference problem. Generally, such problems can be reduced to 6 key elements. 1. A population. 2. A sample consisting of a set of observations randomly selected from the population. 3. A population parameter. 4. A sample statistic. 5. An inference, and 6. A statement about the reliability of the inference. Each of these elements will be discussed as they relate to the box of beads experiments and then to the evaluation of TA rules. The population. A population consists of all possible observations of a random variable. It is a large, perhaps infinitely large, but a well-defined universe of observations. In the typical statistical inference problem, we want to learn some fact about the population, but it is either impractical or impossible to observe the population in its entirety. In the box of beads experiments, the population consisted of the set of beads filling a box. The color was the random variable. With respect to testing a TA rule, the population consists of all conceivable daily returns that would be earned by the rule's signal over the immediate practical future. To what does the term immediate practical future refer? It would be unreasonable to assume that the dynamics of financial markets are stationary, and so it would be unreasonable to expect that the profitability of a rule will endure in perpetuity. For this reason, the population with respect to TA rules cannot refer to returns occurring over an infinite future. A more reasonable notion is what I refer to as the immediate practical future. The immediate practical future refers to a finite future time period over which it would be reasonable to expect a useful rule's profitability to persist, even though markets are non-stationary. Any endeavor to find predictive patterns must make some assumption about the continuity of predictive power. In other words, unless one is willing to assume some persistence in predictive power, all forms of TA are pointless. The assumption being made here is that a rule will continue to work long enough to compensate the researcher for the effort of discovering it. This is consistent with the position taken by Grossman and Stiglitz On the Impossibility of Informationally Efficient Markets. It is also consistent with the idea that profitable rules signal opportunities to earn a risk premium, a topic discussed in Chapter 7. Therefore, the immediate practical future refers to all possible random realizations of market behavior over a finite future. It is as if there were an infinite number of parallel universes, where all universes are an exact duplicate except for the random component of the market's behavior. In each realization or universe, the pattern that accounts for the rule's profitability is the same, but the random component of the market is different. This idea is illustrated in Figure 4.12, the sample. The sample is a subset of the population that is available for observation. In the box of beads case, we were able to observe 50 independent samples. In the case of a TA rule, we typically observe a single sample of the rule's performance by backtesting it over a segment of market history. This sample is composed of a sequence of daily returns generated by the rule's signals. The sequence of returns is reduced to a single number, a sample performance statistic. The population parameter. The population parameter is a fact or characteristic about the population that we would like to know. It is typically numerical, but it need not be. Unfortunately, the population parameter is unknown because the entire population cannot be observed. The essence of statistical inference is the attempt to increase our knowledge about a population parameter, despite the impossibility of observing the population in its entirety. In the box of beads case, the population parameter of interest was the fraction of gray beads in the box, i.e., FG and FG2. In the case of a TA rule, the population parameter is the rule's expected performance over the immediate practical future. Performance can be defined in many ways. Some common measures include average rate of return, Sharpe ratio, profit factor, and so forth. In this book, our measure of performance is the annualized average daily return on detrended market, zero-centered data. In many statistical problems, it is safe to assume the population parameter never changes, i.e., it is a constant. In the box of beads experiment, the proportion of gray beads remained constant. Statistical problems in which the population parameter remains fixed are said to be stationary. Now, imagine a wrinkle on that situation. Suppose, unbeknownst to the experimenter, an invisible demon secretly removes or adds gray beads between samplings. Now the population parameter, FG, is unstable or non-stationary. Earlier in this chapter, I said that it is best to start with an assumption that any rule we test has no predictive power. That is, we assume that it has an expected return equal to 0. Or to put it in statistical terms, the population parameter is assumed equal to be 0. The sample statistic. A sample statistic is a measurable attribute of a sample. Its value is known because it has been observed. In this book, the term sample statistic is restricted to numerical facts, for example, a proportion, a percentage, a standard deviation, an average rate of return, a trimmed average, a Sharpe ratio, and so forth. In a statistical inference problem, the sample statistic typically refers to the same measurable attribute as the population parameter. In the case of the box of beads, the sample statistic, FG, referred to the fraction of gray beads in an individual sample. The population parameter, FG, referred to the fraction of gray beads in the whole box. The bottom line is this: a sample statistic is important because it sheds light on the population parameter. Beyond this, it is a fact of no particular importance. Some market historians seem to be unmindful of this essential truth. If a back test should result in a positive rate of return, it raises the following question: is the positive performance a random deviation above 0 due to sampling variability, or is it attributable to the rule's predictive power, i.e., the rule has an expected return greater than 0? Answering this question requires the tools of statistical inference. This is illustrated in Figure 4.13, an inference. Statistical inference is the inductive leap from the observed value of a sample statistic, which is known with certainty but which is true only for a specific sample of data, to the value of a population parameter, which is uncertain but which is deemed to hold true for a wide, perhaps infinite, number of unobserved cases. When a rule's positive past performance can reasonably be attributed to sampling variability, the reasonable inference is that its expected return over the immediate practical future is 0 or less. However, if the positive performance is too high to be reasonably attributed to sampling variability, luck. The reasonable inference would be that the rule possesses genuine predictive power and has a positive expected return over the immediate practical future. A statement about the reliability of the inference. Because a sample cannot represent the population perfectly, inferences based on a sample statistic are subject to uncertainty. In other words, it is possible that the inference is wrong. We have already seen how sample statistics vary randomly around the true value of the population parameter value. The science of statistics goes beyond simply admitting that its inferences are uncertain. It quantifies their reliability. This makes statistical conclusions considerably more useful than those reached by informal methods that do not provide such information. The inference can be wrong in two ways. One error is concluding the rule has predictive power when it does not. This is a case of good luck shining on a worthless rule. This type of mistake translates into taking market risks that will not be compensated. The other error is concluding the rule has no predictive ability when it really does. This mistake results in missed trading opportunities. Descriptive statistics. The field of statistics subdivides into two main areas, descriptive and inferential. The most important for TA is statistical inference, which was discussed in the preceding sections. However, before making an inference, we must describe the sample data in a succinct and informative way. The tools of descriptive statistics serve this purpose. The goal of descriptive statistics is data reduction, that is, reducing a large set of observed values to a smaller, more intelligible set of numbers and plots. Descriptive statistics tell the story of the forest rather than the individual trees. 3 descriptive tools will be important for the work that lies ahead. 1. Frequency distributions. 2. Measures of central tendency and 3 measures of variation. Frequency distributions. Frequency distributions have already been discussed in connection with the box of beads experiments. They were used to reduce a set of 50 observations on random variable fg into an informative plot. With only 50 observations, one might be able to form an overall impression of the data simply by looking at a table of numbers. Then again, if the number of observations were 500 or 5,000, a table would not be as informative as a frequency distribution. Plotting a frequency distribution is usually the first step in analyzing a set of data. It provides a quick visual impression of 2 key features of a sample of observations: the central tendency, e.g., average value, and the degree of dispersion or variation about the central value. For example, figure 4.11 showed that the 2 boxes of beads had different central values and different degrees of dispersion. A visual impression of a sample is useful, but quantification improves matters. For our purposes, we will need to quantify 2 features of the frequency distribution: its central tendency and its variability or dispersion about its central tendency. Statistics that measure central tendency. There are many measures of central tendency. 3 of the most common are the average, the median, and the mode. The average, also known as the arithmetic mean, is used in many TA applications and is the summary statistic used in this book. It is the sum of the observed values divided by the number of observations. It is important to distinguish the population mean from the sample mean. The sample mean is a statistic, a known quantity that is computed from observed values and varies randomly from one sample to the next. The population mean, in contrast, is unknown and does not vary in stationary problems. The formula for the mean of a sample is given in figure 4.14 in 2 forms. Statistical measures of variability, dispersion. Measures of variability describe the degree to which the observations in a sample are dispersed about their central tendency. In other words, measures of variability quantify the width of a frequency distribution. Among the widely used measures of dispersion are the variance, the mean absolute deviation, and the standard deviation. They are important in the traditional approach to statistics, i.e., classical statistics. The standard deviation is the square root of the average squared deviation of each observation from the mean of the data. The formula for the standard deviation of a sample is shown in figure 4.15. An intuitive notion of dispersion is best conveyed with pictures. Figure 4.16 shows a number of idealized frequency distributions with differing degrees of variation and different central tendencies. They are idealized in the sense that the stair-step look that characterizes real frequency distributions has been smoothed away. The key point of figure 4.16 is that central tendency and variation dispersion are independent characteristics of a frequency distribution. In row 1 of figure 4.16, the four distributions have the same degree of variation but different central values. In row 2, the distributions have the same central value but different degrees of variation. In row 3, all distributions have different central values and different degrees of variation. Probability. The notion of probability is important in statistics because it is used to quantify uncertainty. A conclusion reached via statistical inference is uncertain, that is, there is a chance of error. Thus, an inference about the value of a population parameter has some chance of being wrong. This chance is given in terms of a probability. We routinely use informal notions of probability to form expectations and make choices. Is the person I find so wonderful now likely to remain so after marriage? What is the chance I will find gold if I dig in a certain spot? Is it probable I will feel fulfilled pursuing a career in law? Should I buy that stock, and if I do, how much profit am I likely to make? The informal usage of probability is connected to a cluster of interchangeable terms illustrated in figure 4.17. For our purposes, something more definitive is required. The definition of probability that makes the most sense for the work that lies ahead is based on the notion of relative frequency. The relative frequency of an event is the number of times the event actually occurred divided by the total number of opportunities on which the event could have occurred. Relative frequency is given as a fraction between 0 and 1. It could rain every day, but in the month of April, the relative frequency of rain has actually been 0.36611 out of 30 days. If rain never occurred, then its relative frequency would be 0. If rain occurred every day, its relative frequency is 1.0. Thus, the relative frequency of an outcome is equal to number of occurrences of an event over number of possible opportunities for the event to occur. In the box of beads experiment, the value of Fg was measured 50 times. This was the maximum number of opportunities for any specific Fg value to occur. In fact, the value Fg equals 0.65 occurred on 5 out of 50. Therefore, it had a relative frequency of 5 over 50 or 0.10. Probability is the relative frequency of an event over the long run, the very long run. That is to say, the probability of an event is its relative frequency of occurrence given an infinite number of opportunities for its occurrence. Probability is stated as a number that lies in the range of 0 to 1 inclusive. A probability value of 0 means the event never occurs, whereas a value of 1.0 means it always occurs. Probability is a theoretical notion because it is never possible to observe an infinite number of anything. For practical purposes, however, when the number of observations becomes very large, relative frequency approaches theoretical probability. The law of large numbers. The tendency of relative frequencies to converge to theoretical probabilities as the number of observations becomes large is called the law of large numbers. The operation of the law of large numbers can be illustrated with coin tossing. The possible outcomes events are heads or tails, and the probability of heads is known to be 0.50. The law tells us that the relative frequency of heads will converge to its theoretical value, 0.5, as the number of coin tosses becomes large. However, even for a large number of tosses, a departure from 0.50 can still occur, though the likely size of the departures decreases as the number of tosses increases. For small samples, however, the law of large numbers warns us that the relative frequency of heads can differ substantially from 0.50. When the number of tosses is only 3, a value of 1.0 can easily occur, 3 heads in 3 tosses. Figure 4.18 shows the fraction of heads in a coin toss experiment as the number of tosses grows from 1 to 1,000. When the number of tosses observations is less than 10, the fraction of heads experience 2 large deviations from 0.50. At 3 tosses, the fraction of heads reached 0.662 out of 3. At 8, the fraction was 0.3753 out of 8. However, as the number of tosses increased, the random variable, fraction heads, experienced progressively smaller deviations from the expected value of 0.50. This is exactly what the law of large numbers predicts. Now imagine a naive coin flipper. Upon observing 5 heads in 5 tosses, he loudly proclaims, "I've found the holy grail of coins. It always comes up heads." The law of large numbers says that the poor fellow's optimism is unwarranted. This is also likely to be true for the TA researcher who finds a rule with 5 historical signals, all of which were correct. Optimism is most likely unwarranted. Chapter 6 will show that if this rule was selected because it was the best performing rule out of a large universe of back-tested rules, that is to say, it was discovered by data mining, there would be even less reason to be optimistic about its future performance. Theoretical versus empirical probability. There are 2 kinds of probabilities, theoretical and empirical. Theoretical probabilities can be determined with a good degree of confidence purely on logical grounds. They are derived independent of prior experience, most often based on arguments of symmetry. In other words, they can be deduced without any reference to the world of experience. The probability of a head in a coin toss is a theoretical probability. There is no need to toss it 10,000 times to predict that over the long run the probability of heads is 0.50. Simply the fact that the coin is fair, that it has 2 faces, and that it is unlikely to land on its edge is sufficient grounds for suspecting heads and tails are equally likely. The probabilities for being dealt a royal flush in poker, the occurrence of a 6 in a dice roll, and the chance of winning lotto are also theoretical because each can be determined by a logical analysis of the situation. Empirical probabilities are based on observed frequencies. Technical analysis is concerned with this type of probability. The chance of new snowfall on Mount Hood during the month of July, or the likelihood of a rise in the stock market following a 2% drop in interest rates, are examples of empirical probabilities. They can only be determined by observing numerous past instances of the specified conditions, Mount Hood in July, and determining the relative frequency of the event, new snow. When determining empirical probabilities, it is vitally important that each instance be characterized by the same set of conditions. In TA, this is a practical impossibility. Each past instance of a 2% drop in interest rates is similar with respect to that specific condition, but there are numerous other conditions that may not be the same. For example, the level of interest rates prior to the 2% drop may differ from observation to observation. In one instance, interest rates were at 5% prior to the drop, whereas in another they were 10%. Of course, the level of interest rates could be added to the set of conditions that define each instance, but that has the downside of reducing the number of comparable instances. Moreover, there will always be other conditions that are not part of the specified condition set. The inability to control all potentially relevant variables is an unfortunate fact of life in non-experimental/observational sciences. In contrast, the experimental scientist enjoys the supreme advantage of being able to hold constant all or nearly all relevant variables, except the one being investigated. Imagine being able to do that in TA. I am told this is how it is in the afterlife. Probability distributions of random variables. A probability distribution shows how often we can expect the different possible values of a random variable to occur, i.e., their relative frequencies. The probability distribution of a random variable is a relative frequency distribution built from an infinite number of observations. The concept of a probability distribution can be understood by thinking of a sequence of relative frequency distributions, each built from increasing numbers of observations and progressively narrower bins or intervals. Gradually, the relative frequency distribution becomes a probability distribution. With increasing numbers of observations, more discrete intervals of decreasing width can be created. As the number of observations approaches infinity, the number of intervals approaches infinity, and their widths shrink to 0. Thus, the relative frequency distribution morphs into what is called a probability distribution, more technically referred to as a probability density function. Figures 4.19 though 4.23 show how a relative frequency distribution evolves into a probability density function as the number of intervals is increased and their interval widths are decreased. The height of each bar represents the relative frequency of events falling within the bar's interval. The figures presume that the random variable is a measure of price change. This succession of diagrams shows that a probability density function is, in effect, a relative frequency distribution composed of an infinite number of observations whose intervals are infinitely narrow. Here is where things get a bit strange. If the intervals of a probability distribution have zero width, then there are zero observations per interval. This seems to make no sense. However, it is quite common for mathematical concepts to be at odds with common sense. In geometry, a point has location but occupies no space, i.e., length, width, and breadth equals zero. A line has length but zero width, and so forth. The fact that an interval has zero observations has a strange implication: the probability that any single value of a continuous random variable will ever occur is equal to zero. For this reason, it only makes sense to speak of the probability that a random variable will assume a value within a specified range of values. In other words, it makes sense to speak of the probability that a random variable will assume a value between specified minimum and maximum values. It also makes sense to speak of the probability that a random variable will assume a value that is equal to or greater than some specified value or less than or equal to a specified value. For example, we can speak of the probability that a value of 3.0 or greater will occur. However, it would make no sense to speak of the probability of a value of exactly 3.0. This somewhat counterintuitive idea fits nicely with rule testing. When testing the statistical significance of a rule's past rate of return, we will be concerned with the probability that a rate of return of plus 10% or higher could have occurred by chance under the condition that the rule has no predictive power. Probability density functions can provide such information. Relationship between probability and fractional area of the probability distribution. Let's recap what has been established up to this point. 1. The probability of an event is its relative frequency of occurrence given an infinite number of instances in which the event could have occurred. 2. A probability density function is a relative frequency distribution built from an infinite number of observations and intervals of zero width. 3. The relative frequency of a random variable taking on a value within a given interval is equal to the fractional area of the frequency distribution sitting on top of that interval. See Figure 4.24. We are now ready to take the final step in this sequence of thinking. It is analogous to point 3 in the preceding list, except that the term relative frequency distribution is replaced with probability density function. The probability that a continuous random variable will assume a value within a specified range is equal to the fraction of the probability density function encompassed by sitting above that range. This concept is illustrated in Figure 4.25. It shows the probability that x, a continuous random variable, will assume a value within the range of b is equal to 0.70. In many instances, the interval in question refers to the extreme or tail of the distribution. For example, Figure 4.26 shows the probability that random variable x will assume a value of b or greater. The probability is 0.15. The probability distribution of a random variable is a very useful concept. Even though an individual future observation on random variable x is not predictable, a large number of observations form a highly predictable pattern. This pattern is the random variable's probability density function. Now, here is where these ideas start to come together for us. Chapter 5 will show that, when a hypothesis is represented by the probability distribution of a random variable, we will be able to use an observed value of the random variable to test the veracity of the hypothesis. This will enable us to conclude if a rule's back-tested profitability was due to luck or genuine predictive power. The probability distribution used for this purpose is a specific type. It is called a sampling distribution, perhaps the most important one in all of statistics, and certainly the most important for TA analysts. The sampling distribution, the most important concept in statistical inference. To recap: 1. A random variable is the outcome of a probability experiment. 2. Taking a sample of a given number of observations from a population and computing the value of a statistic such as the sample's mean is a probability experiment. 3. A sample statistic is a random variable in the sense that it fluctuates unpredictably from one sample of observations to the next. The sample statistic fluctuates randomly because chance determines which specific observations wind up in a particular sample. And it is that particular set of observations that determines the value of the statistic for that sample. In the box of beads experiment, the value Fg varied randomly from one 20-bead sample to the next because the particular set of beads that wound up in a given sample was determined by chance. 4. A relative frequency distribution describes how often the possible values of a random variable occur over a very large number of observations. We are now ready to meet the sampling distribution, the most important concept in statistical inference. The sampling distribution defined. The sampling distribution is the probability distribution of a random variable, and that random variable happens to be a sample statistic. In other words, the sampling distribution shows the various possible values the sample statistic can assume, and their associated probabilities. For example, the sampling distribution of the sample mean refers to the probability distribution of all possible means for all possible random samples of a given size from some population. Here, the sample statistic is the mean. The sample statistic in the box of beads experiments was Fg. Its random variation across 50 samples, each comprised of 20 beads, was shown by the relative frequency distribution in Figure 4.8. If, instead of 50 values, we were to take all possible 20-bead samples, a very large number, this theoretical distribution would be Fg's sampling distribution. In rule backtesting, the sample statistic is a measure of performance observed in a backtest. In this book, that sample statistic will be the rule's average rate of return. A backtest typically produces a single observed value for the performance statistic because we have a single sample of market history. Now imagine what it would be like if we were able to test a rule in an infinite number of independent samples of market history. This would provide an infinite number of values for the performance statistic. If this set of data were then converted into a relative frequency distribution, it would be the statistic's exact sampling distribution. This is obviously not possible because we do not have an infinite number of independent samples of historical data. However, statisticians have developed several methods to get something that approximates the exact sampling distribution closely enough to be useful, despite the fact that we have only one sample of historical data and one value of the sample statistic. Two of these methods will be discussed later in this chapter. The sampling distribution quantifies uncertainty. The sampling distribution of a statistic is the foundation of statistical inference because it quantifies the uncertainty caused by the randomness of sampling variability. As stated above, the sampling distribution displays the relative frequencies of a statistic if it were to be measured in an infinite number of random samples of the same size, drawn from the same parent population. The box of beads experiments showed that the value of a statistic, Fg, fluctuated randomly from sample to sample. Figure 4.8 showed that these values tend to fall into a well-behaved pattern, not a random chaotic mess. The fact that the pattern of random variation is well-behaved is what makes statistical inference possible. It may seem ironic that a sample statistic would show such a regular pattern given that it is, in fact, a random variable. Thankfully for statisticians, it does. Figure 4.8 revealed a central value, i.e., the mean of the sampling distribution of approximately 0.55. It also showed a well-defined pattern of dispersion about this central value. This pattern allowed us to conclude, with a fair degree of assurance, that the value of the population parameter Fg was contained within the range 0.40 to 0.65. It also allowed us to conclude, although with somewhat diminished confidence, that Fg was more accurately pinned in the range between 0.50 and 0.60. It was the degree of dispersion in Fg's sampling distribution that permitted these statements to be made about the value of the population parameter Fg. The dispersion of the sampling distribution quantifies the uncertainty of our knowledge about the population parameter Fg. The distribution's central tendency conveys information about the most likely value of Fg, approximately 0.55. Knowing this is nice, but it is not enough. It is also important to know about the reliability of the value 0.55. In other words, how accurately does the sampling distribution's central tendency of 0.55 portray the true value of Fg? The reliability degree of certainty is conveyed by the dispersion of the sampling distribution. The greater the distribution's dispersion around its central value, 0.55, the less certain we can be that 0.55 accurately informs us about the true value Fg, the proportion of gray beads in the entire box. To illustrate this point, consider the two following sampling distributions. Both have central values of 0.55, but their dispersions are quite different. The first, shown in figure 4.27, is a narrow dispersion, thereby delivering a strong impression that Fg is in the vicinity of 0.55. The distribution in figure 4.28 is wider, thus conveying a less certain message about Fg value. It is saying that the true value Fg may be considerably different from the central value of the sampling distribution. In summary, certainty is directly related to the dispersion of the sampling distribution, and the certainty of a conclusion about a population parameter depends upon the width of the statistics sampling distribution. Greater width means greater uncertainty. Suppose it is hypothesized that a rule's expected return is equal to 0. Also suppose the rule's back-tested return turns out to be greater than 0. Is the positive return sufficient evidence to conclude that the hypothesized value of 0 is false? The answer will depend on how far above 0 the back-tested return is relative to the width of the sampling distribution. If the relative deviation is large, the hypothesis can be rejected. Quantifying the relative deviation and the reasoning behind a decision to reject or not to reject the hypothesis will be treated in Chapter 5. The important point for now is that the width of the sampling distribution is critically important in answering this question. Sampling distribution of trading performance. A sampling distribution can be formed for any statistic: the average, mean, the median, the standard deviation, and many other statistics used in statistical inference. Each has its own sampling distribution. This discussion here is confined to the sampling distribution of the mean because the performance statistic used to evaluate TA rules in this book is a rule's mean rate of return. However, there are many other performance measures that might be used: the Sharpe ratio, the profit factor, the mean return divided by the Ulster index, and so forth. It should be pointed out that the sampling distributions of these alternative performance statistics would be different from the sampling distribution of the mean. It should also be pointed out that the methods used in this book to generate the sampling distribution of the mean may be of limited value in generating sampling distributions for performance statistics with elongated right tails. This can occur with performance statistics that involve ratios such as the Sharpe ratio, the mean return to Ulster index ratio, and the profit factor. However, this problem can be mitigated by taking the log of the ratio to shorten the right tail. The three distributions of statistical inference. Statistical inference actually involves three different distributions, one of which is the sampling distribution. They are easy to confuse. This section is intended to clarify their differences. In the context of rule testing, the three distributions are: 1. Data distribution of the population, an infinite-size distribution comprised of all possible daily rule returns, which we assume extends into the immediate practical future. 2. Data distribution of the sample, a distribution comprised of a finite number n of daily rule returns from the past. 3. Sampling distribution, an infinite-size distribution of the sample statistic. In this case, it is the rule's mean return. It represents the mean returns of the rule if it were to be tested in an infinite number of random samples of size n extracted from the population. There are 2 points to emphasize. First, the observations comprising the data distribution of the population and the data distribution of the sample 1 and 2 in the preceding list are comprised of single-day rule returns. In contrast, the observations comprising the sampling distribution are sample statistics, in which each observation represents the mean return of the rule computed over a sample of days. Second, both the population distribution and the sampling distribution are theoretical in the sense that they refer to an infinite number of possible observations. In contrast, the data distribution of the sample is composed of a finite number of observations from a historical backtest. The relationship between these 3 distributions can be visualized by imagining an experiment similar to the box of beads experiment. In this case, however, you are to imagine a population distribution of daily rule returns that is infinite in size. Imagine taking 50 independent samples from the population, where each sample is comprised of a substantial number of daily rule returns. Next, determine the mean return for each sample and then plot the sampling distribution of the 50 means. This is illustrated in Figure 4.29. The real world, the problem of one sample. The preceding discussion was theoretical in the sense that we imagined what it would be like if we could observe 50 independent samples from a parent population. In most real-world statistical problems, there is only one sample of observations, and thus one value for the sample mean. The problem is that with only one sample mean available, we have no notion of the sample statistics variability. The problem of one sample and one mean is illustrated in Figure 4.30. Fortunately, we can learn a lot about a sample statistics variability and its sampling distribution by looking at the single available sample. The discovery of how to do this, early in the 20th century, is what made the field of statistical inference possible. In fact, statisticians have developed 2 distinct approaches for estimating the sampling distribution of a statistic from a single sample of observations, classical and computer-intensive. Although both will be discussed, the computer-intensive approach will be used for the rule tests performed in Part 2. Deriving the sampling distribution, the classical approach. This classical approach is the one most often taught in basic statistics courses. It is attributed to the 2 fathers of mathematical statistics, Sir Ronald Fisher, 1890-1962, and Jerzy Neyman, 1894-1981. It utilizes probability theory and integral calculus to derive the sampling distribution on the basis of a single observed sample. It provides estimates of the sampling distribution's dispersion, its mean, and its basic shape, normal. In other words, it provides everything needed to quantify the reliability of an inference based on a single sample of observations. The sampling distribution of the sample mean every statistic has its own sampling distribution. This discussion will focus on the sampling distribution of the mean average, because it is the statistic used in Part 2 to evaluate TA rules. Classical statistical theory tells us several things about the sampling distribution of the mean. 1. The mean of a large sample is a good estimate of the mean of the population distribution from which the sample was obtained. The larger the sample, the more closely the sample mean conforms to the population mean. 2. The dispersion of the sampling distribution depends on the size of the sample. For a given population, the larger the sample, the narrower the sampling distribution. 3. The dispersion of the sampling distribution also depends on the amount of variation within the parent population data. The bigger the variation in the parent population, the wider the sampling distribution. 4. Under the conditions that apply to the evaluation of TA rules, the shape of the sampling distribution of the mean will tend towards the so-called normal or bell shape, with the conformity to the normal shape increasing as the sample size increases. Other sample statistics, such as ratios, can be profoundly non-normal. Each of these concepts is now explained. The mean of a large sample is a good estimate of the population mean. This is a manifestation of the law of large numbers, which we met previously in the context of a coin flipping experiment. To recap, the law of large numbers tells us that the larger the number of observations comprising the sample, the more closely the sample mean will approximate the population mean. There are some qualifying conditions attached to this promise, but they need not concern us here. The graph of the coin flipping experiment illustrated the action of the law of large numbers, figure 4.18. As the number of coin tosses increased, the proportion of heads gradually converged to its theoretically correct value of 0.50. In the early stages of the experiment, when the sample size was small, there were large departures from 0.50. These departures illustrate the large role that chance plays in small samples. In 4 tosses, though values of 0.75 or 0.25 are not the most probable, they are quite common. However, when the number of coin tosses reaches 60, the probability of 0.75 or 0.25 is less than 1 in 1,000. The important lesson: increased sample size diminishes the role of chance. The dispersion of the sampling distribution depends on the size of the sample. The larger the sample, the less the dispersion. Imagine a very large population of observations on some variable whose standard deviation is 100. Usually, we do not know the population's standard deviation, but in this case, we will assume that we do. In figure 4.31, I show the parent population distribution at the bottom. Above it are 2 sampling distributions for the variables mean for sample sizes of 10 and 100. Notice that the width of the sampling distribution is cut by approximately 1/3 each time the sample size is increased by a factor of 10. One of the lessons from classical statistics is that the standard deviation of the sampling distribution of the mean is inversely proportional to the square root of the sample size. Thus, if the sample size is increased by a factor of 10, the width of the sampling distribution is reduced a factor of 3.16, the square root of 10. The parent distribution can be thought of as a sampling distribution with a sample size of 1 mean, the population mean. The sampling distribution for a sample size of 100 is 1/10 the width of the parent population. The essential message is the larger the sample size, the less the uncertainty about the value of a sample statistic. Incidentally, the standard deviation of the sampling distribution of the mean is given a special name in statistics: the standard error of the mean. See later explanation. With some qualifications, the law of large numbers tells us that the larger the sample size, the more accurate our knowledge of the population's average. With some caveats, therefore, we would like to work with samples that are as large as possible so as to minimize the width of the sampling distribution as much as possible. The dispersion of the sampling distribution of the mean also depends on the amount of variation within the data comprising the parent population. There is another factor that impacts the width of the sampling distribution: the amount of variation within the parent population from which the sample was taken. The greater the variation within the population data, the greater will be the variation dispersion of the sampling distribution. You can visualize this by thinking about a population that has no variation at all. For example, if all people in the population weighed 150 pounds, every sample is going to have an average weight of 150 pounds. Therefore, 0 variation among the members of the population would lead to 0 variation in the sample average, and consequently a sampling distribution that has no dispersion whatsoever. Conversely, if there is great variation among the individuals comprising the population, there is going to be greater variation in the sample averages, which translates to a fat sampling distribution. Shape of the sampling distribution tends toward normal. The central limit theorem, a foundational principle of classical statistics, states that as the size of a sample gets larger, the sampling distribution of the mean, with some qualifications, converges toward a specific shape irrespective of the shape of the population distribution. In other words, no matter how weirdly shaped the distribution of the data in the parent population, the shape of the sampling distribution approaches a specific shape that statisticians refer to as the normal distribution, also known as the Gaussian distribution. The normal distribution is the shape of the most common probability distribution. Often referred to as the bell curve because it has the silhouette of the Liberty Bell, the normal distribution characterizes continuous variables that describe many real-world phenomena. There are a few points about the normal distribution that should be understood. It is completely described by its mean and its standard deviation. If these two facts are known, you know everything that there is to know about the distribution. About 68% of the observations lie within one standard deviation of the mean, and about 95% lie within two standard deviations of the mean. The tails of the distribution become quite thin beyond two standard deviations. Thus, values beyond 3 standard deviations are rare and beyond 4 are extremely rare. The normal distribution, which is illustrated in Figure 4.32, is so common that it has been called a fundamental feature of the natural world. Its shape is caused by the additive effects of many independent factors acting on the same situation. For example, systolic blood pressure is affected by genetic factors, diet, weight, lifestyle, aerobic conditioning, and a multitude of other factors. When they interact, the probability distribution of blood pressures in a large group of randomly selected people will have the bell-shaped distribution. Figure 4.33 shows several very non-normal population distributions along with the shape of the sampling distribution of the mean. Note how the sampling distribution converges to a normal shape, as a sample size is increased irrespective of the shape of the distribution of the data in the parent population. There is nothing magical about the number 30. The rate at which the sampling distribution converges to a normal shape as a function of sample size depends on the shape of the parent distribution. Note that for 3 of the cases in the figure, a sample size of 5 produces a nearly normally shaped sampling distribution of the mean. However, for the bottom case in the figure, the sampling distribution of the mean does not become normal-like until a sample size of 30. The standard error of the mean. We are now in a position to take the final step toward defining the sampling distribution of the mean as it is done in classical statistics. So far, it has been established that 1. The sampling distribution of the mean converges to the shape of a normal distribution as the sample size is increased. 2. A normal distribution is fully described by its mean and its standard deviation. 3. The standard deviation of the sampling distribution of the mean, also known as the standard error of the mean, is directly related to the standard deviation of the population from which the samples were taken. 4. The standard error of the mean is inversely related to the square root of the sample size. The standard error of the mean is equal to the standard deviation of the population divided by the square root of the sample size. This is a true statement, but not of practical use because the standard deviation of the population is not known. This is simply a consequence of the fact that the full population is not observable. However, the standard deviation of the population can be estimated from the sample. This estimate, which is designated by sigma hat, is shown in equation in Figure 4.34. The little roof or hat over the sigma is statistical symbolism for a quantity that has been estimated. You will note that the divisor within the radical sign is n1 rather than n. This modification compensates for the fact that the sample standard deviation understates the standard deviation of the population. This expression is used to estimate the standard deviation of the parent population, which is then used in the equation in Figure 4.35 to estimate the standard error of the mean. With the standard error of the mean in hand, and the assumption that the sampling distribution is normal, it is now possible to form a good estimate of the sampling distribution of the mean. And recall, all this was on the basis of a single sample. There is one problem with the traditional approach. It assumes that the sampling distribution is normally shaped, bell curve. If this proves not to be so, the conclusions reached will be inaccurate. For this reason, I have chosen to use an alternative method for estimating the sampling distribution of the mean, based on computer simulation. Deriving the sampling distribution with the computer-intensive approach. Until about 30 years ago, there was no alternative to the classical approach for deriving the sampling distribution from a single sample. Now there is the computer-intensive approach. By systematically resampling the single available sample many times, it is possible to approximate the shape of the sampling distribution. This procedure is described in this section. The next chapter will present 2 computer-based methods, bootstrap resampling and Monte Carlo permutation. Although each method has its limitations, as is true for any statistical method, they are useful alternatives to the classic approach. The bootstrap is so named because it seemingly lifts itself up, as if by its own bootstraps, to approximate the shape of the sampling distribution. In this book, it will be used to approximate the shape of the sampling distribution of the average return for rules that have no predictive power. The Monte Carlo permutation method is named after the famed European gambling casino because it uses the computer as if it were a roulette wheel. By whatever means it is generated, the sampling distribution serves the same purpose. It tells us how much the back-tested return of a non-predictive rule can vary above or below zero due to the random effects of sampling. Thus, it serves as the benchmark for evaluating rule performance. If the rule's mean return is too high to be due to sampling variability, the rule is judged to have predictive power. Preview of next chapter. We have already made a number of references to using statistical inference to test claims. The official title for this activity is hypothesis testing. The next chapter discusses the rationale and mechanics of hypothesis testing. It will also consider another use of statistical inference, estimating confidence intervals. A confidence interval is a range that contains the true value of the population parameter with a specified level of confidence. For example, if the observed mean return of a rule is 15%, the 95% confidence interval might indicate that the rule's true return lies between 5% return and 25% return. The width of the confidence interval, in this case 20 percentage points, is derived from the same sampling distribution that is used for hypothesis testing.